Mic check, 1, 2, 3. Committee will come to order. Good morning, everyone. Welcome back to another House Financial Services Committee markup. Today we'll consider several regulatory oversight measures. This includes 7 pieces of legislation that were rolled over from the last markup that we didn't have time to get for circumstances on the House floor. And it seems like everything's going very smoothly on the House floor this week, so we shouldn't be interrupted at all in our committee, at least not for the next couple of minutes. And then we've got 6 Congressional Review Act, or CRA, resolutions. I'll get into the structure of that, but the first 7 bills we'd noticed previously. We're already on that. 5 Republican bills, 2 Democratic bills. We got a lot to get done. So first bill I want to bring up is the Financial Services Innovation Act, which I recently reintroduced, which allows entrepreneurs to beta test new products and services without sacrificing critical consumer protection safeguards. This would help firms harness technology to innovate without fear of heavy-handed penalties from regulators. Next is Congresswoman Houchin's Bipartisan Futures Act. This legislation will help regulators utilize new technology to achieve more efficient and streamlined supervision. This is not enough. It's not enough to champion innovation in the private sector. We also must ensure federal financial regulators are keeping pace with ever-changing technological landscape, and our committee has an interest in pushing that forward. I look forward to advancing Congressman Stiles' Earned Wage Access Consumer Protection Act. EWA products provide short-term liquidity to Americans trying to make ends meet. As sky-high prices continue to hammer family budgets, protecting consumers' access to these innovative products is more important than ever. This bill will ensure Biden's regulators don't stymie the clear benefits of earned wage access products by applying inappropriate regulations to them. 2 other bills, Congressman Loudermilk's Bipartisan Respect State Housing Laws Act and Congressman Fitzgerald's Insurance Data Protection Act, build on Republican efforts to rein in rogue regulators. These bills correct provisions in existing law that are being exploited for uses other than their intended purposes. We should all agree that the American people and small businesses should not be forced to deal with the phony or misused application of laws stretched far beyond their original intent. We'll also advance 6 resolutions to combat gross overreach by Biden's financial regulators using the Congressional Review Act. The Congressional Review Act has been utilized by Democrats and Republicans here in Congress to have a check on the executive branch rulemaking and rulemaking results. This package is not a knee-jerk reaction to everything the Biden administration does. It's a targeted effort. The CRA, the Congressional Review Act, is an essential tool Congress has at its disposal to carry out our constitutional duty to hold the executive branch accountable. We'll consider Subcommittee Chairman Huizinga's H.J. Res. 127 to overturn the SEC's disastrous climate disclosure rule. The fatally flawed rule exceeds the agency's authorities, threatens our economy, and would overwhelm investors with non-economic information. It's costly, complex, and against the public good. The SEC's stay of the rule is not enough, so House Republicans are taking action to protect the American job market, the American stock market, job creators and workers and investors from this destructive rule. We'll also advance Subcommittee Chairman Barr's H.A. Res. 122 to protect America's access to affordable credit. This CRA resolution will block the CFPB's credit card late fee rule. The credit card late fee rule fails to acknowledge the role certain fees play in encouraging timely payments. It will harm consumers by shifting costs to responsible consumers who pay on time in the form of higher annual fees and higher interest rates. Additionally, we'll mark up Vice Chair Hill's H.J. Res. 120. This resolution overturns the Biden administration's guidance on non-bank designation through the Financial Stability Oversight Council. This guidance represents another attempt by FSOC to become a roving regulator. Instead of targeting specific companies or industries that may be politically unfavorable, FSOC's focus on actually the emerging risks that in the financial system, that should be their focus. We'll also consider 3 CRA resolutions to rescind Biden administration's banking regulators' climate risk management principles for larger financial institutions. The resolutions led by Representatives Fitzgerald, Houchin, and Donalds will overturn the rules from the Fed, FDIC, and OCC, respectively. This critical effort builds on Republicans' work to stop the Biden administration from forcing a progressive climate regulatory agenda through financial regulation. Finally, we'll mark up 2 bills led by Democratic colleagues, Congressman Sherman's Bank Safety Act and Congressman Green's Systemic Risk Authority Transparency Act. I'll close by reiterating what I've said at every markup this Congress. My door is always open. If there is an issue that interests you or a problem you wanted to address, come talk to me. I can't guarantee you a successful outcome, but we will always engage in the conversation. And where we can find common ground, I'm committed to finding solutions. So with that, I'll recognize the ranking member for the purposes of an opening statement.
Thank you, Chairman McHenry. Good morning, everyone. Today, this committee is marking up several bills. Unfortunately, most of the bills we're considering are not bipartisan and would pose significant harm to our nation's consumers and investors. This includes the 6 Congressional Review Act resolutions, or CRAs, that will repeal important consumer, investor, and environmental protection rules. With these CRAs, Republicans are working on behalf of credit card companies, big oil and gas, the Chamber of Commerce, and other titans of Wall Street committee Republicans. Committee Republicans are teaming up with big banks to block rules that would protect consumers against junk fees, which cost consumers $10 billion annually, rules that would help prevent another financial crisis, and rules that would provide investors with information about the financial risk of the climate crisis that would impact the value of their investments if enacted. These harmful and problematic resolutions will prohibit the federal government from ever putting out any similar protections going forward. And that's really the point. That's not all my colleagues on the other side of the aisle are doing to harm our nation's financial system. They're also moving forward with a bill to remove basic safeguards for consumers using earned wage access products, even though these products have long posed many of the same risks to consumers as other credit problems. EWA companies have wrongly insisted that they are different. I don't buy it. The bill before us today would give the industry exactly what they want, a weaker regulatory framework, and this will push vulnerable consumers into a dangerous cycle of debt with unsustainable payday loan-like interest rates. We will also consider another bill that demonstrates how committee Republicans have forgotten the responsible part of responsible innovation. The so-called Financial Services Innovation Act of 2023 creates so-called sandboxes where financial firms can break federal laws in the name of innovation. I'm also deeply disappointed with the woefully inadequate Republican response to the affordable housing crisis. At the last markup, the only bills Republicans could muster simply required more talking about the housing crisis. Unfortunately, Republicans have now decided to exacerbate the crisis with legislation to make it easier to evict tenants. And while insurance companies cancel homeowners' policies and pull out of state after state, Republicans are rewarding the insurance industry by moving legislation to prevent the Federal Insurance Office from investigating these industry practices. A better use of this committee's time is to move legislation that will actually address housing inflation and homelessness, including my bills, the Housing Crisis Response Act, Ending Homelessness Act, and the Down Payment Toward Equity Act. The Republican-led bills today serve as further proof that Republicans will always choose Wall Street and corporate elites over our nation's consumers. The simple truth is they cannot solve our most pressing issues or safeguard our economy. Committee Democrats, however, have solutions to real problems, including bills from Mr. Green and Mr. Sherman to respond to and prevent a repeat of the catastrophic bank failures last year. It's time to get these bills across the finish line. And with that, I yield back.
Shelley yields back. Pursuant to notice, I call up H.R. 5535, the Insurance Data Protection Act, introduced by the gentleman from Wisconsin, Mr. Fitzgerald. The clerk will report the bill, which was distributed in advance.
H.R. 5535, to prohibit the Federal Insurance Office of the Department of Treasury and other financial regulators from collecting data directly from an insurance company.
Without objection, the bill is considered as read and open to amendment at any point. The gentleman from Wisconsin.
Mr. Chairman, I object to treating the ANS as base text.
The gentleman from Wisconsin has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment. Then I will recognize the ranking member.
Amendment in the nature of a substitute to H.R. 5535.
Without objection, the amendment is considered as read and will serve as base text for the purposes of amendment. The ranking member objects.
I object to treating the ANS as base text.
The ranking member objects to the ANS will be treated as a first-degree amendment. And before I recognize the gentleman from Wisconsin for 5 minutes, I want to announce to committee members who are present, today is the day our committee gets into at least the last couple of decades of technology. We will use electronic voting devices today.
Where are they?
Other committees have electronic voting, but I should have announced this at the top. Today is the day that we try to use technology that is less complex than the technology every one of us on this committee use that is in our pocket, our phone. I did test this out with a group of third graders on a tour on Monday morning. Committee staff has tested it out very well. I look forward to us embarrassing ourselves as a committee collectively in a bipartisan way before we figure out how to actually use this. So it should be exciting when we do this voting. I want everybody attentive to this, and I want our staffs to make sure they document it very well, how we comport ourselves in a bipartisan way. And with that, I'm going to recognize, the chair now recognizes the gentleman from Wisconsin, Mr. Fitzgerald, for 5 minutes.
Thank you, Mr. Chair. For about 150 years, state insurance regulators and laws have regulated insurance companies. But recently, the Federal Insurance Office has grown increasingly aggressive in collecting data from insurance companies, with the latest and most egregious example being the revised proposed data collection to access climate-related financial risk. I'm pleased that last month, the Insurance Office chose to defer to the National Association of Insurance Commissioners' climate data call. However, the long process it took to get here demonstrates, excuse me, why the Insurance Office should not have the potential to abuse their subpoena authority. When it was first issued, the Insurance Office intentionally chose to not collaborate with state regulators on their climate data call, which goes directly against Dodd-Frank's Act provision requiring the Insurance Office to first confer with the state insurance regulators before issuing any kind of data call. Not only has the Insurance Office been unclear with how they intend to use the data they collect, the effort would be duplicative, as many states, as we're all well aware, who have worked with the state insurance regulators, already collect similar data, if not exactly the same. Individual state insurance regulators, as well as the National Association of Insurance Commissioners, has been monitoring the climate for decades, as it serves as one of the primary factors in assessing risk. Further, state regulators have a unique understanding of the challenges and risks that face their respective states regarding the climate. Their experience and knowledge in this space is much more valuable in assessing climate risk than that of bureaucrats in Washington. The mere threat of a subpoena incentivizes the insurance office to go around the states by issuing overly broad data calls that may not adequately protect consumer information to insurers. That is why I introduced the Insurance Data Protection Act. In addition to repealing the insurance office's subpoena authority, this bill would prescribe the treatment of data collected by financial regulators from an insurance company, including confidentiality procedures and agency disclosure requirements. Additionally, the bill declares that the sharing of any non-publicly available data with or by the office among other federal agencies, the state insurance regulators and their collective agents, or other entities does not affect any federal or state confidentially privilege arising under federal or state law to which such data or information is otherwise subject. I urge my colleagues to vote in favor of the bill to keep insurance regulated at the state level, and I yield back.
Further discussion, further debate on the ANS? Ranking member is recognized.
I move to strike the last word.
Gentlelady is recognized for 5 minutes.
I strongly oppose H.R. 5535, which would restrict the federal government's ability, including that of the Federal Insurance Office, or FIO, to properly monitor financial and systemic risk in the insurance industry and the effects on the availability and affordability of insurance for underserved consumers. Skyrocketing insurance and housing costs are putting serious financial strain on both consumers and communities. The proposed repeal of FIO's subpoena power and that of the Treasury's Office of Financial Research with respect to insurance companies is a regressive step that undermines one of the federal government's only tools to monitor the industry, promote financial stability, and promote policyholders. Additionally, this bill would limit the financial regulators' ability to quickly gather information to monitor and mitigate systemic risk in the insurance industry as compared to other banks and financial institutions, creating blind spots similar to those that led to the catastrophic collapse and bailout of AIG. In 2008, as we face growing threats posed by the climate crisis and other evolving factors, such as ongoing inflation, now is not the time to weaken the federal government's tools to monitor industry trends. In certain situations, FIO's subpoena power, a last resort tool, may be essential for collecting non-public data and insights at a national level regarding growing risks and barriers to affordability in the industry, as well as to provide insight into possible solutions. For example, FIO recently announced that it is partnering with state insurance commissioners to collect data on the insurance industry's climate-related risk in accordance with President Biden's 2021 executive order on addressing the climate crisis. These efforts are crucial to mitigating the effects of climate change on the insurance industry and, by extension, on families who are required to purchase coverage and rely on it in dire circumstances. However, in the event that states or others refuse to work with FIO to collect or provide the necessary data, FIO must have the ability to collect the data it needs to carry out its mandated monitoring duties. To date, FIO has not had to use its subpoena authority, but it is a critical tool that must be preserved. So I call on my colleagues to oppose H.R. 5535, and I yield back.
Gentlelady yields back. Further discussion, further debate. Mr. Nunn from Iowa seeks recognition.
Thank you, Mr. Chairman, and appreciate your...
Gentleman is recognized for 5 minutes for purposes of debate.
Thank you, Mr. Chair. I move to strike the last words. In keeping my remarks brief, I want to express my strong support for this legislation, given my district's global position as a hub for the insurance industry. For the past 150 years, state insurance divisions like the Iowa Insurance Division have supervised the industry in a way that allows it to thrive. In fact, the insurance industry accounts for nearly 12% of Iowa's overall GDP. The success of Iowa should be something that we want to replicate at the federal level. Every state has unique and different insurance needs. For instance, just last week I was with a group of independent insurance agents in Iowa, and we discussed our state's need for a range of crop insurance to title insurance to small business insurance. The Federal Insurance Office, using subpoena power to collect data from insurance companies, is just another example of what an unelected bureaucrat overreaching their authority would serve as a detriment to folks across the country, including my home state. In Iowa, on the other hand, the focus is on growth and tailoring the system to work with the industry, not treat it as an enemy agent. The Iowa Insurance Division, not the Federal Insurance Office, has the expertise to support Iowa companies, again, at the local level. That is why I am pleased to co-sponsor Congressman Fitzgerald's Insurance Data Protection Act. I'm proud to co-sponsor this legislation, and I urge all of my colleagues on both sides of the aisle to be able to support it in its final passage. Thank you, Mr. Chair.
Will the gentleman yield? Will the gentleman yield time?
Yes.
I'd just like to pick up where the gentleman highlighted the support for Mr. Fitzgerald's bill. I, too, strongly encourage all of our colleagues to support the bill. You know, frankly, the beauty of the Bill of Rights is when you get to the 9th Amendment, it mentions that not all the rights protected in America, not all the rights a person may have been endowed by their creator with, are addressed in the United States Constitution. And when you get to the 10th Amendment, it says everything not granted to the federal government is reserved to the states. And that's one of the great things about the insurance market. It actually represents the constitutional framework that we ought to be applying to many more markets and certainly lots of regulation. So the establishment of the Federal Insurance Office, you know, automatically posed a threat to this idea. But it was given a narrow scope because in a bipartisan way, the body still agreed that it shouldn't spread out. And it's like a noxious weed. If you don't contain it, it's spreading out. And that's what they're trying to do. The people at the Federal Insurance Office are trying to spread out and grab power that they were not granted by the statute, and they should not be granted, and it shouldn't be tolerated to see them expand. So I thank Mr. Fitzgerald for offering the bill, and I do hope our colleagues enthusiastically support it. I yield back, Mr. Nunn.
Thank you, Mr. Davidson. I yield back the remainder of my time to the chair.
Gentleman yields back for the discussion, for the debate. Gentleman from Illinois, Mr. Caston.
Move to strike last word.
Gentleman is recognized for 5 minutes.
So I want to speak in opposition to the bill, and look, I know because we're talking about climate change, it's, you know, there's a split in the middle of the aisle here, but I would urge us to think about this in terms of this committee's jurisdiction and financial stability. Our jurisdiction includes insurance generally. I believe that's in our bylaws, which at least makes it clear about where our jurisdiction runs into other committees in this body. As we all know, as Mr. Davidson has pointed out, as Mr. Nunn has pointed out, a lot of insurance regulation is at the state level. This doesn't change that basic question. But the question is, should federal regulators like FIO, like Office of Financial Research, be monitoring what's going on? Because I would hope we could all agree that just because insurance is regulated at a state level doesn't mean that the impacts of an insurance failure stay cauterized within the boundaries of a state. We know that climate change doesn't really care where state borders are. We know that there are multiple insurers, home insurers, who are announcing they are going to stall or end the issuance of new policies in places like California, Louisiana, and Florida because of the risks of extreme weather events. We know there are fights in those states, in some cases driven by the climate exposure of those states, in some cases because the politics of those states find it difficult to move to a forward pricing of insurance risks, and so the insurance companies are saying as an obligation to my shareholders, I simply can't actuarially price that risk. And so they're backing out of those states. Last month, State Farm announced they wouldn't renew 72,000 policies in California. What I want to walk through here is let's just think about whether we want to be in a position where a couple of years from now, we are all exposed with a national financial panic that we knew we chose to be blind to. Florida. You got a bunch of insurers who are leaving the state of Florida for property insurance. Citizens Property Insurance, the state insurer of last resort, has more than doubled their market share since 2020. Ron DeSantis recently said in an interview, the governor, that Citizens Property Insurance is not solvent, and we can't have millions of people on that because if a storm hits, it's going to cause problems for the state and the country, I would add. Because what happens if you can't insure property in Florida? Well, if you're a bank, why would you issue a mortgage if you can't get insurance? Is the reinsurance going to be there? Well, that's kind of global. That's not just limited to state insurance. What if you can't get reinsurance? What's the smart thing to do as a bank? Well, we know that because CFTC actually said you can see in flood-prone states that the banks are offloading their mortgages onto Fannie and Freddie, AKA the taxpayer. Well, what if they can't cover that risk? Do we want to be in a position a couple years down the road where Fannie and Freddie, which are in receivership, are suddenly bleeding in cash and we're trying to figure out what's the politics between dealing with long-term structural deficits and trying to offload this thing that's bleeding cash? Now, I'm not being doom and gloom. Those are real possibilities because climate change doesn't care where state borders are and fiscal solvency is not limited. The risks of insurance are not limited there. So again, this is not about making some violation of the 9th and 10th Amendments. This is saying, should our federal regulators be monitoring that risk so we can see what's coming? Because if you go through the Florida example, if you can't get property insurance in Florida, and therefore that triggers that you can't get a mortgage, and therefore that triggers that that's a dumb place to own property, what happens to the Florida economy? What happens if you have people starting to say, I just can't put money in Florida because that's not a safe place, I can't insure my losses? If you are a Florida regulator under the jurisdiction of a Florida government who is a part in this, is it in your interest to disclose that risk or to hope people won't know it? And so I think like so many of the things on this committee, the question is simply, there are people who make money by selling a high-risk product to somebody who doesn't understand the risk. There ain't nothing wrong with that. But it's also not a good way to manage risk in our society. So if we were to pass this bill into law, the practical effect would be to make our financial regulators dumber, to expose us to systemic financial risks in our economy, and every one of us who voted for this bill would be accountable for that outcome. I don't want to be accountable. I don't think anybody wants to be accountable for that outcome, and I encourage a no vote.
Gentleman yield.
I think I'm out of time. I yield back, Mr. Chair.
Gentleman yields back. Further discussion, further debate.
Mr. Chairman, I have an amendment at the desk.
Gentlelady has an amendment. Desk. We'll pause while the amendment's distributed. Do we need it? Where's Katrina? Thank you. Do all members have a copy? Who wish to have a copy? The clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 5535, offered by Mrs. Beatty of Ohio.
Without objection, the amendment is considered as read. The gentlewoman is recognized on her amendment.
Thank you, Mr. Chairman. Among other provisions, H.R. 5535, the Insurance Data Protection Act, would eliminate the authority of Treasury's Federal Insurance Office, FIO, to subpoena insurance companies and otherwise collect data to monitor the industry. This provision completely removes one of the few critical tools that FIO has to collect information necessary for it to do its congressionally mandated job. Because FIO does not regulate the insurance industry, and given the potential limitations of data sharing between the states and the federal government, FIO subpoena power can be crucial to the federal government's ability to monitor potential financial risks, to safeguard consumers' financial well-being, and to prevent illicit activity and threats to our national security. My amendment would allow FIO to subpoena insurance information if the Treasury Secretary deems it necessary for national security interests, including as it relates to ghost ships carrying illicit oil. It is essential to preserve the federal government's ability to monitor certain national security concerns through insurance information. For example, just a few months ago in November, the committee unanimously passed the ranking member's bill, H.R. 6365, the Shipping Illicit Oil Shipments Act of 2023 out of markup. This bill recognizes the importance of insurance information in order to identify and stop illicit activities. Turning around and marking up today's bill just months later to hamstring FIO and impede federal-level efforts to address certain national security risks is counterintuitive and counterproductive. So I urge my colleagues to support this amendment, and I yield back. Thank you, Mr.
Gentlelady yields back. Is there further discussion, further debate? Gentleman from Wisconsin, Mr. Fitzgerald, is recognized.
Thank you, Chairman. Move to strike the last word.
Gentleman's recognized for 5 minutes.
So state regulators are obviously perfectly capable of working with FIO, in a timely manner when the insurance office is willing to work collaboratively, which I think they would. I don't know why they wouldn't on a security issue. So I don't think the security exemption, which is something that we had contemplated before the amendment was offered, it once again, I think, makes all the consumer information somewhat vulnerable in this process. The bill would prescribe the treatment of data collected by financial regulators from an insurance company, including the confidentiality procedures and agency disclosure requirements. Additionally, the bill declares that sharing of any non-publicly available data with or by the office among other federal agencies, and once again, your state insurance regulators, and anyone that they work with, or any entity that does not affect any federal or state confidentiality privilege, which could arise under federal or state law to which such data or information is otherwise subject. So I think that the amendment is not needed, and certainly I think if there was some type of leverage or some type of back and forth, which is what I think this is all about, which, earlier maybe my comments were more focused on climate change than they should have been, because there's any gambit of other issues, I think, that kind of fall to this category of should we be doing these massive data orders. So once again, I don't think that the amendment is necessary, and I would hope the members would not support it. I yield back.
Gentleman yields back. Is there further discussion, further debate on the amendment? Further discussion, further debate. If there is no further discussion, further debate, does the ranking member seek recognition on the amendment?
I move to strike the last word. I support this amendment.
Gentlelady is recognized for 5 minutes.
I support this amendment that would empower FIO to leverage subpoena authorities when deemed essential by the Treasury Secretary for the purpose of national security. As our committee well knows, insurance can be a crucial lever to stop an illicit activity and safeguard our nation. Take the issue of ghost ships that smuggle illicit oil from Iran and Russia to China, for instance. These aren't mere maritime tales. These are real threats. using the shadows of international waters to finance activities that jeopardize our security. The FIO's role in monitoring financial transactions and insurance activities can bolster our defense against such clandestine operations. By allowing the FIO to act swiftly and decisively, we're not just reacting, we're proactively disrupting the financial networks that underpin these illicit activities. This amendment ensures that when it comes to protecting our shores, our economy, and our people, the FIO has the necessary tools at its disposal. And so I urge my colleagues to support this amendment. I yield back.
Gentleman yields back. Further discussion, further debate on the amendment? No further discussion. The question now occurs on the amendment offered by the gentlewoman from Ohio, Mrs. Beatty. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. In the opinion of the chair, the nays have it.
Request a recorded vote.
The ranking member requests a recorded vote. Recorded vote is requested. All those in favor of recorded vote, please raise your hand. A sufficient number having raised their hands, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the Rules Committee. Further proceedings on the amendment are postponed. Is there further discussion or debate? There being no further amendments, without objection, the previous question is ordered and recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. We'll now turn to Mr. Loudermilk. Pursuant to notice, I call up H.R. 802, the Respect State Housing Laws Act, introduced by the gentleman from Georgia, Mr. Loudermilk. The clerk will report the bill, which was distributed in advance.
H.R. 802, to amend the CARES Act to remove a requirement on leasers to provide notice to vacate and for other purposes.
Without objection, the bill is considered as read and open to amendment at any point. The gentleman from Georgia has an amendment in the nature of a substitute. The gentleman from Georgia has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 802, offered by
Without objection, the amendment is considered as read.
Object to treating the ANS as bank states. I'm not so sure that I'm saying it here.
And the ranking member objects to serving the ANS serving as base tax for purposes of amendment. The ANS will be treated as a first-degree amendment. On behalf of Mr. Loudermilk, Mr. Davidson is offering the amendment. He'll now be recognized for 5 minutes to explain the bill and the ANS. I'm sorry, will be recognized on debate of the ANS.
I thank the chairman, and I thank Mr. Loudermilk for carrying the work on this important legislation. The amendment here is very straightforward. It simply clarifies that Section 4024 of the CARES Act is amended by striking subsection C. And that subsection C is important because it abrogates state laws. It imposes a federal, standard on what is often even a local matter, not even always a state matter. And we need to undo that with respect to housing and appraisals. And I think this bill corrects a problem. I enthusiastically support it, and I encourage all our colleagues to do the same. I yield back.
Is there further discussion, further debate?
I move to strike the last word.
Ranking member is recognized for 5 minutes.
I strongly oppose H.R. 802, a bill that threatens to deepen our nation's homelessness crisis by stripping away renters' protections and increasing evictions. Let's not forget, it was the collective effort of committee Democrats and Republicans through the CARES Act that introduced unprecedented housing protections, including the first ever federal eviction and foreclosure moratorium, forbearance relief, and critically, a permanent 30-day eviction notice requirement. But now, Republicans are claiming that the permanent nature of the 30-day eviction notice requirement was a mistake. The CARES Act 30-day eviction notice requirement continues to provide a lifeline for countless families during one of the nation's worst housing crises, made worse by the pandemic. Yet, Republicans are inexplicably trying to take this crucial tenant protection away. I fail to see the difference between a person who lost their job because their employer was negatively impacted by the pandemic and a person who loses their job today because their employee is downsizing as a result of the economy. Through the CARES Act and the American Rescue Plan Act, we kept over 12 million people stably housed and helped offset a recession. Congress intentionally applied this bipartisan requirement on a permanent basis, and it thanks to this policy approach that eviction rates are lower than they otherwise might be. In fact, the Department of Housing and Urban Development estimates that a 30-day notice for non-payment of rent helps reduce evictions by between 1,600 and 4,900 annually. These aren't just numbers, they represent families, children, and individuals who, because of this notice, can better avoid the risk of experiencing homelessness. Moreover, research has shown a direct correlation between eviction filings and increased rates of sheltered homelessness. By providing tenants with adequate notice and clear information on the reasons for eviction, we're not just adhering to a legal requirement, we're investing in community stability and preventing a proven spiral into homelessness. Furthermore, this 30-day notice requirement is consistent with Biden administration's blueprint for a Renters' Bill of Rights, emphasizing our nation's commitment to protecting renters and promoting fairness in the housing market. Representative Loudermilk's bill would be better titled the Evict America's Renters Act of 2023. Eliminating eviction notice requirements undermines the modest progress we've made in addressing homelessness and housing insecurity. It disregards the evidence showing the effectiveness of such measures in preventing evictions and cascading effects of homelessness. As we continue to confront the challenges of homelessness and housing instability, let's focus on policies that build on the successes of the CARES Act. Let's commit to measures that protect tenants, promote housing stability, and contribute to the broader goal of ending homelessness. In opposing this bill, we reaffirm our commitment to a more humane, equitable approach to housing, one that recognizes the right of every individual to have a safe and stable place to call home. If I may, I'd like to engage the gentleman, the sponsor of this bill, in a colloquy for a minute or so. Mr. Loudermilk?
Respectfully, I just literally walked in, and so I'd like a few minutes, not quite prepared to do a colloquy. I'll make some remarks after strike the last word.
So what? Oh. Okay.
The gentleman says he's not prepared for a colloquy at the moment, and if the ranking member, I'll seek recognition at some later point so you all can engage in a colloquy.
Thank you very much.
Okay.
I yield back.
Gentlelady yields back. Gentleman from Georgia,
Move strike
the
last word.
sponsor of the bill, is recognized for 5 minutes for the purpose of debate.
Thank you, Mr. Chairman. I apologize for just walking in. I'm in the process of chairing another committee that is going on simultaneously. So, in March 2020, Congress faced an unexpected challenge. The COVID-19 virus was sweeping through the country. To stem the spread of infections, federal, state, and local governments implemented stay-at-home orders and shuttered businesses nationwide. At the time, Congress worried that nationwide government mandate shutdowns would shutter businesses and leave countless American families without a source of income to meet their existing financial obligations. Congress was equally concerned that a rapid rise in delinquent rental payments would lead to widespread eviction and mass displacement. On March 27, Congress responded to this concern with Section 4024 of the CARES Act. Section 4024B of the CARES Act imposed nationwide moratorium on evictions from federally supported housing for 120 days. At the time, a nationwide eviction moratorium was an unprecedented exercise of federal authority over housing. The 120-day timeline reassured property owners that this federal intervention was a temporary response to the unprecedented threat of COVID-19. Congress made no substantial effort to extend the moratorium beyond the period in statute because it was never intended to be permanent. In 2021, the Biden administration acted to extend the moratorium under a separate authority, but this extension was later overturned by the Supreme Court. While Section 4024B expired as intended, Section 4024C contained no explicit sunset. 4024C provided that eviction proceedings could not begin until 30 days after a tenant had been given notice to vacate. 4024C was crafted to protect tenants from immediate eviction for non-payment during the moratorium. Its purpose was directly related to the moratorium and was not intended to become a permanent fixture of law. The ambiguous language of the original law and the lack of a clear sunset period have led some to believe that Congress intended to permanently usurp state notice to vacate laws. H.R. 802 would strike Section 4024C, eliminating any ambiguity in the law that remains today. Before my colleagues assert that this bill would make it easier to evict non-paying tenants from public housing, let me be clear. Prior to the CARES Act, HUD had its own notice to vacate requirements for different types of public housing. My bill would not affect requirements that were in statute or regulation prior to the CARES Act. It would simply clarify and execute Congress's intent for the original provision and resolve the ambiguity it has created. Property owners across the country demand this clarity, and lack of congressional action will affect participation in the various covered programs due to the risk that tenants may remain on the property without payment for a prolonged period. That is why my bill is supported by a broad coalition in the residential real estate sector. Without objection, I'd like to insert their letters of support.
Without objection.
Thank you, Mr. Chairman. Prolonged occupation with non-payment presents particular risks to retirees and military service members. A property manager recently shared this story with my office. In 2022, they were managing a rental owned by an 86-year-old widow. The widow decided to move out of her 30-year family home to a smaller apartment and use the monthly rental income from her home to rent a smaller apartment. When the tenants fell behind on rent, the widow nearly lost her own apartment. Despite good faith efforts to assist the tenants by allowing them to make partial payments, the tenant decided not to pay at all and continued to occupy the home for another 3 months without payment due to Section 4024C and delays in the local court. The widow lost her apartment and ended up staying in a homeless shelter. To make matters worse, once the eviction was finalized and the property manager was able to survey the home, they found that the tenants had caused thousands of dollars of damage to the property. The widow was forced to move back into her now vandalized home to avoid homelessness and passed away shortly thereafter. This is just one of the hundreds of stories we've heard since introducing H.R. 802. There are countless others just like this, where delays in evictions caused immeasurable suffering for property owners who depend on rental income to support themselves in retirement. I've heard stories from service members stationed overseas, retirees, and young families looking to jumpstart their financial future only to end up underwater due to non-paying tenants. The effects of Section 4024C aren't just limited to large property managers or real estate investors. The confusion this section has created is a threat to the financial security of families in every one of our districts. Finally, striking Section 4024C eliminates jurisdictional uncertainty. Last year, HUD argued that tenancy law is a patchwork across states and in need of unifying federal framework. However, subjecting properties with a federal nexus to requirements that differ from local law creates the very same patchwork the HUD claims to want to address. There is no need for further federal regulation when, in fact, it would create the very same problem it was supposed to address. Thank you, Mr. Chairman, and I yield back.
Gentleman's time's expired. Further discussion, further debate on
I have an
the
amendment
bill.
at the desk.
We're further discussion on the debate on the bill. The gentleman from South Carolina, Mr. Norman, is recognized.
Thank you, Mr. Chairman. I move to strike the last word.
Gentleman's recognized for 5 minutes.
You know, this legislation sponsored by Mr. Loudermilk is very important. This was not meant to be a permanent extension where you basically couldn't even, if someone didn't pay, you had 4 months then an additional extra month. And the long-term effects of this, if you want to stop any new building of apartments at even affordable housing or any construction, this does it. To keep this in place where you can't pay your bills when you build these units is unsustainable. It would lead to, if we don't pass this legislation, this bill out of committee, it would lead to delinquencies by the owners and the builders of the complex. The maintenance would basically stop because you've got, on units like this, you've got extensive maintenance requirements that you have to do on a monthly basis. So this is very important to pass this, and I applaud Representative Loudermilk for putting this forward. I yield back.
Gentleman yields back. Further discussion, further debate. The ranking member is recognized for purposes of offering her amendment. Sorry. Oh, I'm sorry.
They're going to distribute the amendment.
I move to strike the last word. I now recognize myself for 5 minutes. There's an interest by the ranking member in having a colloquy with the bill sponsor, Mr. Loudermilk. Gentleman, Mr. Loudermilk is willing.
Yes.
The ranking member is still interested. I'll yield to the ranking member.
Well, thank you very much. I appreciate, Mr. Chairman. I have to tell you that I'm deeply disturbed about an attempt to eliminate simply a 30-day notice before evicting tenants. And I'm just wondering, Mr. Loudermilk, you have an alternative?
If you yield, ranking member yield.
I yield.
Were you comfortable with the way that the law was prior to the CARES Act? This just takes us back to where we were prior to that by eliminating ambiguity in the law that trial lawyers have been using to undercut the authority of local governments, and it is creating a patchwork that is what we claim that we want to eliminate. So if you were comfortable with the way things were prior to the CARES Act, this is just taking us back to where the local governments have the ability to determine
Reclaiming
when the
my
evictions go.
time. Yes.
No, it's gentleman's time. It's my time.
All right,
And
thank
I'll yield to the ranking member.
Thank you very much. We learned an awful lot during the pandemic and the crisis. And we know that there were evictions that were taking place that put families at real risk and harm. Now we know, because we went through the pandemic, how terrible it was. And we know we have a housing crisis now. We have a housing crisis now where we don't have enough affordable units, where we don't have the support that we necessarily had during the pandemic. And so, given that we have this housing crisis, homelessness is basically growing everywhere. In my own county, we have over 70,000 people on the street every night. In this country, it's over 650,000 people who are on the street. Given that, don't we see that we could help keep families from being on the street, on the sidewalks, in tents, and children sleeping in cars, trying to go to school every day? Don't we have enough compassion by which we would say, okay, 30 days is reasonable before you evict? I yield to the gentleman.
Well, if I may reclaim my time, it was a Democrat majority in the House that did not extend the eviction moratorium. What is left from the CARES Act is this provision. The CARES Act was thought of as temporary, targeted, and related to COVID. What the gentleman's bill does is remove this federalization of housing rules on this notice of an eviction. Each state and many localities have specific rules on how to evict. And California's standards and Georgia's standards are different, and they're different than North Carolina's. I would like to have North Carolinians writing that process for my constituents rather than it being federalized. And so a 30-day notification does not prevent homelessness. It does not make housing more affordable. And in fact, slows down the process by which you get paying folks into housing. By having a cumbersome notification federalized process, it makes housing less available and more expensive in a marginal way, but still, we're actually running on the side of making housing less economical for folks to own or to rent by having by having rules in place by which those that aren't paying get to stay in housing, and make it more difficult for mom and pops to rent out their basement apartment here on Capitol Hill, or for folks to keep owning the home that they grew up in and maybe want to return to, but rent for a temporary period of time. So I appreciate the gentleman offering this bill. I think it is a targeted bill. It does not get into the greater question of housing and housing affordability, but it is about notice and whether or not we want to federalize this question of
The
notice.
gentleman will yield.
Happy to yield, again.
I want you to know, in fact, the Department of Housing and Urban Development estimates that a 30-day notice for non-payment of rent helps reduce evictions by between 1,600 and 4,900 annually. These aren't just numbers. They represent families, children, and individuals who, because of this notice, can better avoid the risk of experiencing homelessness.
My time has expired. In a nation of 300 million people, that is small ball. This is a targeted bill. And with that, my time has long since expired.
Chairman?
The gentlelady from New York seeks recognition.
Seeks recognition.
Yeah. Thank you, Mr. Chairman.
Gentlelady is recognized for 5 minutes for purposes of debate.
Thank you. Republicans supported minimum eviction notice requirements during the pandemic that helped millions of families who were on the brink of homelessness through no fault of their own. But millions of families are still on the brink of homelessness today. In fact, in New York, we have 90,578 people right now, while other provisions in the CARES Act have explicit sunsets or expiration dates. This provision does not. And HUD, FHA, FA, and the CFPB will have all issue guidance or notice affirming that this provision is still in effect, protecting renters who continue to face housing inflation and ongoing economic fallout from the pandemic. This bill would lead to more evictions and increased homelessness. 30 days eviction notices that help reduce eviction, promote housing stability, and offset homelessness by providing renters with adequate notice and information about the reason for eviction. The provision of 30 days written notice of eviction not only provides tenants with additional time to avoid eviction, but also reduces the time and cost burdens on landlords and PHAs that are associated with evictions. Mr. Chairman, I reject and I will oppose this ill-conceived legislation. This is not about numbers. This is about people. This is about families. This is about children. And I concur with the ranking member. Don't we have some sense of humanity? Thank you. I yield back.
The lady yields back for the discussion, for the debate.
I have an amendment at the desk.
Gentlelady has an amendment at the desk. We'll pause while the amendment's distributed. Have all members received a copy of the amendment? Without objection, the clerk will report the amendment.
Amendment to the amendment in the nature of a substitute to H.R. 802.
Without objection, the amendment is considered as read. The gentlewoman from California is recognized on her amendment.
Thank you. In the midst of a deepening affordable housing and homelessness crisis, it's alarming that Republicans are moving this bill that would cause a new wave of evictions and worsen the plight of families who are just trying to keep their heads above water as housing inflation continues to rise and Republican inaction on housing persists. In case it was unclear, when committee Democrats called on Republicans to do more on housing, we meant to do more to reduce homelessness and get people into fair and affordable housing, not to evict more people more quickly. I'm appalled that the little attention Republicans have paid to housing is focused on such detrimental policies that would only exacerbate the existing housing and homelessness crisis. So my amendment would strike the text of this bill and instead reaffirm that the eviction notice requirement in the CARES Act is in fact a permanent provision. I just want you to know that when it was described by the chair of the committee that this had nothing to do with homelessness, in essence, that this just was repealing what happened in the CARES Act. You can't separate that. You can't say that, you know, the fact that we once had a 30-day eviction requirement, and because of the CARES Act, that's the only reason that we had it. And now that the pandemic is over, the CARES Act has to be repealed. It doesn't make good sense. Let's champion policies that uplift and support rather than put our most vulnerable populations at greater risk or further hardship. You know, we have homelessness all over this country, not just in urban areas, not just in suburban areas, in rural areas, all over this country. We're stepping over people in makeshift tents when the rains are coming and the cold weather has taken place. How could we, in good faith, not have enough compassion to give people a 30-day notice? You know what happens? They have time to look for alternative housing. They have time to say to their relatives, could I stay with you temporarily? They have time to find out what's being offered by the church or other nonprofit organizations. But if they don't have at least a 30-day notice, they're out on the street with all of their belongings on the street, with the children being embarrassed that they've got to step over their own property to get to school. How can you do this? This is disturbing. And I don't think that your constituents, I don't care how conservative you say they are, I don't care how you're saying they don't know about this, I don't believe they would support this. And I don't believe that all members on the opposite side of the aisle believe that we should repeal a simple 30-day notice. We're not asking for a year. We're not asking for 2 years. We're not asking for a long period of time. But you mean to tell me you don't have the compassion for 30 days? You break my heart. I yield back.
All right. The ranking member yields back. I'll now move to strike the last word. I oppose the amendment. Don't wish to break the ranking member's heart on this or anything else. Okay. Nor do I want to risk the ranking member's ire by going further. So, well, I dug myself in this hole. So anyway, I disagree with the ranking member on this policy. The issue at hand here is provisions of the CARES Act that still remain in the federal code. It's important for this committee to clean up language from the CARES Act that was intended Temporary. Every state in the nation has an eviction process. In my home state of North Carolina, we have a judicial process that gives tenants rights, and it has to go before the court for an eviction to take hold. That is a process distinct from other states in the nation, but many have the same process, a judicial review process. And I know of no state in the nation that has an eviction process faster than 30 days. And so this is a redundant piece of federal code that is not necessary. It was intended to be temporary, as was all of the CARES Act. It's important that Congress clean up the federal code when we are able. Let's return this back to the states where they can best do this and are most nimbly prepared for this. And they have a court system that can hear both sides, both for the tenant and the landlord, in an eviction process, or the mortgagor and the mortgagee in that process. Federal courts are not equipped to deal with this, and federal regulation is not equipped
Will
to
the
deal with this.
gentleman yield?
Happy to yield.
Mr. Chairman, do you believe that there is even no room for negotiation on this issue? When you talk about what happens in the states, I have to tell you that human beings are human beings no matter what state they live in. Children are children no matter what state they live in. Any laws, rules, or regulations that would simply deny a 30-day notice on eviction is unacceptable. I don't care whether it's in Georgia or Mississippi or Alabama or California, anyplace else. It's unacceptable. And what you are basically saying to us is, if a state decides that their rules are substantially different and that not only do they not have a 30-day notice, they don't have a one-day notice. They don't have
If the
anything.
gentleman will yield.
And so,
The gentlelady will
yes,
yield.
I
What state
yield.
is that? What is the
Real
state?
back.
What states have no notice? I know of no state in the nation that has no notice. I know no territory. Certainly in the District of Columbia, they are far more generous to tenants than a 30-day notice. So the point here is the discussions we had, sitting in the same, I was sitting in your seat, you were sitting in my seat, about the CARES Act. Temporary, targeted, related to COVID. This is about getting rid of and rescinding COVID-era law that is not applicable now. Every state in the nation is more generous to tenants than a federal 30-day notification, number one. Number two, if you want recourse under federal law, you've got to go to the federal courts. The federal courts don't have capacity to do this. State courts do. This is best left up to the states. And so with that, I oppose the amendment and yield back the balance of my time. Is there further discussion, further debate? No further discussion, no further debate. The question now occurs on the amendment offered by the gentlewoman from California, the ranking member, Mrs. Waters. All those in favor of the amendment shall signify by saying aye. All those opposed shall signify by saying nay.
Speaker,
In the
Mr.
opinion of the
Chairman, I
chair, the
request a
ayes
point of
have
order.
it. And there's a request for a recorded vote. Those that wish to have a recorded vote, please raise your hands. A sufficient number having raised their hand. Pursuant to pursuant to subsection C5 of Rule 3 of the Committee Rules, further proceedings on the amendment are postponed. Is there further discussion, further debate, further amendment?
Point of order, Mr. Chairman. Did the noes have it?
Oh, thank you for catching my mumbling. Yeah, the noes had it. We'll be voting on that. There's a request for roll call.
What did you just do? I requested a recorded vote.
The ranking member requested a recorded vote, and we'll have a recorded vote on the amendment. All right, there being no further discussion, further amendment, without objection, the previous questions are ordered. Recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to to report the measure. We'll now turn to, pursuant to notice, I call up H.R. 7437, the Fostering the Use of Technology to Uphold Regulatory Effectiveness, or Futures in Supervision Act, introduced by the gentlewoman from Indiana, Mrs. Houchin. The clerk will report the bill, which was distributed in advance.
H.R. 7437, to require certain supervisory agencies to assess...
Without objection, the bill is considered read and open to amendment at any point. The gentlewoman from Indiana has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute...
Without objection, the amendment is considered as read. And without objection, it will serve as base text. There is objection to it serving as base text for purposes of amendment. The ANS will be treated as a first-degree amendment. The gentlewoman from Indiana, Mrs. Houchin, is recognized for 5 minutes.
Thank you, Mr. Chairman. First, I ask for unanimous consent to submit 3 letters to the record in support of my bill, H.R. 7437.
Without objection.
Thank you. These letters are from the American Bankers Association, the Alliance for Innovation Regulation, and organizations that work with AIR. The financial industry is rapidly evolving with technological advancements, yet regulatory agencies lag with outdated IT infrastructure from a pre-digital era. The widening gap in technology adoption between financial markets and regulatory oversight poses significant risks. While regulators may have the tools needed to address these issues, these developments may make it so that the regulators are too slow to recognize and address problems before it becomes too late. Recognizing the urgent need for modernization, I'm proud to introduce the Fostering the Use of Technology to Uphold Regulatory Effectiveness in Supervision Act, or the Futures Act, alongside Representatives Foster, Hill, and Pedersen. This bipartisan bill would require the Federal Reserve, the FDIC, OCC, CFPB, and NCUA to conduct assessments of their supervisory technologies and procurement practices and report their findings to Congress annually for 5 years. By addressing the challenges of talent acquisition, workforce education, and technological adoption barriers, the Futures Act aims to enhance regulatory effectiveness and reduce burdens on financial institutions and consumers alike. According to a GAO report from last September, financial regulators reported they use supervisory technologies for data collection, processing, storage, and analytics. GAO found that each regulator had at least one strategic objective focused on improving supervision with technology. This is an objective that everyone should applaud. As the agencies evaluate how to improve on their missions, we need to ensure that unnecessary red tape does not hurt their initiatives. With the rapid changes we've seen in technology in recent years throughout the financial services sector, the technology being used by our supervisory agencies needs to keep pace in order to address potential systemic risks. Potential hurdles need to be presented to Congress directly, so we know where the pain points are and can evaluate how to support our own regulators. The Futures Act provides a framework to facilitate a constructive dialogue between the regulators and Congress. I urge my colleagues to support this bipartisan bill, and I yield back.
Gentlelady yields back. Further discussion, further debate. Gentleman from Illinois, Mr. Foster, seeks recognition.
Thank you, Mr. Chairman. I'd like to thank Representative Houchin.
Gentleman is recognized for 5 minutes.
I'd like to thank Representative Houchin for her leadership on this bill. I'd also like to thank Congressman Hill and Congresswoman Pedersen for supporting this effort to ensure that our financial regulators are well equipped for the 21st century. The Futures Act will require federal banking regulators and the CFPB to regularly review their technological systems and procurement practices to ensure that they're all well equipped to address emerging threats to our financial system. Regulators will then submit a report to Congress identifying any degraded systems or procurement processes that are inhibiting their ability to supervise modern financial institutions. As we saw with the collapse of regional banks last spring, 24-hour banking tools and social media-fueled panic can intensify bank runs and increase the risk of contagion. Silicon Valley Bank's depositors attempted to withdraw $42 billion from the bank in 24 hours, with more than $100 billion in additional withdrawals requested before it was shut down and put into receivership by the FDIC. Financial institutions and regulators must also be ready to respond to new opportunities and challenges stemming from emerging technologies. Artificial intelligence has the potential to supercharge cybersecurity risk, contagion, and fraud, which can put our financial system at risk. At the same time, these technologies present tools for regulators and financial institutions for them to use to improve bank supervision, identify suspicious activity, and improve the quality of customer service. This legislation will encourage regulators to review their technology systems and ensure that they are ready to meet the challenges of the day, shedding light on new tools that will improve their ability to oversee rapidly changing financial systems. And finally, the regulators have a number of problems to address. This won't address all of them. But in the area of the need to use state-of-the-art technology to do the best job they can for the people they're trying to protect, I think there is good reason for bipartisan support for this. It's a common sense bill, and I encourage my colleagues to vote yes. Yield back.
Gentleman yields back. Further discussion, further debate. The ranking member is recognized for 5 minutes for purposes of debate.
Move to strike the last word. This bill requires federal banking agencies to assess vulnerabilities in the supervisory technology they use and to provide a report to Congress on procurement processes and contracts. This legislation represents a state in the right direction by allowing us to gain an understanding of the technological vulnerabilities our banking regulators may face. This also highlights the importance of our agencies modernizing their efforts in light of the evolving technological capacities in the financial services industry. And I want to thank the sponsor and Chair McHenry for working with me and my staff to strengthen the bill. I do appreciate the cooperation that we have enjoyed on this subject matter. However, there's still a few areas that could further be improved. I hope to work with Representative Houchin and Chair McHenry as this bill moves forward, ensuring the report required by this bill also covers changing procurement practices, hiring, diversity, and contracting. And while we didn't have the opportunity to delve into this aspect of my concerns, I want you to know that procurement and contracting emerges as an important area to pay attention to. We talk about closing the wealth gap. Part of closing that wealth gap has to do with the ability for women, people of color, minorities, etc., to have access to the possibilities of being able to contract with government at every level, and particularly the federal level. As you know, I am the author of the subcommittee's diversity and inclusion on this committee. And while when we lost control, the opposite side was not willing to continue to have a subcommittee on diversity and inclusion. I want to tell you that our efforts on diversity and inclusion to open up opportunities that have not been available to some people in this society keeps that wealth gap from closing. And I want you to know, as I have examined very closely certain procurement processes, I'm still absolutely alarmed and appalled at the obstacles that are placed in front of women and minorities to be able to participate in these procurement opportunities of their government. It still seems to have the old boys club working. And even though they say that there are requests for response to proposals, what we find is those with extraordinary resources are able not only to have input in what those proposals should be, but then they respond to them with sophisticated responses using all of the resources that are necessary to have the best absolute proposal because of the money that they put into it. And those who are emerging, who are trying to participate in procurement opportunities cannot match those resources, and that they're left out. We were not able to get into all of this at this time, but this is my notice to you that this is an issue, and these are issues that must be addressed. And you're going to hear from me, and you're going to hear from others ad nauseum. And I want you to know that we are intent on closing this wealth gap, opening up opportunities that have not been available. When we take back the House, we will have another subcommittee on diversity and inclusion that will begin to get at this. And so I would appreciate your thinking about it. I would appreciate your asking me questions about it. I would appreciate your just giving the whole idea some consideration. I want you to think about this subject in ways that you know that we have to pay a lot of attention to it. With that, I yield back the balance of my time.
Gentlelady yields back the balance of her time. Is there further debate on the ANS or are there amendments?
I have an amendment at the desk.
Ranking member has an amendment at the desk. We'll pause while the amendment is distributed.
Where's the amendment?
Do all members have a copy of the amendment? Clerk will report the amendment.
Amendment to the amendment in nature of a substitute to H.R. 7437, offered by Ms.
Without
Waters.
objection, the amendment is considered as read. The gentlewoman from California is recognized on her amendment.
Thank you very much. Just a few moments ago, when I spoke about the lack of procurement opportunities and closing the wealth gap and diversity and inclusion and all of that, I said you would be hearing about this subject ad nauseum, and so I have this amendment. While this bill is a step in the right direction, there are missed opportunities in the legislation to gain critical data points in agencies' diversity and inclusion efforts in several important areas, as well as assessing risk in agencies' integration of new technology systems. For one, although this bill directs agencies to prepare an assessment of procurement practices, there is no consideration of diversity in procurement or hiring. We know that improving procurement quality through supplier diversity is critical, and working with minority business enterprises can be extremely beneficial to stakeholders, competition, and innovation. And though my proposed amendment, through this amendment, we could gain critical data to artificial intelligence and tech-specific procurement practices and their engagement with diverse-owned enterprises and businesses. So I hope to work alongside Representative Houchin and Chair McHenry to incorporate language on diversity and inclusion. So this amendment would also ensure that federal banking agencies complete a full risk assessment of risk proposed through the integration of new technologies, including those associated with third-party vendors. Proponents of AI have pointed to the efficiencies possible when using AI, which assist our regulators. However, there's still concerns about adverse outcomes arising from the use of AI. This amendment directs agencies to continue to innovate responsibility. So I urge members to support this amendment, and I yield back.
Gentlelady yields back. Is there further discussion on the amendment? Gentlelady from Indiana, Ms. Houchin, is recognized to debate this amendment.
Mr. Chairman, I move to strike the last word.
Gentlelady is recognized.
I thank the ranking member for working with the chairman and the committee on improvements to the bill. I am a former certified women-owned business owner, and I also was a member of the Commission for Supplier Diversity as a member of the Indiana State Senate, so I certainly understand what the ranking member is hoping to do. However, the goal of the Futures Act is to better understand regulators' strengths and vulnerabilities as it relates to their technology procurement abilities and real-time supervisory capabilities. I do have concerns that the amendment unnecessarily expands the scope of the legislation and could detract from the ultimate goal of the bill. Regulators' focus should be on evaluating their technology abilities and supervisory capabilities. In addition, however, the General Services Administration is already actively working to advance equity and supplier diversity in federal procurement. In April of 2022, the GSA announced steps they were taking to help small disadvantaged businesses obtain and maintain government contracts, including establishing a supplier diversity plan. Because of this, I urge my colleagues to vote against the amendment, and I yield back.
Gentlelady yields back. Gentlelady from Ohio, Mrs. Beatty is recognized for 5 minutes.
Move to strike the last.
Gentlelady is recognized.
Thank you, Mr. Chairman. I simply want to go on record thanking Ranking Member Waters for her comments and for her great leadership in the 117th Congress. As you certainly know, Mr. Chairman, that we had the Diversity and Inclusion Subcommittee. Certainly, as you know, you made a commitment that we would, during this Congress, deal with diversity and inclusion. And to the sponsor of this bill, let me just say thank you. Maybe we have more in common than I knew. I also, for more than 2 decades, served as a small business owner, and also for the state of Ohio, was very active with the minority supplier and procurement process. Certainly, as you know, in stating your participation for that, that there would be no harm in us including Congresswoman Waters' amendment into this bill, a bill that I think we could all agree on. We could make history here, certainly as women, as you mentioned, being a female small business owner. So I guess I want to say to the sponsor, is there any consideration to Congresswoman Waters' amendment that we can look at doing? I'm looking through some of our notes, and I'm sure our 2 states are not that far apart in the mission and the goals of minority supplier development, which was hugely for women, Black, brown, and white women, accomplished a lot through the DE&I program. So I guess I wanted to pose that to the sponsor, that we could be on the right side of history. We could also be helping your chairman, who said in this committee, he assured us in his opening statement as the chair that we would deal with DE&I. So that is something I'd like to put up for consideration, and again, thank Ranking Member Waters.
Will the gentlelady yield?
Absolutely.
Ms. Beatty, you chaired the subcommittee on diversity and inclusion in this committee. And I know of much of the work that you did, and I know about many of the discoveries that you learned about, but you also learned that there was willingness to cooperate and to learn. Mm-hmm. And some of our executives at the highest level were very appreciative for the assistance that you were able to provide to them in making sure that they created opportunities that had not been available in their business. Would you comment on the kind of responses you were getting?
Absolutely, and thank you, Congresswoman Waters. What we were able to hear, and keep in mind, we practice diversity in every sense of the way. We brought in people of all races, all ethnicities. We brought in some of the highest CEOs in financial institutions, insurances, and across the board, we heard those individuals, and most of them were majority folks, who said to us, it moved the needle. It made a difference on the outcome. It was good for their business. It brought diversity of thought. We had a Republican to say, is it going to include rural areas? We did a whole hearing on that. And let me also say, then Ranking Member Ann Wagner even did an opening statement that said this was valuable. And that's what we heard throughout. Even people who might have started out being in opposition to this found out when they looked at their data and their numbers that Congresswoman Waters insisted that they do. And what was so amazing to the author of this bill, they came in and brought the data when people did not think they would. And the data showed that after our DE&I committee, that they were more committed to making a difference. We saw women, in particularly, advance to higher positions. We saw them in the boardroom. We saw them in the corporate C-suites, and we had never seen that before. But at the end of the day, it was the productivity that made a difference. So I am asking the sponsor of this bill, will she give any consideration? I yield to the sponsor for a response.
Yield to the sponsor.
Thank you. I think what I would suggest, when I was a member of the Commission on Supplier Diversity, there were things that we did that were
Gentlelady's time's expired.
Was that a yes or a no? Would I be able to get that, Mr. Chairman? Was she getting ready to say yes, she would do some consideration? Can I just get a yes or no?
The gentlelady's time has expired. There's plenty of members that can seek recognition on it. There are others in the queue.
Thank you.
But we're gonna have a long day. I can go here as long as possible. I have somebody who can sit in the chair while I take a restroom break. Happy to be here all night. We'll order pizzas. Maybe they're bipartisan pizzas.
Pepperoni and cheese.
Will the gentleman yield?
There's no one's recognized right now.
Mr. Chairman.
Mr. Chairman. Gentlelady's time's expired. We'll now recognize, next up in the queue is the Vice Chair, Mr. Hill, who's now seeks recognition. For what purpose is the gentleman?
Move to strike last word.
Gentleman's recognized for 5 minutes to discuss the amendment.
Well, Mr. Chairman, I want to say that I don't support the amendment as drafted, but I do enthusiastically support the bill as offered by Representatives Houchin and Foster. The winds of innovation are sweeping through our financial system, and amidst that dynamism, one thing that remains frequently static, as it does in government typically, year in and year out, are our regulatory and supervisory capabilities. Our regulators lack the tools and capabilities to effectively supervise a system that's constantly evolving and under the pressure of technological change. And this poses a risk, not just for our financial markets, but for our economy that relies on that effective supervision. You know, the supervisors demand that of all of our financial market participants. Exchanges, broker-dealers, depository institutions, they all have to go through a systematic quarterly technology supervisory process, internal and external penetration testing, due diligence on all aspects of what vendors are using, being used by those companies. And so we ought to hold the supervisors to that same level of scrutiny. And I think the Futures Act is precisely about closing that critical gap. The bill doesn't create any new bureaucratic exercise. Rather, its intention is to simply provide Congress with a holistic assessment of the roadblocks hindering our supervisors' ability to effectively regulate and supervise their financial institutions around which that they have their charge. This bill does not look at technological tools that the agencies use. It looks at that, but it also looks at the talent they need to use that technology to adequately supervise. Attracting and retaining that necessary talent is a challenge we've heard from years from our supervisors. The Futures Act shed lights on these hurdles and allows Congress to have the necessary information, develop and target informed solutions. The current system also acts as a brick wall, blocking innovative technologies from reaching supervisors and regulators. This bill would help identify those bureaucratic hurdles, allowing us to work together to create a more efficient and transparent system. The information gathered would be the foundation for a constructive dialogue between Congress and our supervisory agencies under the authority of this committee. Working together to remove those roadblocks and streamline processes will help keep pace with the rapidly changing landscape that those regulated and those supervising both face. The Futures Act is a common sense bipartisan step forward to address the critical challenge, and I urge the support of the underlying bill, and I urge rejection of the amendment, and I yield back. I yield to the gentlewoman, the sponsor of the bill, if she'd like some more time. I'm going to yield to Congresswoman Houchin, the balance of my time.
Thank you, Representative Hill. I would just say that the underlying bill is designed to cut unnecessary red tape, address potential systemic risks, and identify pain points and support our regulators. With respect to the amendment, I would say, when I was a member of the Commission on Supplier Diversity, there were things that we were asked to do legislatively, and there were things that we did on our own as a commission. And I think in light of the GSA already taking steps to increase the share of contracts awarded to disadvantaged small businesses by 50% by 2025, they're already doing these things in procurement, and I think that this amendment will take the focus off of what I think the scope of the bill should be, and that is improving particularly the opportunity to cut red tape, evaluate for systemic risk, and support our regulators with their pain points. And I yield back to the gentleman from Arkansas, Mr. Hill.
I yield back to the chair.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized, or seeks recognition.
I do.
Gentleman's recognized for 5 minutes for purpose of debate on the amendment.
Thank you, Mr. Chairman. Mr. Chairman, I'm in agreement with the ranking member and Ms. Beatty, and would now yield time to Ms. Beatty.
Thank you, Mr. Green. And again, I think I might have had my response through Congressman Hill yielding to the sponsor of the bill. I'm looking through some of your notes in 2021 when I believe then you were a state representative and the governor appointed you to that commission. Is that what you're speaking of? And so when I looked at much of the language that was there that some of your colleagues, and you were also present on the day that they took a vote on DB and E. And so when you look at some of the work you did then, it seems a little contrary to what you're saying now, because the biggest emphasis on that board that you sat on with other women making a statement was about making sure that we were doing diversity with women, and that benefited white women as much as brown and black women. So I guess I'm a little concerned that all that plight of minority supplier diversity, and all of us, whether it was in your state of Indiana or in Ohio, where 10 years before you were doing this, I was working with the Ohio supplier diversity, which was all about, started with elevating women and majority women, and then black and brown women. So I don't think, looking now at your bill more closely, there's no way that this harms or hurts your bill to take one line or part of what Congresswoman Waters is asking for. It actually complements what you've done in your work in 2021 in Indiana. So is there any dialogue, any conversation, any part of it that we could work with you on to make it fit in a more appropriate way? Because it certainly does not take away from your bill.
Will the gentlelady yield?
Yes.
I yield to the lady.
The gentleman, thank you.
Thank you.
Again, I would just reiterate that when the agency is already doing what you're asking to do in the bill, the GSA is already taking steps to do this as a Biden administration goal. I don't feel it's necessary to legislate it in this bill, and I do feel like my emphasis is on the equipping these agencies to do the evaluation of systemic risk and keep up with technology, the technology necessary to do that in the least burdensome way. And I yield back.
Yield to Ms. Beatty.
Thank you. I guess I have my answer, and let me just say for the record that this is a sad day.
I reclaim my time and yield to the ranking member.
Thank you very much. I think this is a very worthwhile discussion, and these discussions are absolutely needed. We cannot continue to have a lack of involvement by all aspects of this society, and it starts with supervision. It starts with knowing that the proper technology is there to make sure that the outreach is done, that minority businesses are considered in the possibility of procurement opportunities. I want you to know we all work hard. For example, you know, on the infrastructure bill, for example, we all worked hard because we want our bridges improved. We want the water systems improved. We want the highways repaired, and on and on and on. I've been working with minorities about trying to have access in ways that they could have charging stations. Do you know, having reviewed what happens in the federal government, the state, and the local level as it relates to being able to get charging stations at a part of the businesses of minority communities is almost impossible to do because of the way things are structured. And we certainly need supervisory oversight, et cetera. If we're ever to have access, I yield back.
Reclaim the time and will yield to the gentlelady from Texas, Ms. Garcia.
Thank you, my friend and colleague, Mr. Green. I just wanted to join Representative Beatty in asking the sponsor of this bill to reconsider. I think that
Gentleman's time's expired. Further discussion, further debate. Further discussion, further debate on the amendment. I'll now recognize myself on the amendment. This amendment has nothing to do with the underlying bill. We're 1 hour in debate on an amendment that would tell the financial regulators they have to report on their use of technology. These financial regulators require the regulators, the regulated of their agencies to do the same thing that Congress is now, in this bill, requiring them to do. Now, I understand the political debate here. I understand the willingness of colleagues to question other colleagues' legislative history and legislative record predating their time in Congress, but that is unbecoming of this committee and unbecoming of members of this committee. We can have the debate about the topics raised in this amendment, but the underlying bill is simply a bill saying to the regulators, report to Congress on their use of technology.
But the chairman,
let's not overcomplicate it. There's been plenty of debate, and I will not yield.
It's not a debate. Would the chairman yield on a comment you made that referenced to me?
I did not reference you.
Well,
I referenced
the
members
statement
of this
that
committee. It is my time. I've been respectful of members on this. We are 2 hours of. It is my time.
Refer to comments that the gentlelady from Ohio used and talking about.
So are you saying the gentlelady from Ohio questioned another member's integrity? That's not what I'm saying.
Did not question her integrity.
So what I'm telling,
You
what I'm
are
stating
not
in my.
defining that
If you yield,
in
may I
ways
explain
that
what I said, please?
The gentlelady raised a question, and now you're talking about freedom of speech for real. And so I would ask the gentleman to please not imply that in any way did she question the integrity of the gentlewoman who's the author of this bill. She did not do that. She complimented her.
I did not say integrity. I said
What did you say?
legislative record dating back to the legislature. So if you wish to correct the record.
I did.
Then I'm happy to yield to the gentlelady if you wish to correct that. That was not your intention to impugn another member. If that's how you took my comments, that's not what I was stating.
I did take, Mr. Chairman, I took your comment. I only introduced it because the author of the bill introduced it. She brought up that she served on a committee, and she served on it when she was a state legislator. So I didn't bring up her past, she did. She used it as a positive in her bill and her expertise. Now, I just happen to know, because I was very involved with Kentucky, Indiana, and Ohio, that it was when she was a state rep, because I'm a former state rep. So I think it was unfair for you to say we should not be bringing up people's past. She introduced her past.
What I'm suggesting to members of this committee is to get into a debate like we just did about an underlying bill that is a report of financial regulators on their use of technology.
And that would have been fine,
understand
Mr.
that-
Chairman, if you didn't make the comment about the statement I made about bringing up someone's past legislation.
I've allowed you to correct.
She did that.
Then I've allowed you to correct. So
Thank you.
I will reclaim my time.
Thank you.
My point here is to wrap up by saying this was a simple bill. We started off with the training wheels this morning, 2 simple bills, so that in this long day of 13 bills, the last time we did a markup, we got blown up by the House floor. So half of our bills weren't taken up. And 2 Democratic bills weren't taken up then too, and it got rolled over to this one. So we have 7 bills added on to the 6 CRAs that we're doing. We're going to get through them today. What I'm suggesting to members, if we want to have extraneous amendments on this, we're going to have a long day. But we're going to be here until we report out these 13, or until we vote on these 13 bills.
Will the gentleman yield?
And let me finish, if I may, to the ranking member. And if you wish to take 2 hours on the simplest of bills on the day, it is going to be long. And so if we can just get on with us sticking to the contents of this bill, it's enough that we can talk about here in a highly divided place when we have to take an hour of debate on a bill that is that the ranking member said she supports the underlying bill, and Democrats are saying they support the underlying bill going into this markup. This should not be an overstatement of the second most junior Republican on the committee to elicit this type of fiery debate about a bill that everybody supports. So I'm happy to yield to the ranking member.
Well, thank you very much, and I appreciate your being conscious of the time. But, you know, there are times when we talk about justice and equality, that if we have to stay all night, we'll do it, because we have suffered long enough, particularly women, people of color, with a lack of opportunity. Don't try and say that procurement had nothing to do with this bill, that it's only about technology. That's only a part of how you correct the ills of the past. So while you talk about, don't take up the committee's time with extraneous information on bills. We don't consider this extraneous at all. We consider it important, and it is absolutely relative to the bill. So while your admonishments you can do as the chair, I would like you to give consideration to admonishments that say, shut your mouth. You're talking too long. You're taking up too much time. We may have to be here long enough that we order pizzas. I don't care what you order. I don't care what it takes. If we feel that we have to have a voice on issues that are important to our ability to participate credibly in this country, in this society, we're going to do it, and I thank you, and I yield back the balance of my time.
Well, it sounds like we might have several pizza orders this evening. So with that, I will urge an opposition to the amendment and a yes vote to the underlying bill. I look forward to a spicy day of debate if these are the 2 simplest bills we're taking up first. Further discussion, further debate? No further discussion, no further debate. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. No. In the opinion of the chair, the nays have it. The nays have it. The amendment is not adopted. Recorded vote is requested. All those in favor of recorded vote, please raise their hands. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3, the committee rules. Further proceedings on the amendment are postponed. Further discussion, further debate. Any further amendments? There being no further amendments, without objection, the previous question is ordered and recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure. We'll now call up, pursuant to notice, H.R. 7440, the Financial Services Innovation Act of 2024. The clerk will report the bill, which was distributed in advance.
H.R. 7440.
Without objection, the bill is considered as read and open to amendment at any point. I have an amendment of the nature of substitute, copies of which were distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to H.R. 7440.
Without objection, the amendment is considered as read. And without objection, the base bill for it will be
I object to treating the ANS as base text.
the ANS will be treated as a first-degree amendment. Because of the objection, I'll now recognize myself for 5 minutes to explain the bill. The Financial Services Innovation Act has the potential to unlock a new era of innovation and opportunity for our financial system. This common sense bill paves the way for entrepreneurs to do regulatory beta testing before bringing a new product to market. This is good for the regulators, it's good for society, it is good for market participants. This process will facilitate innovation by providing entrepreneurs with regulatory clarity and consumers with greater choice and competition. For too long, the path to market for innovative financial products and services has been plagued by regulatory hurdles and bureaucratic roadblocks. These barriers only stifle competition, hinder consumer choice, and ultimately slow down the pace of technological advancement, much less having properly fitting consumer protections in place and regulation. The Financial Services Innovation Act tackles these challenges head-on by establishing the Financial Services Innovation Offices within the Federal Reserve, the OCC, FDIC, NCUA, CFPB, HUD, Treasury, FHFA, and SEC. All those agencies we oversee out of this committee. We've already seen various states like North Carolina, Florida, Ohio, Kentucky, West Virginia, and others adopt successful regulatory beta testing like in this bill. This bill builds on those efforts at the state level and years of discussion in this committee. Under this bill, these dedicated offices will serve as a one-stop shop for innovators to petition regulators in search of a viable way to bring their product to market. Imagine being a passionate entrepreneur with a revolutionary new product, eager to share it with the world, that would reduce costs for consumers, provide consumers with greater choice, and is better fitting to the consumer's economic needs. Under the current system, the prospect for navigating a maze of regulation, each with its own interpretations and requirements, can be daunting and discouraging. This is especially true when existing rules and regulations are not tailored to new technologies used by financial firms, or consumers are using in other unregulated ways. Congress must provide innovators with a means to cut through that complexity by offering a clear path forward. By working with an innovation office, entrepreneurs can gain clarity on regulation, explore alternative compliance options, and ultimately bring their ideas to market faster and more efficiently. This bill is only effective if all agencies are rowing in the same direction. Currently, they are not. This bill establishes a committee that will facilitate coordination across each agency's innovation office to ensure a collaborative effort as it moves forward in promoting innovation. I'd like to emphasize that this isn't a free pass, or as some may claim. Rather, it's a framework for companies to come in and work with their respective regulators to craft a fit-for-purpose regulatory framework that protects consumers while simultaneously facilitating innovation. Similarly, this isn't just about easing the burden on innovators. It's about opening doors for consumers to enjoy the benefits of innovative financial products and services. By fostering innovation, we can unlock a wave of competition and accessible financial services that empower individuals and businesses to thrive. Let me be clear, this beta testing approach embodied by this bill will not compromise consumer protection or financial stability. In fact, it will enhance it. The rigorous petition process ensures only innovations offering clear benefits to consumers and posing no systemic risk are able to gain regulatory relief. Additionally, enforceable compliance agreements hold innovators accountable for upholding responsible practices and adhering to agreed-upon standards. Let me finish with this. With every change in administration, we see a shift in how these offices of innovation are run and how they engage with market participants. This is not serving consumers, and it's not serving the regulated either. The Financial Services Innovation Act will help modernize and streamline how financial firms and entrepreneurs interact with regulators. It represents a commitment to fostering a financial system that is dynamic, responsive, and inclusive for all consumers. And by empowering innovators and prioritizing consumer protection, we can unlock a brighter future for all Americans. I urge my colleagues to support this bill to embrace innovation, empower consumers, and help build a more vibrant and inclusive financial system. I yield back. Is there further discussion, further debate? The ranking member
The last word.
moves to strike the last word and is recognized for 5 minutes on the
Thank you, Mr. Chairman. I support responsible financial innovation, which is why I oppose H.R. 7440, as it throws responsibility out the door and will create significant risks to consumers and open the door to an array of new frauds. Mr. McHenry's bill would create wholesale exemptions from consumer protection laws, both at the state and federal level, so that companies can experiment on our constituents without repercussions. This bill is also very concerning to me, as it appears to also raise challenges for every agency in the Financial Services Committee's jurisdiction from being able to conduct effective enforcement of current law. This includes the Treasury and HUD, the banking regulators like the Fed, FDIC, OCC, and NCUA, our consumer regulator, the CFPB, and markets regulator, the SEC. Once an agency approves a petition and agrees to modify or waive certain laws or regulations within its own jurisdiction, given recent changes to the text, it is not clear what would happen in instances where agencies share jurisdiction of a law or regulation. It would seem to limit their ability to take enforcement actions against a company based on current law. Given the interaction various federal laws have with state laws, the bill could also undermine the state's abilities to protect their own consumers and investors by potentially preempting their enforcement mechanisms and that of residents who might otherwise have a private right of action. This bill sets all agencies up to fail by not giving them enough time, information, or funding to properly implement the requirements. For example, the bill would only provide the government with up to 120 days to respond to petitions for light touch oversight. I anticipate that because this bill is very broad and any company could apply to sell any financial product because using, quote, technology, quote, unquote, itself such a broad term, our agencies could be overwhelmed with applications from hundreds of companies on any one day, and those companies could repeatedly submit applications without limitation. Consumer advocates have pointed out that this time period is extremely short for agencies to, quote, conduct a fulsome review of a new financial product, such as reviewing data, evaluating legal issues, consulting with other agencies, and evaluating the company and its background, end quote. Additionally, this bill would require 9 federal agencies to establish new offices, but barely contemplate how these new activities will be funded. This is especially concerning as Republicans have consistently sought to cut funding across our regulators and agencies. This bill is widely opposed by a number of consumer advocates, including the Americans for Financial Reform, Center for Responsible Lending, Consumer Federation of America, Consumer Reports, National Consumer Law Center, New Economy Project, Public Citizen, and USPIRG, among others. I strongly urge members who care about promoting responsible innovation to oppose this bill, and I yield back.
Gentleman yields back. Vice Chair, Mr. Hill is recognized.
Well, I thank the chairman. Move to strike the last word.
Chairman is recognized for 5 minutes.
So I'd like to take the other side of that equation from the ranking member's remarks and simply say that if we want better consumer protection of technology and better understanding of the risks associated with it, the benefits to consumers, that this kind of standing up innovation inside the supervisory agencies and encouraging work with market participants is absolutely the way to achieve that. It's not a way to skirt anything. It's a way to enhance supervision. And during the years of the Trump administration and our task forces here on this committee on artificial intelligence and on financial technology, we witnessed sandbox innovation and innovation officers being designated by our supervisors, whether it's the Securities and Exchange Commission or one of our depository institution offices, and that was good. We saw benefits from that. We've seen states do that. We've seen foreign jurisdictions do it, and we've seen benefits from that, and it provides certainty. And when but we hear now that under the Biden administration, under Biden's supervisory leadership, that government bureaucracy is standing in the way of bringing innovation. And newer financial products and services may not have the kind of partnership and regulatory review that they should. The Financial Services Innovation Act that Mr. McHenry offers does precisely that. It facilitates a regulatory environment that fosters financial innovation, as America has been demonstrated a leader for well over 100 years. Some regulators have stalled the momentum by refusing to work with market participants. We see that in this administration, not providing clarity, actually disincentivizing the use of innovative products and services. For example, last August, the Federal Reserve issued a memorandum basically saying that banks, depository institutions can't use innovative fintech applications either internally to help with better compliance, fraud prevention, or externally in serving clients. I think that's a terrible mistake to freeze that market and that dialogue. This bill would revitalize those offices and light a fire under them that consumers and financial firms need and will benefit from. Next major point. We have our AI working group that Mr. Lynch and I are coordinating and working on, and we took an interesting set of visits with the financial supervisors a few weeks ago, and they presented to us a united approach about how they were considering artificial intelligence as a part of their supervision. It's good. I loved it. They all even used many of the same talking points. They said they had their own council that works together on how to supervise and consider artificial intelligence, including the use in their own agency. Mr. McHenry's bill would implement a unified approach across the agencies, which would coordinate with one another through a newly established liaison committee to ensure that all financial agencies are on the same page. And as a result, regulators, market participants, consumers would all benefit from compliance agreements that would facilitate access to new financial products and services, but on a safe and sound basis, thoroughly vetted and coordinated across our regulatory space. And finally, this bill would allow regulators in Congress to learn about new products and services and how best to see them utilized and supervised. So I view this as something that is going back to some things we saw working a few years ago in the agencies, giving it some structure, giving it a unified approach. I also see it as a way to not create new bureaucracy or new costs, but designate innovation officers, sandbox-type officers within the system. And I think you'll find, Mr. McHenry, that many of these agencies already have those people, but they're not being, emphasized. So I thank the chairman for his, I think, common sense bill. I think it deserves bipartisan support, and I would yield to him if he would like to enunciate or add anything to this. Yield to the chairman.
I'm good. Thank the vice chair for
I yield back to the
support of
chair.
the bill. Thank you. Further discussion, further debate. Gentleman from Massachusetts.
Thank you, Mr. Chairman. I've been here over 20 years.
For what purposes, gentlemen? You
sorry?
move to strike the last word, or do you have an amendment?
We're good?
Do you have an amendment, or you move to strike the last word?
Strike the last word.
Gentleman's
I
recognized for
have a
5
couple
minutes.
of amendments, but I want to use 5 minutes on just the general overview of what this bill is. So I've been here over 20 years, and this has to be, and I've seen some bad bills over 20 years. There's some real doozies, some real stinkers out there. Now, this isn't the worst bill. I wouldn't say this is the worst bill that has come before me, but I would say it is in the top 10. I would say it's in the pantheon of bad ideas that have come out of the Republican side. So what you're suggesting here is, and you're elevating innovation, this word innovation, you're saying if someone can put a petition that more likely than not, proposes to create innovation, then, once that petition is granted, that effort is immune, and that company is immune from the enforcement of all other federal statutes and other agencies, other than the one that signs the compliance agreement. All those protections for all those consumers, all those investors, they are held in abeyance. So they can't, the other enforcement agencies, the other regulators can't take action once that petition is granted. And that is unconstitutional, okay? Just for starters. I'm sort of not worried about this bill because it's got so many constitutional problems, it's going nowhere. It's going absolutely nowhere. You've built so many explosive devices in a legal context in this bill, it's going nowhere. You know, it's poorly drafted, and it's just, look, so think about this. We got a bunch of agencies out there that share, in some ways, issues including anti-discrimination, anti-money laundering, consumer protection, community and reinvestment, safety and soundness laws, all the major regulators. And what you're saying, and we have many, many cases where we have joint rulemakings that involve all these agencies. So what you're telling me in this statute is, if one agency grants a petition on the basis of so-called innovation, then everything else doesn't matter. That this company, for this proposal, gets immunity. And that people's civil rights, their property rights, their rights to a day in court, because you steer everybody in this bill, once a petition is granted, you say no more judge trials. We're going to steer everybody into arbitration. So you eliminate the right to a direct action in court on the part of a plaintiff by granting this petition. That's not going to fly. There's no federal court in this country that will approve that. So when we sit down and we pass a law and we grant people who are wronged the right to a jury trial or a judge trial, that is all obliterated in your bill. You've changed the legal landscape for every American in this country by this bill. This is crazy. This has to be an industry bill. This cannot be a bill offered by one of my colleagues. It cannot. No one who, and it couldn't be something that was drafted by the committee staff, because they know better than this. And you got some good staffers on your side, so I know they are not behind this. This is an industry bill that disregards the rights of Americans across the board. This is bad. I have a couple of amendments that will more surgically address the faults in this bill, but I just got to say, this is ridiculous. Remember, let's talk about innovation. FTX was innovation. It blew up. The only thing that saved Americans was that the company was launched overseas, and 99% of the people who invested in that exploding exchange were foreigners. We saved Americans because they couldn't invest in that, many of them, unless they really went out of their way. So Americans were protected by regulations, and innovation took all their money away, and they're still trying to get their money back. AIG, that was innovation. Credit default swaps, that was innovation. It took the economy down.
Gentleman's time's expired. Further discussion, further
I'll be
debate.
back.
Mr. Chairman,
Gentlelady from New York.
I move to strike the last one.
Gentlelady is recognized.
Mr. Chairman, this bill's approach will undermine the consumer protection framework and financial stability by opening the door to exempting new and old products and services from statute and regulation. As part of their core mission and responsibility, federal financial regulators already keep pace with and facilitate development, this is beneficial for consumers. Waiver authority exists, and rulemaking authority is used as needed to respond to marketplace developments. Processes exist to allow the public, including industry, to petition for rulemakings. This bill, Mr. Chairman, is highly prescriptive and potentially burdensome for agencies because it creates a binding, open-ended right for a company to ask any agency to enter into an enforceable compliance agreement waiving statutes or regulations. The timeline and Federal Register notice requirements and judicial review will pose a substantial burden on agencies, OMB, and the courts. The criteria for approving or denying the petition are extremely weak in terms of the justification required and the criteria that allows an agency to deny a petition. The agency's decision is reviewable by a court. It allows one agency to bind others where they share statutory authority and prevent agencies that are not party to the petition agreement from enforcement of the law against the company. This bill is a way to undermine completely an agency's operation as well as the entire statutory and regulatory framework. To my colleagues who might consider voting for this bill, this is not legislation in the name of innovation. This is blowing off the doors of consumer protection and financial stability, regulation, and statute. I encourage my colleagues to vote no and reject this bill.
Tilde yields back. Is there further discussion or amendment? Gentlelady from Ohio seeks recognition.
Mr. Chairman, I have an amendment at the desk.
Sorry. Your ranking member has provided a list to us and said that Mr. Sherman's going to offer the first, I'm sorry, Mr. Lynch is going to offer the First Amendment.
Thank you, Mr. Chairman.
I want to be deferential here, at least on that.
I thank the gentlelady for yielding.
Well, no, does the gentleman seek recognition? And for what
I do,
purpose?
yes. For the purpose of, I believe I have an amendment at the desk, amendment number 1.
We'll suspend while the amendment's distributed. We can move this along more quickly if we have the amendment and get a move in here. I think we should skip that.
The gentleman would withdraw, would really save some time.
Take all day. We can do those. Yeah. That's what I'm saying. Why don't we just move Green and Sherman to the end? Yeah. And then if we just that. And this is the game. And this is the shit about it. The fact that what pissed me off is they're doing the same time on me as the cruise. It's crazy. The woman. Yep. I'm not going to do it. I don't give I give no evidence about what they do. I'm not going to engage in stuff. But you just lose measure. All right. Every member will have their amendment. Clerk will report the amendment.
Amendment to the amendment in the nature of a substitute.
Without objection, it is considered as read. The gentleman from Massachusetts recognized on his amendment.
Thank you, Mr. Chairman. In the interest of consumer protection and investor protection, this amendment would strike the section in this wrong-headed and misguided legislation that relates to enforcement actions by non-party agencies. So in its current form, H.R. 7440 would inexplicably prevent any regulatory agency that is not a party to a so-called compliance agreement, so that's the petition and the compliance agreement, from even attempting to enforce a consumer protection law or an investor protection law or a privacy law or anti-discrimination law. So any other agency that wanted to intervene here and actually enforce their law, the law that they're responsible for, They can't do that because there's a compliance agreement in place that some other agency has agreed to relax or waive. So, in other words, if the promoter of a particular financial innovation can convince just one agency to agree that, or maybe that agency is not even aware of the conflict because they don't have jurisdiction of the other regulatory mission that another agency has, which is clearly understandable. If you can convince that one agency to agree that their product should be subject to lax regulation or light touch regulation, then no other agency would be allowed to enforce the regulation or law that has been weakened against that same product. So it's just a disaster. The inclusion of this harmful provision in the underlying bill defies common sense and good government, and it stands in complete contrast to our longstanding regulatory framework that has been in place precisely to protect American consumers against discrimination, to protect American investors against fraud and other illicit misconduct in the financial sector. And look, all this innovation has introduced incredible opportunities for fraud. You know, when we did after the pandemic, we did the American Rescue Plan. Over 75% of the scams were on internet platforms, on mobile platforms. We had 75% of the scams were in the innovation space. So there's more reason for protection, not less, in that space. As explained by the Nonpartisan Government Accountability Office, the U.S. financial regulatory structure is complex, with responsibilities fragmented among multiple agencies that have overlapping authorities. So they overlap. Under H.R. 7440, however, federal agencies with dual jurisdiction or triple jurisdiction and overlapping enforcement authorities would lose their ability to enforce the laws that they've been charged with enforcing. And they would be unable to safeguard consumers against a risky financial product simply because one agency, either wittingly or unwittingly, has entered into a compliance agreement with the product promoter. Our oversight of artificial intelligence-empowered financial technologies, cryptocurrencies, digital wallets, and other emerging financial innovations has clearly revealed that now is not the time for this committee to grant virtual regulatory immunity to rapidly evolving and very complex products, especially when we're still examining the full extent of the risks that they may pose to consumers. That's why a broad range of consumer advocacy groups strongly oppose this legislation, including the Americans for Financial Reform, Great People, Smart People, Consumer Federation of America, Public Citizen, Consumer Reports. They're very, very reliable. The Center for Responsible Lending. Look, as underscored in a letter signed by these and more than 40 other consumer advocates, they all recognize this is a bad idea. This legislation would force agencies to shirk their statutory duties to enforce the law and protect consumers and instead prioritize allowing risky and unproven products into the marketplace before they have been fully evaluated to ensure that they comply with the law. Moreover, H.R. 7440 would incentivize bad actors to manipulate the product approval process and resulting compliance agreements as a shield against the enforcement of the law. So, Mr. Chairman, I just urge my colleagues on both sides of the aisle to support this amendment to strike the provision in this bill that would undermine regulatory enforcement and consumer protection, and I yield back the balance of my time. Thank you.
Gentleman yields back. Further discussion, further debate. Ranking member seeks recognition.
I move to strike the last.
Gentlelady is recognized for 5 minutes.
This amendment would ensure that all agencies, including federal and state authorities, continue to have their full enforcement authorities. As I mentioned before, the underlying bill raises serious concerns about the full extent of our federal and state agencies to take appropriate enforcement actions on everything from consumer protection to national security issues. This amendment would ensure that federal and state agencies are able to initiate enforcement actions against, including in instances where agencies share jurisdictions on a law or regulation. This would ensure that states are able to do the important work they have long done to go above and beyond federal law to protect their states, consumers, and investors. So I urge members to support this amendment, and I yield back.
Gentlelady yields back for the discussion, for the debate on the amendment. I'll recognize myself for 5 minutes. I oppose the amendment. It guts the underlying bill. I would commend the author of the amendment to look holistically at the legislation rather than cherry-picking his political viewpoint on a piece of legislation that is seeking to make regulation more effective, not less effective. I would say to the sponsor of the amendment that if you like our current approach to regulation, and you think consumers are fully protected, well, let's just keep at it. I don't think that's in the interest of deploying technology. I don't think that's good for consumer protection. I don't think it's good for innovation. I don't think it's the right thing for the American marketplace. This bill is to coordinate between these agencies so that the innovation offices in these agencies talk to each other and coordinate, not to go off ham-handed and with one agency doing something without any other agency of government knowing about it or without coordinating. And so that's the intention here. I understand the gentleman has a different point of view, and he and I have a different point of view on financial innovation in the financial sector, and that's longstanding. But this is a bill that I followed what happened in the UK quite, I'd say to the gentleman, sincerely. I saw what they did in the UK around financial innovation offices, and now in a bipartisan move by agencies under Democrat and Republican leadership, they have financial innovation offices. Now I want to use what we've learned from the UK and through Democrat and Republican administrations having financial innovation offices that I don't find highly effective, to actually get them to coordinate. That's the intention. And for the author of this amendment to impugn my staff to say that they didn't work on this, I think is unbecoming of the member. And so I don't think that's his intention, is to do that. But I've worked on this for quite a number of years. Prior to my
On a point of order.
chairmanship.
On a point of order.
Gentlemen, will the gentleman state his point of order?
I love your staff. I love your staff. I would never demean your staff. The kernel of this idea, however, is one that I've heard repeatedly from industry. And so I know where the source of this is. The source of this.
That is not a point of order. I appreciate you correcting the record on your regard for my staff. What I would say, again, back to the substance of this, is I took this model from the UK. And while you may be the gentleman may be talking to members of industry, I led on this rather than followed. And you can say whatever you want about me. I don't really care about that. I appreciate you correcting the comments about the staff. I think that matters, and I think we have to be respectful of each other's staff. And as we savage each other, that would be just fine. We have a different point of view here. And I appreciate the debate. I appreciate the opportunity for debate. I do think we are lagging in the use of technology in a proper regulated way in the financial realm that we oversee in the four corners of this room. I want us, as Congress, to speak in a bipartisan way on AI, on the deployment of technology. This is the reason why the ranking member and I have a group focused on that we announced together. And the result here is we already have a regulated sphere here that is using technology. Shouldn't we have some guardrails for consumer protection and innovation in the use of those technologies? I think we should. And that's the goal here with this bill. You may not like the construct of it, but this is my attempt at achieving that result. We're not gonna go from a regulated sphere to an unregulated sphere. It's whether or not the regulated sphere is catching pace or keeping pace with what is happening in society. We've been woefully behind. Look at crypto. We have no federal definition of what is a digital asset. We have no federal definition of a stable coin. We have no federal law when it comes to AI, specific to AI. We have every company that we have oversight over uses financial models, and we don't know a damn bit about it in this department. We do not know enough as policymakers about those models. So that the intention here is for Congress to put a stamp on how these innovation offices work and to say you have to coordinate, and here is a good option for how we update regulation to keep pace. That's the goal. And so with that, yield back the balance of my time for the discussion, for the debate on the amendment.
Green of Texas, Mr. Chairman.
Gentleman from Texas is recognized for 5 minutes for purposes of
Thank you,
debate.
Mr. Chairman. I now yield time to Mr. Lynch.
I thank the gentleman for yielding. I don't know how anybody with a straight face could say that this is enhancing regulatory protections at all. The idea of the petition itself gives immunity from regulation. And I believe that's not by accident. I think that's by design. You know, the gentleman has talked about regulatory bureaucracies and obstructions, and I think this is deliberately meant to silence all but one regulatory agency, the one that might, as I said, wittingly or unwittingly grant a petition to an applicant who has a technology that survives the innovation test, whatever that is. So under the bill, once an agency approves an application and agrees to modify or waive certain laws or regulations within its own jurisdiction, other agencies are prohibited. So we might have 10 agencies out there that have jurisdiction, right? And once one grants jurisdiction, other agencies are prohibited. Prohibited. How is that enhancing regulation when you say one, if you get a petition, you can have one regulator and one regulator only, and the other 9 are off the playing field. So they're completely wiped out. It's like they don't even exist. So they're prohibited from enforcing the laws and regulations that have been waived under the agreement. So that's the heart of the problem here. And that is not enhancing regulation. That is reducing it in the 10 regulator model. It's reducing it by 90%. Okay, the amount of regulatory involvement and enforcement. So that claim is just laughable. Okay, that's as plain as I can be. When you take every other regulator other than the one who's party to the compliance agreement, when you take them off the field, and normally they're supposed to be out there protecting consumers, protecting investors, and enforcing all of these federal statutes that we have charged them with. Once you say those enforcement powers have been suspended, then all the people who were otherwise protected by those federal statutes are naked in the eyes of the law, and they have no protection, sir. So, I think it's just it's not an issue of perspective on innovation versus no innovation. It's the application of our laws, the rule of law in our country. These didn't just appear; they were hashed out between Republicans and Democrats. Some in this chamber, some who have gone. But we've got a body of law out there that has been tried, vetted, contested in courts under the rubric of our Constitution. It protects those rights, those liberties that the Constitution acknowledges are at the heart of our union. And what you're saying is that, well, if someone can show innovation, well, all of that is secondary, and we're gonna wipe that slate clean. And so the courts, again, and the people who are protected by the laws no longer have those protections. I think it's absurd. I really do. And I'm going to yield back the last 35 seconds that I have, unless, I'm going
I
to
yield.
yield back 35 seconds to.
Gentleman from Texas yields back. Further
yield
discussion,
back.
further debate on the amendment offered by Mr. Lynch of Massachusetts. No further discussion, further debate. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed, nay. In the opinion of the chair, the ayes have it. Is there a request for a recorded vote? Mr. Stile.
Please, may I have?
Mr. Lynch requests a recorded vote. A recorded vote. Mr. Stile requests a recorded vote. Recorded vote is requested. All those in favor of recorded vote, raise your hand. If sufficient number having raised their hand, a recorded vote is offered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Further discussion, further debate on the underlying bill.
Mr. Chairman?
Gentleman from Massachusetts, what purpose is gentleman?
I have yet another amendment.
Gentleman has another amendment. We'll pause while it's distributed. Do all members have a copy of the amendment? Clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 7440.
Without objection, the amendment is considered as read. The gentleman from Massachusetts is recognized on his amendment.
Thank you, Mr. Chairman. In the interest, again, of consumer protection and investor protection, this amendment would prohibit a financial regulatory agency from approving a petition for a financial innovation that uses an algorithm, input data, machine learning model, or other artificial intelligence-powered tool that is not readily explainable to users and which would likely have a discriminatory impact on a protected class. In the course of our work on this committee's bipartisan working group on artificial intelligence with Mr. Hill as the chairman, we've generally discussed the remarkable potential that AI carries to enhance operational efficiency and reduce institutional costs in the financial sector. However, it's also clear that with the proliferation of artificial intelligence technologies, there's also been the introduction of serious risks to consumer protection, as well as the safety and soundness of our financial institutions. So for this reason, the Financial Stability Oversight Council, or FSOC, recently identified for the first time that the use of AI in financial services is an emerging vulnerability in the U.S. financial system. And in its latest annual report, the Council expressed specific concern over the possibility that, and I quote, AI systems with explainability challenges could produce and possibly mask biased or inaccurate results, close quote. So in other words, the complexity and technological sophistication of AI modeling can often result in so-called black box problems, a complete lack of explainability in terms of informing users on how a given AI technology is generating its decisions. In other words, we know the inputs and we know the outputs of an algorithm. However, we don't know how it gets from the input to the output and what calculations it makes internally. From a consumer perspective, you're not able or possible, for example, if you have received a credit denial letter, let's put that example out there. So you submit all your information, and then if AI is used to calculate all the inputs, and then you get denied, you know that you've applied and you know you've been denied, but you don't know how they reached that decision. So that's sort of a more pedestrian example of how this works. But from the regulator's viewpoint, it is difficult for anyone to assess whether an AI-powered innovation is conceptually sound, reliable, and free of bias, and otherwise fair. So we are, in fact, continuing to receive reports on the serious risks that unexplainable AI systems could produce discriminatory results, especially impacting members of protected classes and marginalized communities. A recent study issued by the Urban Institute and the Federal Home Loan Bank of San Francisco warned us that while the Equal Credit Opportunity Act may require lenders to be able to explain the reasons for credit denials, this may become increasingly complicated or impossible as the models become increasingly complicated. Moreover, a lack of transparency could harm consumers and reduce their ability to dispute what they perceived as an unfair or arbitrary decision on their credit. The report also underscores that such scenarios disproportionately affect borrowers of color, who are more likely to be denied a mortgage. Similarly, the Federal Reserve recently cautioned that machine learning and other artificial intelligence tools can perpetuate and amplify bias where data sets that are used to train AI systems are incomplete or non-representative. According to the Fed, and this is again another quote, there are also risks that the data points used could be correlated with a protected class and lack a sufficient nexus to creditworthiness, close quote. The risk of AI-related bias is also greatly exacerbated by the increased use of third-party artificial intelligence or shadow AI, algorithms and other tools designed by one company that are purchased or leased by another organization. According to a recent study by the MIT Sloan School of Management, more than half of all AI failure systems come from third-party AI, with many companies lacking awareness as to the precise nature and scope of the AI tools they are using. Mr. Chairman, this amendment would better ensure that agencies are not relaxing or outright waiving their regulatory authority over AI-powered financial products that neither they nor users can understand and which could result in discriminatory results. So I urge my colleagues on both sides of the aisle to support this amendment, and I yield back the balance of my time. Thank you.
Gentleman yields back for the discussion for the debate. The ranking member seeks recognition.
Move to strike the last
Gentlelady is
word.
recognized for 5 minutes.
Mr. Chairman and members, this amendment ensures that unexplainable black box artificial intelligence or machine learning innovations are not approved under this bill's light touch regulations. This amendment is critical in ensuring consumer protections in light of the growing role of AI and ML in companies across the financial services ecosystem, including the proliferation of generative AI and ChatGPT. This amendment will build off of the important work that CFPB has done to ensure that when lenders use AI and subsequently deny consumers credit, the lenders are still following the law and giving those consumers accurate and specific reasons for their credit denial. CFPB also described that they are, quote, actively working to ensure that black box models do not lead to acts of digital redlining in the mortgage market, end of quote. So I urge members to support this amendment, and I yield back.
Gentlelady yields back. I move to strike the last word. I oppose the amendment. The amendment would ban the use of data in the underlying bill. It would ban the use of anything that would be deemed as artificial technology without a definition of artificial technology. Machine learning models, that is an expansive view as well, but an algorithm, input data, machine learning model, or other artificial technology tool would be banned under this bill. My colleague from Massachusetts says he's not anti-technology, but this amendment reads like it's against using information to make decisions. I don't think that would be the author's design. He talks about AI, but when you ban the use of input data on an agency reviewing rules, that seems to me like turning back the clock in a very bad way, that we want to have uninformed regulation. Moreover, the whole debate here has gotten well out of hand of the purposes of this. In order for a new alternative rulemaking to go through this process, you have to go through a set of factors. And that alternative compliance process we lay out in this bill, you have to show that that change in policy would serve the public trust. And I would commend page 10, line 10, improve consumer access to a financial product or service. And then finally, factor E says that it would promote consumer protection. So we put those weights and measures in the bill. This debate has gotten out of hand. Reject this amendment, reject this anti-technology, anti-data amendment, and let's reject that and vote for the underlying bill. I yield back the balance of my time. Further discussion,
Green
further
from
debate?
Texas, Mr. Chairman.
Gentleman from Texas seeks recognition.
Strike the last word. and
Gentleman's
yield
recognized for 5 minutes.
to strike the last word, yield to Mr. Lynch.
I thank the gentleman from Texas. The only burden here, okay, and I know you made some comments about data. They can use any data they want, any input data, any machine learning model, any artificial intelligence powered tool. The only burden that this amendment requires is that it has to be readily explainable by the people who use it. That's the problem. That's the problem.
Will the gentleman yield?
Sure.
This is not what the amendment says. I'm reading the plain text of the amendment. I don't know where the gentleman is getting this.
It has to be, it's in the text.
The paragraph above it is what I'm referencing. You can't use input data. That's what section A is.
That is not readily explainable. That's where the bias comes in. That's where the problem comes is when, so, I mean, I trust the gentleman's up on the explainability issue.
I would trust the gentleman's up on financial models.
Reclaiming my time. So we've had a long debate.
Mr. Green's time, but go right ahead.
Okay. He yielded it to me. So in the joint task force on AI, the gentleman from Arkansas and myself and all the members have been going back and forth about this issue of explainability, which creates a problem. The use of some complex AI algorithms, while very fast, very efficient, are not explainable. In other words, we know what the inputs are, we can see what the outputs are, but we don't know how this particular artificial intelligence arrived at that result. So all we can look at is really the outputs, and because different groups have, including the San Francisco Fed and others, and MIT School of Management, they've looked at the outputs and then compared them to the real world and the people who have been applying and have found that in many cases there are instances where some of that AI contains a bias result, and they cannot explain how the AI got to that point, right? So this would allow a lot of AI that is explainable. It would prohibit AI tools, input data, artificial intelligence powered tools that are not readily explainable and which would likely have a discriminatory impact on a protected class. That's the burden that the amendment creates. It's not that you can't use data, but if you're going to use that data, you've got to be able to explain it to the consumer.
And Mr. Gentleman, we yield. It's a very good, proper explanation of AI. But the plain text here, our current financial models that the people we oversee use are not readily explainable to humans either. That's my larger point, and I think the gentleman would agree on that larger and what I hear from you separate question from the amendment here, which is the ability to readily explain financial models that are so complex that we have hundreds of people working on one company's models at the Federal Reserve. That is cumbersome, not good for financial stability. So that was my point.
Okay,
I hear correctly your point that at this stage of the game, AI is not readily explainable to human beings. I would point to the public interest in the outline that I gave. I better understand your point, though, and I appreciate the work that you're putting in on the AI task force. And I yield back. I yield back to the gentleman's time.
Okay. I have nothing further. I yield back to the gentleman from Texas.
I yield back to the chair.
Further discussion, further debate on the amendment? No further discussion, further debate. The question now occurs on the amendment offered by the gentleman from Massachusetts, Mr. Lynch. All those in favor of the amendment shall signify by saying aye. Aye. All those opposed shall signify by saying nay. No. In the opinion of the chair, the nays have it. Nays have it. The amendment is not adopted. Does the gentleman wish to have a recorded vote?
Yes, I request a recorded vote.
Request a recorded vote. A recorded vote is requested. All those in favor of a recorded vote, please raise their hands. Sufficient number having raised their hands, recorded vote is ordered pursuant to subsection C5 of Rule 3 of the Rules Committee. Other proceedings on the amendment are postponed. Further discussion, further debate. Gentlelady from Ohio.
Mr. Chairman, I have an amendment.
Gentlelady from Ohio has an amendment at the desk. Clerk will distribute. All members have a copy of the amendment. Clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 7440.
Without objection, the amendment is considered as read. The gentlewoman from Ohio is recognized on her amendment.
Mr. Chairman, H.R. 7440, the Financial Services Innovation Act, would create a Financial Service Innovation Office, FSIO, within each regulator and allow companies that intend to offer so-called innovative products to petition regulators for alternative compliance strategies. While it is important to encourage innovation, we must do so without compromising critical consumer protections. This bill creates a path for companies to evade long-standing safeguards that prevent abusive practices in financial marketplace. It would also allow risky products to enter the marketplace by limiting the full ability of federal and state agencies to bring enforcement actions. Requiring regulators to go to great lengths to explain why they disapprove certain applications and providing a legal pathway for companies to challenge a disapproval in court. The legislation is also, in my opinion, extremely broad. Example, defining financial innovation as any product or service offered through technology. In addition, the bill would require nine federal agencies to establish new offices without giving them sufficient time, information, or funding to carry out this task. However, to be helpful, my amendment would strike the legislation and replace it with text directing the relevant agencies to do things we've heard the other side frequently say to directors when they come. They've asked for assessment, so we're asking to prepare an assessment for this committee to do these things. Describe the funding required. We hear that all the time. The quantity of staff, the process, the estimated resources involved in creating an FSIO within each agency. In addition, the assessment must describe how a limitation on enforcement actions could potentially pose risks to consumer protections and to the safety and soundness of the financial system. We know this. History has shown us that unconditional endorsement of so-called innovation at the cost of all else can ultimately prove disastrous to consumers. It is essential that new financial products have the vetting required to ensure safety, transparency, and fairness for all consumers, and I believe that is what probably the sponsor wanted. So I urge my colleagues to support this amendment to help the bill, and I yield back.
Further discussion, further debate. Gentleman from California seeks recognition.
I rise in support of the amendment.
Gentleman is recognized for 5 minutes.
I rise in support of the amendment, which I think improves the bill. I'm concerned about the bill in general. I once again rise in support of capitalism, under which the government should not be choosing winners and losers. My concern is that this bill says, well, if you're innovative, then we treat you especially well, and if you're old-fashioned, we don't. And I just think that the market should decide, and that we should not be favoring, through the regulatory process, companies that want to do old things in new ways as opposed to the old companies that want to do old things in old ways. It may very well be that the innovative companies can offer products at lower cost, and maybe the market likes that. It may be that consumers want brick and mortar facilities that they can actually visit and see and talk to real humans, and the market will appreciate that. But the idea that the federal government should treat you better because you're higher tech or lower tech doesn't strike me. It strikes me as the federal government choosing winners and losers. I realize that some of our regulations are designed for smaller companies, and I think that it makes sense to have regulations designed for smaller financial institutions. We have a stake in preventing undue concentration. We have a stake in promoting competition. But I don't think we should be telling the market that we want a high-tech approach or a low-tech approach to financial services, and I yield back.
Gentleman yields back for discussion, further debate of the amendment. If not, I move to strike the last word. I rise in opposition to the amendment. Just like important legislation this committee has pushed under Democrat and Republican control, when we have staff already working on the matter at hand under the bill, we don't provide them additional resources when it is not necessary, and in this circumstance it's not necessary, number one. Number two, if this is passed, it renders moot the underlying bill. I commend the staff for the design of this amendment. It is creative, it's interesting, but it has the inevitable impact of destroying the underlying bill. So kudos to them, and I urge a no vote on the amendment and a yes vote on the underlying bill. And I yield back. Further discussion, further debate. Ranking member seeks recognition.
Strike the last word.
Gentlelady is recognized. Is it on the
Beatty.
On the Beatty amendment?
On the Beatty amendment.
Gentlelady is recognized for 5 minutes.
This amendment would ensure that agencies have the full amount of funding, staff, and other resources necessary to create financial services innovation offices before they are mandated to do so. It is integral that if we are mandating agencies to take up new work streams, we ensure those are fully funded so that the other important work the agencies do every day is not negatively impacted. Additionally, if entities with so-called financial innovations are looking to benefit from the purported changes in this bill, it is important that the cost of setting up and running these offices are borne by those entities rather than the American taxpayers. That's why this amendment requires agencies to report on any barriers, including staffing and other processes that may face in charging fees to petitioning entities. I urge members to support this amendment, and I yield back.
Gentlelady yields back. Further discussion, further debate on the Beatty amendment. No further discussion, further debate. The question now occurs on the amendment offered by the gentlewoman from Ohio, Mrs. Beatty. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed shall signify by saying nay. Opinion of the chair, the noes have it. The noes have it. The amendment is not adopted. Gentlelady, ranking member asks for a recorded vote. A recorded vote is requested. All those in favor of a recorded vote, please raise their hands. a sufficient number having raised their hands, record a vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. Further discussion, further debate on the underlying bill. Gentleman from Illinois. Gentleman from Illinois has an amendment at the desk. Clerk will distribute, and we'll pause. Every member have the copy of the bill? Gentleman from Illinois, Mr. Gaston, clerk will report.
Amendment to the amendment in the nature of a substitute to H.R. 7440.
Without objection, the amendment is considered as read. We'll now recognize the gentleman from Illinois to explain his amendment for 5 minutes.
Thank you, Mr. Chair, and I'm sure I won't need the whole 5 minutes, and I'm sure that will bring much joy to everybody in the room. Just want to first make two bipartisan points. Money laundering, bad. Number two, of the 3 branches of government, the legislative branch is the best. We're the best looking, we're the smartest, we're the wisest.
Amen.
Unanimous consent, agreed. I mention those both because this amendment is basically very simple, just to avoid any ambiguity on the point of money laundering being bad, or that might frustrate the intent of this legislation as relates to one of those lesser branches, the judicial branch, who might be confused on this. The current drafting of the bill says that petitioners should certify that their products, quote, meet the purposes of the bank secrecy agreement. I hope we would all agree that we would be wise not to have any question of whether there are other ways to meet those other than what would exist normally. So this basically just said would meet the bank secrecy agreement. It may seem minor, but keeping in mind that most fintechs are already money services businesses, they already comply with BSA obligations. Let's not have any question about whether somehow becoming a fintech allows a backdoor that you can meet the requirements of the bank secrecy agreement through some other.
Legitimate yields.
If I could just finish, and then I'd be happy to go back, because I just want to make the second point as well, which is to add at the end that this would not present a national security risk to the United States, terrorist financing, sanctions evasion. Again, all those things should be there, but is outside of the bank secrecy agreement language in the top. So it's just formality to clarify, to avoid any ambiguity about whether these fintech companies are regulated differently than others. I promise less than 5 minutes. That's 3 minutes left.
Will the gentleman yield?
Yes.
I concur. This is a good addition. This language in these factors is something that I've spoken with. Our staffs are well vetted in the current set of language for a number of discussions we're having in committee over the last couple of years. This is a nice addition to it. Good catch. I want to commend the gentleman for offering a solid addition to the policy. And I won't even ask whether or not the gentleman will support the bill. If his amendment is adopted, I will accept the amendment if that is acceptable to the offerer of the amendment.
I appreciate it, and out of respect for you, Mr. Chairman, I will yield back.
Thank you. Gentleman yields back. All those in favor of the amendment shall signify by saying aye. Aye. All those opposed shall signify by saying no. The ayes have it. The ayes have it. And the amendment is adopted. We'll now, congratulations, Mr. Gaston. Further discussion, further debate on the underlying bill. If no further discussion or amendment, without objection, the previous question is ordered and the recorded votes on the pending amendments have been postponed. Once the votes are taken, the committee will immediately consider the question to report the measure. Stop.
Take your break now, Mr.
Oh, yes. Awesome.
Pursuant to notice, I call up H.R. 7428, the Earned Wage Access Consumer Protection Act, introduced by myself. The clerk will report the bill, which was distributed in advance.
H.R. 7428, to regulate...
Without objection, the bill is considered read and open to amendment at any point. I have an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute to
Without objection, the amendment is considered read and will serve as the base text.
I object, Mr. Chairman.
The ANS will be treated as a first-degree amendment.
Yes.
Thank you. I'll now recognize myself for 5 minutes. Very good. The Earned Wage Access Consumer Protections Act is introduced, provides a clear and consistent consumer protections for users of earned wage access services, commonly referred to as EWA. This would be the first time federal consumer protections for EWA would be included in statute. EWA uses technology to give workers access to a portion of the wages they've already earned prior to payday. It allows workers to move to more closely tie work to reward and helps them avoid financial instability. This is a different type of liquidity product which requires novel solutions. As with all new developments, the growth in EWA poses new questions for policymakers. It's important that consumers have strong protections and fully understand all the details of the services they're receiving. EWA providers also need to know what their obligations are and what types of activities are permissible or prohibited. So that's what my bill does and tries to clarify this at the federal level. My legislation regulates the two main EWA models, direct-to-consumer and employer-sponsored. It requires providers to offer an option to receive earned wage access at zero cost, even if they have other fee-based services. It also lists out specific and clear disclosure obligations so consumers know exactly what their rights are when participating in EWA. The bill also ensures consumers can cancel services at any time and that all providers must offer a straightforward dispute resolution process. And it clarifies that EWA advances are non-recourse. Consumers can't be pursued for non-payment in court or through a debt collector. Providers can simply turn off the service for customers that don't live up to their terms and conditions. Crucially, this legislation does not challenge the CFPB's authority to regulate this industry. In fact, it directs the CFPB to engage in rulemaking. Millions of American workers already use EWA. The protections in my bill will help to ensure consumers that they can safely use EWA nationwide. And they'll be able to provide industry with regulatory clarity to innovate and expand product offerings. I urge my colleagues to support this legislation, and I yield back.
Green of Texas.
What purpose does the gentleman seek recognition?
To strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I strongly oppose H.R. 7428 as it creates a major loophole in our consumer financial protection laws that would allow predatory payday-like loans and products to proliferate. I want to be clear, I support consumers having early access to their paychecks, but this shouldn't be done as proposed in this legislation. Today, there is a growing industry of so-called earned wage access, or EWA products, that purport to provide employees early access to their paychecks for wages already earned. Some of these companies work with employers to provide this service for free for their employees, and I think such arrangements have the potential for being a responsible innovation. However, there are more nefarious versions of this product where workers are charged fees and tips, including where third-party companies offer this product directly to consumers, and those fees and tips can add up quickly. The various versions of EWA are currently being reviewed by the Consumer Financial Protection Bureau as to whether certain versions should be considered credit instruments, like payday loans. I support the CFPB's efforts because if they are credit products, consumers should be given clear and much-needed disclosures required by the Truth in Lending Act so that they can make full and informed decisions. However, this bill would exempt all forms of earned wage access products from the Truth in Lending Act, or TILA as it is called, denying consumers information about the true cost of these products. Mr. Chairman, I'm talking about denying consumers from simply knowing the annual percentage rate, or APR, of the product. Today, 76% of American families live paycheck to paycheck with only minor savings to help with emergency expenses. There is no reason companies offering these products shouldn't comply with long-standing consumer protection and credit laws. I would also note that in the amendment, in the nature of a substitute, there appear to be unintentional mistakes in the draft. For example, the amendment states that the Bureau administers this law, but it does not specify which bureau is being referred to. It is the CFPB, the FBI, or is it the CFPB or the FBI? The bill is not clear. Furthermore, even if Republicans meant to give this to the CFPB, this version of the text would be unenforceable. Even if those errors are fixed, consumer advocates strongly oppose this bill and have highlighted a list of the ways consumers are harmed by TILA protections for EWA products. They're harmed without these protections is what I should have said, Mr. Chairman. So therefore, I would end by simply saying I support the notion of consumers having the opportunity to receive their pay early, but they should not have to pay to be paid. And I will yield back.
The gentleman yields back. For what purposes the gentlewoman from New York seek recognition?
Mr. Chairman, I move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. While I am open to earned wage access, believing it is a service that thousands of individuals already use to access critical funds, we must ensure there are proper consumer protections. For example, there must be clear disclosure of the APR, even on transactions that are on only a few days. This ensures transparent pricing and allows consumers to make an apples-to-apples comparison. Some EWAs charge APRs as high as 300%. There must be transparent pricing on the front end before the transaction takes place, no hidden fees. This bill fails in achieving these core protections and exempts EWA providers from TILA and prevents the ability to compare EWAs to other credit options. H.R. 7428 and its supporters continue to perpetuate the myth that EWAs are not credit. But guess what? They are alone, even if for only a very short amount of time. The advances must be paid back. Allowing EWAs not to be characterized as credit is similar to the arguments we have heard for years from the payday loan and merchant cash advance industry. We have heard this argument before, and it allows these providers to evade basic consumer protections and state rate caps. You can call it whatever you want, but it's credit. It is, if it wasn't credit, it would be a gift. You don't want to call it credit because if you call it credit, then TILA will apply. So the sponsor and supporters are straining to call it something else. The bill support purports to offer a number of protections that will apply to fintech cash advances. But the bill largely codifies lenders' current business model without adding significant new protections, and the CFPB already has the regulatory authority provided under this bill. So the consumer protections and regulatory authority are largely duplicative. 190 labor, civil rights, consumer, legal services, and community groups and academics are opposed to H.R. 7428. Mr. Chairman, you cannot put lipstick on this pig. I urge my colleagues to vote down this ill-conceived legislation. I yield back.
The gentlewoman yields back. The gentleman from Texas is recognized for 5 minutes to strike the last word.
I do strike the last word. Wish to be recognized for 5 minutes.
Gentleman's recognized.
Mr. Chairman, thank you very much. I want to stand in support of this bill, H.R. 7428, the Earned Wage Access Consumer Protection Act, offered by the young chairman of the committee. I think that in fairness that the gentleman from Texas offered his remarks that really give the advantage to an employee, that give the advantage to the circumstance. And I think that that is what the gentleman, Mr. Stile, was attempting to do. As a congressman, he well understands that there's a user study by the FTI Consulting that reveals that a significant majority of consumers, when talked about this, that they understand not only the mechanisms, but also that they understand that there might be an associated fee associated with that. The key differences that we're talking about today is whether that employer offered a great partnership that they might have with one of these EWA providers. Some of them charge a little bit more and some charge a little bit less, but either way, what the gentleman's trying to do is to give an advantage, because we find that people who have earned that money might need access to that money before a regular paycheck. And I think that that's what the gentleman from Texas, Mr. Green, was attempting to say. He sees why this is a good idea. He simply disagreed because there might be some fees associated with it. Well, there might be fees associated, but it's up to that employer to sign with an EWA that would, a provider, that then would allow that to take place. I think it strongly outweighs the possibility of someone bouncing a check, might needing immediate financing, might need to do something that takes them away from work for a long period of time. And if this could be done through their work, with the opportunity to take the money that they had earned, I think it's a responsible thing. Lastly, the numbers, I think, are very important. As we have more people in the workplace that perhaps have dependents at home, perhaps that have children under 18 that can cause circumstances that parents are responsible for, it's more a lifestyle issue. And what's associated with that, their employer, the employees could work together to make sure that those fees are in line. Lastly, I think it's very important that we understand that the consumer would understand before they do this what the consequences, what the fees and what the responsibility would be. And that is why we clearly understand that this piece of legislation establishes dispute resolution policies. It clearly informs consumers of their rights, and it allows optional nature of tips, which allows service cancellation without fees. What does this mean? This means that the money that was earned by that employee can be managed by that employee effectively, and that's the advantage. We should not let a fear of this happen when it's done with consent of an employee who understands the obligations and the advantages that would be there, that obviously by this piece of legislation is an advantage to the employee. Mr. Chairman, I yield back.
Will the gentleman yield?
I would.
I appreciate it. I just want to speak briefly because off of some of the remarks we've heard, I think there's some misunderstanding of what EWA is and how people use it in the dialogue earlier. I think if we jump back 100 years, workers expected to be paid daily for their work. You'd carry a 50-pound sack of potatoes, the manager, the owner of the business, at the end of the day, if he didn't pay you, you'd be upset. Jump forward, we have these large ERP systems or reasons to do payroll on a biweekly or on a monthly basis. That started to be the norm. Technology's now moved forward such that you can get paid as you work. So the reason that this is not a truth in lending issue is because it's not a loan. You're receiving the money that you have already earned. In the bill, to make sure that we could try to bring bipartisan support, we did a lot of outreach and a lot of work on this, there is a free option with no fees associated with it, a free option for workers to be able to earn the benefits of their labor. And so as we look at this, it's really a tool to empower workers to be able to receive the benefits of the wages they've worked. And we've set this up in a structure such that there is a free option to workers. It's non-recourse, and so therefore it's not a truth in lending issue. It's a question of how do we put forward the regulatory framework to assist workers and allow innovation in this space. I appreciate the gentleman yielding his time.
I will ask for my time back now, and I would say, Mr. Chairman, that's exactly the advantage to the consumer that I'm proud to be a part of. It's already earned. You just need it a little bit sooner.
Agreed that the gentleman's time has
expired. Back my
expired.
time.
I will give you equal time, sir. Does the gentleman seek recognition?
I seek recognition.
To strike the last word?
I strike the last
Gentleman,
word.
yes. Mr. Sherman is recognized for 5 minutes.
This is a payday loan. As a matter of fact, many payday loans are called payday advances. A rose by any other name or a payday loan by any other name smells the same. Now, we're told the question before us is not whether consumers will have access to this product, but whether we as a Congress are going to say it's not a payday loan. Now, went to a kind of good law school. I can talk about how many angels can dance on the head of a pin and how many bankers can dance on the head of a pin. But in substance, this is a payday loan. This is not selling a receivable. Now, why is that the substance? Because this is an advance on your paycheck. It means that when you get paid, you owe the money to the lender. But even for those who want to talk about, you're selling a receivable, keep in mind most of these loans, you can let's say you get paid on the 15th of the month. You can borrow this money on the second day of the month and get it wired into your account on the third day of the month, and you haven't earned it till the 15th of the month. So this is not getting your money for carrying the sack of potatoes at the end of the day. This is getting 15 or 30 days of carrying potatoes paid in advance. Second, it's my understanding that employers don't have to cooperate with this. This is not assigning a receivable where the employer is going to pay the lender. This is a situation where the money is going to be pulled out of the consumer's bank, and the employer may know nothing about it. there's this idea that somehow this is free money. These are not charitable organizations. First, they ask for a tip. Now, a tip is usually something you give to someone who brings you food at a restaurant. A tip is not what you give Jamie Dimon for providing financial services. This is not a tip in the sense that you're providing it to a low-paid employee. You are paying this to the company. Second, you may think this is a voluntary tip, but instead it's built into the software where 2 or 3 times you have to delete it, otherwise it's self-populated and it's already in the system. But second, this is not free money because most people who do this want the money now, need the money now, and if you want to get the money now, you have to pay interest to get it. They call that a lightning fee. So, you're paying a company to borrow money. It's not a tip. You're getting your money now. You're paying interest on your money now. You end up with less money than you would have gotten otherwise in order to get the money sooner. Are there practical reasons why that might be in the meet the consumer's needs? Yes, you may have an automobile that needs its transmission fixed. But is there any reason for us to say that isn't a loan? That it isn't subject to the same rules as other payday lenders? There's no reason at all. This is functionally identical to and directly competes against and is an alternative to the payday lending that we're already familiar with. And to just put another name on it and to say you're not borrowing until payday, you're transferring your pay makes absolutely no sense from the consumer's perspective. Either way, it's you get money now, and they kind of take it out of your wages on payday. This is a payday loan in every sense. So let's expose it to the same rules as payday lending, and let us not pretend that a fee that's built into the software is a tip, and that a lightning fee is voluntary when in fact that's what you're paying to get your money now. So I don't know why some technical dancing on a head of a pin argument should stand in the way of us realizing that a payday loan is a payday advance, is a whatever you want to call it, earned wage access, consumer protection, whatever you call it. It ought to be subject to the same rules, and I yield back.
The gentleman yields back. Mr. Hill is recognized for 5 minutes to strike the last word.
Strike the last word. Thank you, Chairman. I'm rising in support of this bill that Mr. Stiles introduced, the EWA Consumer Protection Act. For many of the reasons that I've heard on both sides of the aisle, that people need clarity, transparency, rules of the road, documentation, and that includes absolutely the consumer. Mr. Chairman, when I was in banking in the years before I came to Congress, I had locations in the poorest counties of my state of Arkansas with a lot of people who really struggled with that gap between their pay, some every 2 weeks with a direct deposit, some out in the rural countryside being paid every Friday. But nonetheless, people tried to make smart, wise decisions about how to cover that gap. Some might use a bank overdraft protection program. Some might do a cash advance on a credit card, a very expensive alternative. Others look for that gap, and I think that the issue we have to recognize in this House is that people are going to avail themselves of these choices. And so how do we do that in that way for that single mom who, as Mr. Sherman noted, has an unexpected car repair before payday and could fall behind on rent or face higher late fees or an advance higher price on a utility bill or have to go to a higher interest rate lender? So the EWA offers that kind of an alternative. And so what I think Mr. Stile has arranged is, let's have full transparency by publishing in plain language the disclosures detailing any fee and the customer's rights under an EWA product, guarantee a cancellation right, giving the individual complete control, and developing clear dispute resolution purposes for those customers across the country who want to select this as their in-between paycheck gap opportunity. And I'd like to offer to my friend from Wisconsin some time to respond to the comments from our friends on the other side.
I appreciate the gentleman yielding. I would just note, as we're looking at this, I think it's really important to remember that these are advances based on money workers have already earned. And in particular, how do you know that's the case is because they're non-recourse and there's no reporting or interaction with the credit bureaus. And so it's a very different structure than a payday loan. And in fact, it is a much better offer for many people who are working to make ends meet. Give you a quick example of this. You can envision a young woman, a single mother maybe, in December working at a large big box retailer. And they come to her and they offer her the opportunity to work an overtime shift, time and a half. She has childcare in that situation and she would love to take advantage of it to be able to use those funds that are raised to maybe buy additional Christmas presents. Maybe it's a young man who had a car breakdown and he needs $200 to repair his car. And he's looking to take a weekend shift to be able to earn the money to pay that car, rather than go to a payday loan or another form of financial product to be able to receive that money, to be able to address an immediate need. This broader product better ties workers to the benefits that they're earning through that work. Removing the aspect of the recourse, removing the credit bureau reporting is what demonstrates that it is not a loan product. In fact, is giving you access to wages that you've earned. This is an important tool for a lot of people who are struggling to make ends meet, and putting that regulatory framework in place. Not only does it ultimately protect the worker, but it also provides a framework for further innovation in this space to continue to work to improve the connection between work and reward. I yield back.
Appreciate the chairman's work on this bill. I urge members on both sides of the aisle to support it, and I yield back to the chair.
The gentleman yields back. Is there further amendment or debate? The gentleman is recognized to strike the last word.
Strike the last
5
word,
minutes.
please. Thank you, Mr. Chairman. Mr. Chairman, I'd like to express my strong opposition to H.R. 7428, the so-called Earned Wage Access Consumer Protection Act. To the detriment of low-wage workers who are living paycheck to paycheck, this misguided legislation would essentially exempt earned wage access products from federal consumer credit laws, including the charge and fee disclosure requirements set forth in the Truth in Lending Act. As ranking member of the Subcommittee on Digital Assets, Financial Technology, and Inclusion, I have participated in multiple hearings to examine the proliferation of fintech-powered earned wage access services that enable employees to receive a cash advance on their paycheck prior to payday, often at an inflated fee or at the cost of a voluntary so-called tip. Whether offered through an employer or through a direct-to-consumer provider, this on-demand pay market has grown rapidly, with employers and providers now advancing billions of dollars in wages to millions of employees annually. However, our oversight in this area has revealed that there is serious cause for concern when it comes to consumer and worker protections. While earned wage access products are routinely marketed as safer, quick cash alternatives to high-interest payday loans, we have also found that these fintech cash advances can carry exorbitant interest rates that, according to one industry analyst, can turn these services into, quote, payday lending on steroids, close quote. And a recent analysis from the California Department of Financial Protection and Innovation indicates that the average APR across nearly 6 million earned wage access transactions was just over 330%. So they looked at 6 million earned wage access transactions, the average APR just over 330%. We're also seeing high rates of repeated usage and dependency by primarily low-wage workers. As reported in a national study conducted by the Kennedy School at Harvard, 40% of people who have access to an earned wage access app through their employer was using it at least once a week. Over 75% of respondents indicated that they were using their money to pay for regular bills rather than just emergency expenses. With one typical user noting, quote, "It just turned into a cycle of always taking money out," close quote. Other users reported that when using direct-to-consumer providers, they were regularly charged an overdraft fee whenever that app unexpectedly overdrew their account. I'm also greatly concerned that these cash advance models are disproportionately targeting and impacting unbanked and underbanked populations and communities of color and women. The same Harvard study cited a survey of one popular app that was used by over 5 million families monthly in all 50 states. Nearly 84% of the respondent users were women, 33% were Black or African American, and 43% earned less than $20,000 annually. Considering these and other challenges, I would strongly recommend that this committee afford the Consumer Financial Protection Bureau the opportunity to finalize its upcoming guidance on earned wage access. I'd like to thank you, Mr. Chairman. Another indication of the worthiness of this bill is illustrated by the people who are opposing it. And I'm not going to read them all off, there's just too many. But the Americans for Financial Reform, the Appleseed Foundation, the Center for Responsible Lending, all these groups are against this bill. The Coalition for Labor Union Women, the Coalition of Human Needs, the Consumer Actions Council, the Consumer Federation of America, Consumer Reports, Consumers for Auto Reliability and Safety, the Equal Rights Advocates Impact Fund, the Leadership Conference on Civil and Human Rights, the NAACP, the National Association for Latino Community Asset Builders, the National Association for Consumer Advocates, the National Coalition for the Homeless, the National Community Action Partnership, the National Consumer Law Center on behalf of its low-income clients, the National Consumer League. Well, how much time I got left? There's just the National Employment Lawyers Association, the National Institutions for Workers' Rights, Public Justice, Public Good Law Center, the Public Council, Public Citizens, Service Employees International Union, and many, many others. Mr. Chairman, we should vote against this bill. I urge my colleagues to do so, and I yield back the balance of my time.
The gentleman
Thank you.
yields back. Is there further amendment or debate?
I have an amendment at the desk.
We'll pause while the amendment's distributed. The clerk will report the amendment.
Amendment to the amendment.
Without objection, the amendment is considered as read. The gentleman is recognized on his amendment.
Thank you, Mr. Chairman. Mr. Chairman, the bill presented today purports to give the CFPB authority to regulate EWA advances. Yet, we are well aware that the CFPB already has ample authority to do so. The passage of this bill would ultimately do more harm than good, hampering the CFPB's forthcoming guidance on EWA advances and limiting the agency's options on the application of consumer protections in this space. My amendment would strike the implementation of this bill and direct the CFPB to issue, under its full authority, guidance on how consumer financial protection laws apply to EWA products and clarify the status of such products. Mr. Lynch has mentioned language from a letter that I have that I'd like to introduce into the record, Mr. Chairman.
Without objection.
This letter is from 191 labor, civil rights, consumer, and legal service, as well as community groups and academics. I'd like to read a few excerpts from the letter. It reads, "The 191 undersigned labor, civil rights, consumer, and legal services and community groups and academics write to express our opposition to H.R. 7428, the Earned Wage Access Consumer Protection Act. In the guise of offering protections, the bill obscures the truth, its true effect, to exempt fintech cash advances from the Truth in Lending Act, to endorse a form of loan that makes workers pay to be paid, and to facilitate new evasions for payday lenders." It goes on to say, "True earned wage advances are offered through employers, often with fees, but some employers offer early pay for free. Fake direct-to-consumer providers claim to be paying earned wages, but have no connection to wages or payroll, are repaid by debiting bank accounts and collect purportedly voluntary tips. Both models charge inflated expedited fees." And I'd just like to go over to a couple of additional organizations that Mr. Lynch did not get to. The ACLU is endorsing this letter, the AFL-CIO, the American Federation of Teachers, Center for Responsible Lending, the Coalition of Labor Union Women, the Consumer Federation of America, the Japanese American Citizens League. Mr. Chairman, this piece of legislation would allow those who are the most vulnerable to become repeat borrowers, because typically it would work this way. A person in need of money, which I will call right now money, meaning they need it right now, they would borrow money on day one, but these are the same persons who are most likely to need that money on day 2 or day 3. And as a result of these fees that they pay, they would end up paying fees for day 1 because they want it right now, and you pay the fee to expedite the receiving of the money. If you can wait a week or 2 or some period of time, maybe you don't pay the fee. But we're talking about the right now money that people will need. So as a result of getting the money on a day-to-day basis, they no longer live from paycheck to paycheck. They live from a day's pay to a day's pay. And these fees add up. This is how you get to the 330% APR that was mentioned by Mr. Lynch. This is a very bad piece of legislation. Regrettably, I say it, Mr. Chairman, and I cannot support it. And I joined this 191 group of labor, civil rights, consumer, legal services, and community groups, as well as academics, in opposing the legislation. I yield.
Gentleman yields back. Does anyone seek further recognition? I'll recognize myself for 5 minutes. A couple topics here that I think are worthy. We continue to talk about the fees associated. The beauty of putting this bill forward is actually sets forward a mandatory free option. Free is free. It's kind of a great option. And so we put forward that option in here to make sure that we would address some of the concerns, I think, of all of us, to make sure that there is an avenue for workers to be protected.
Would the chairman yield?
Not at this time. I think it's important to know, we've heard a long list from my colleagues of people that oppose the bill. I'd bring attention to the Las Vegas branch of the NAACP. Nevada has put forward legislation that regulates earned wage access. And in that, there's a discussion about whether or not we should be expanding this beyond just employer EWA, which is why this is needed, because there's a framework for employers, there's not for non-employers. And in the letter from the NAACP, they write this argument dismisses viable EWA models in favor of a single cherry-picked model. For workers in dire financial straits due to the timing of their employer's pay cycle, solutions that wholly depend on the arbitrary decision of that same employer to participate is not viable. In short, it's anti-worker. And that's from the Las Vegas branch of the NAACP. And so what we're seeing is a need to put forward a framework on this. Then I would jump out and look big picture as to what this amendment does, and I think it's quite ill-advised. In fact, what it really does is abdicates the role of the legislative branch to the CFPB. So if my colleague has a thoughtful amendment that they would like to make, or a discussion to make this bill better, open to the dialogue. I obviously came forward with my rules of the road that protect workers, encourage work, make sure that we're providing a free option, a series of reforms that I think are actually really productive. Simply advocating this to the CFPB, I think, is quite foolhardy. We were elected by people across this country to put forward rules and regulations to their benefit. My colleagues on the left, if they support this amendment, would simply be supporting a regulatory state abdicating their role as members of Congress to put forward rules and guidance in the event that we can protect consumers, which is, or can protect workers, which is exactly what the underlying bill does. It's interesting, having been here now a small handful of years, watching whether or not people appreciate or not appreciate the CFPB on the left side of the aisle. When there is a Republican-appointed CFPB director, I hear a lot of complaints about the CFPB. When there is a Democratic-appointed CFPB director, I hear a lot of interest in having the CFPB move forward on the rules and regulations. And so in the event that a Republican-appointed CFPB administrator came in or director came in, I wonder if we would hear a whole host of concerns from my colleagues on the left about the rules and regulations they would put forward. My view is let's not send it to either of them. Let's sit down and actually find the rules and regulations that work. This legislation was through a series of conversations with a whole host of individuals on both sides of the aisle, trying to reach a resolution to allow workers to obtain the benefits for which they work, providing a free option, protecting workers so that there is no recourse, and in so doing, putting forward a regulatory environment that protects workers and encourages innovation in a pro-work manner. And so I would love to see engagement from those on the left. Instead, what we see is stonewalling, pushback against innovation, and then the oldest game in the book, which is this amendment, which simply does the Washington salute, which, for the record, would be to point to anybody but to ourselves. And that is really probably one of the most frustrating aspects of this town, is rather than coming forward with rules and regulations that work, that protect consumers, protect workers, which this bill does, simply advocating this to unelected bureaucrats. I just could not disagree more on the broader philosophical topic than my colleague's amendment has brought forward. I yield back. The gentleman, Mr. Sherman, seeks recognition for what purpose?
I'd like to strike the last word.
The gentleman's recognized for 5 minutes.
And I yield to the gentleman from Texas.
Thank you, Mr. Sherman. Greatly appreciate your kindness. Let's examine the free option. What the chairman did not mention is that the option is free if you choose not to have the expedited loan. If you choose to have the expedited loan, which means you can get your right now money right now, if you choose to do this, then you pay a fee. The people who are most likely to be harmed are the people who need the money today. They've had the problems that have been called to our attention. And if they're to get it today, they have to pay the fee. Well, they can't wait. That's why I've said that they become persons who no longer live from paycheck to paycheck, but rather from day check or day loan to day loan, because they need money right now, and they are the most vulnerable, and we should not take advantage of the needy under these circumstances. No abdication. There is no abdication to the CFPB. The CFPB has the authority to look into this and promulgate, promote, produce proper rules and regulations. After the CFPB has had its opportunity to do so, if you're not pleased, you can produce legislation. This does not prevent legislation, but it does allow the Consumer Financial Protection Bureau the entity charged with the duty, responsibility, and obligation of protecting consumers to do just that, protect consumers. I've always stood for the CFPB, still do, but this notion that somehow we are passing over our authority or our need to legislate to them is just not the case. And I would also, again, reiterate that the free option is only free if you don't need the money right away. If you do, it is no longer free. I yield back.
The gentleman yields back. Does Mr.
I'm sorry. I'll yield to the gentleman from Massachusetts. I've got my own 5 minutes, I think, right? Yeah.
To strike the last word?
Strike the last words, please.
The gentleman's recognized to strike the last word for 5 minutes.
Thanks, Mr. Chairman. The one thing that sticks out to me is, you try to get a sense of what's the real impact on workers. And so the California study I thought was extremely helpful to try to sift through this. So California data based on, so they did 6 million transactions. They looked at 6 million transactions by these earned wage access companies. They added not only employer-based, but also these other independent companies that collect tips and all that. And they figured out the annual percentage rate that these companies were charging workers. And they found that, and so it's a pretty broad study, 6 million transactions. The average percentage rate that they were charging these consumers was over 330%. That is jaw-dropping. That should be a crime, but it's not. So I don't understand how stopping that would be anti-worker, because that's just robbery. I used to represent workers for a living when I was with the Ironworkers Union, and that would be an unfair labor practice right there, charging people 330% annual percentage rate for getting their money early. I would just say that, look, I understand the gentleman's remarks about sort of the inability of us to work together sometimes, and I just want to add that I was here during the debate about the CFPB, the Consumer Financial Protection Bureau. It was a war here to create one agency. Of all the agencies that we have in our government today, there's one that is built and designed to protect consumers in the financial services space. And I won't be, let me be kind. My Republican colleagues were totally against the creation, in unison, they were totally against the creation of the CFPB, the Consumer Financial Protection Bureau. They did not want it to be created from day one. So I'm not surprised that they would not want the CFPB to do this analysis and figure out a rule and some guidelines to address this, the growth in this industry of our early wage access products. But I think, if we got more studies like the one in California that said, they're charging over 330%, we might be able to design collectively or at least vet what the guidance that does come out of that process recommends. We would have additional examples. We could sit them there at CFPB and say, okay, how did you come up with this result, and what was the analysis that you used? I think that would be helpful. That would be doing our job. We could even ask them to expedite it if time is the issue. Tell them, give them a date certain. Come up here and show us what your results are, because we want action on this right now. That's not what I'm seeing, and I think it's a missed opportunity, because I think people are being harmed out there. I think there's a lot of opportunity in this space. There are companies in this space that are doing the right thing, that are trying to, provide a service at reasonable costs. And if we could encourage that type of activity, this technology could actually help people. I'm not arguing against that. I'm just saying that there have to be guardrails that induce companies to do the right thing, rather than letting them charge people 330% annual percentage rate interest, on their early payday loans. That's all I got. I'll yield back. Thank you.
The gentleman yields back. The gentleman from Kentucky is recognized for 5
Move
minutes.
to strike the last word.
Is recognized to strike the last word for 5 minutes.
Well, the gentleman from Massachusetts' analysis is wrong. An APR doesn't apply to a non-credit product. That's the problem with the analysis. That's the flaw in his argument. And those Republicans that he cites opposing the creation of the CFPB become more and more prescient as the years go by, and we see how harmful the CFPB is to consumers that they're supposed to protect. Because instead of actually protecting a competitive marketplace where Americans who need access to products to enable them to meet, to make ends meet, the CFPB is eliminating access to those products, whether they're credit products or earned wage access products like these. And because we're experiencing 40-year high inflation, these products are more in demand than ever before, because the inflation crisis that this administration has hoisted upon the American people require more Americans to have early access to their wages that don't go as far as they used to because of Biden's inflation. So let's stop applying an APR analysis to products that aren't credit products. And with that, I would yield to my friend, the author of the legislation I support, the gentleman from Wisconsin.
I appreciate the gentleman yielding. We've heard a little bit of some studies that are out there. I think it's worth looking at the FTI consulting study on this, and in particular, it'll note that 80% of EWA services help the workers save money on overdraft fees. So I think one of the questions is, what do people do when they do need money in short order? There's not a utopia. Money doesn't come out of a tree. So then the real world question becomes, what do they do? What are the options? And in this FTI study, it looks back and says that if EWA weren't available, users would consider, number one, not paying certain bills on time. As we know, that is detrimental for the long-term credit of an individual. Two, 38% would overdraft. As we know, there's fees associated with that. That often makes people in the long run end up going backwards. And then the third was 35% was a payday loan, which is an option for individuals, but it's definitely not the best option that we would think is out there in the total world. So as we look at EWA as a product that is available to consumers, it's a product that really addresses how do people get by in a pinch. In a utopia, you wouldn't have somebody in that situation. In the real world, people do find themselves in that situation far too often, as noted by my colleague, Mr. Barr, in large part because of the inflation that's been brought on, where everything's almost 20% more expensive than it was when President Biden came to office. But if we look at how do we address this, how do we leverage the technology that's before us, what I was trying to do is what was been discussed, put forward guidance, put forward guardrails to protect workers, allow further innovation in this space under the guise of allowing Congress to work its will to make sure we're protecting consumers and allowing innovation. I think the bill as drafted does that, and it's the reason that we have a great opportunity to put forward a structured framework to help workers and avoid some of the other challenges that they might face in the event that they had an unexpected expense, and to allow them an alternative to an overdraft, a payday loan, or abandoning or not paying a bill on time, because we know the negative consequences of those three options. This in many ways provides an alternative that is a positive step for many people. And again, in the legislation, we require the free option, again, a guardrail, an innovation to make sure that we're working to protect consumers. And so, although I won't be supporting the underlying amendment from my colleague, Mr. Green, I do think ultimately this legislation moves us in the right direction, uses the authority of Congress to provide worker protections and innovation in this space, and more directly connect workers to the fruit of their labor. I yield back to my colleague, Mr. Barr.
I appreciate the gentleman's work on this bill. Again, I support the legislation, and I would just kind of conclude by just saying, look, there's a reason why Republicans were critical of the idea of the CFPB at the outset of its creation, and they appear to be more and more prescient every day, and that is that instead of protecting consumers, the Bureau seeks to take away products and services that are in demand with the American people. And with that, I yield.
The gentleman yields back. Is there further amendment or debate? If not, the question now occurs on the amendment offered by the gentleman from Texas, Mr. Green. All those in favor of the amendment shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chairs, the nay have.
Chairman, a recorded vote is requested.
Recorded vote is requested. All those in favor of recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee's rule. Further proceedings on the amendment are postponed. Is there further amendment or discussion? There being no further amendments, without objection, the previous question is ordered and recorded votes on the pending amendments have been postponed. Once those votes are taken, the committee will immediately consider the question to report the measure.
Pursuant to notice, I call up H.R. 4206, the Bank Safety Act of 2023, introduced by the gentleman from California, Mr. Sherman. The clerk will report the bill, which is distributed in advance.
H.R. 4206, to amend the Financial Stability Act of 2010 to require covered financial institutions to include elements of accumulated other comprehensive income.
Without objection, the bill is considered as read and open amendment at any point. The gentleman from California has an amendment of the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment.
Amendment in the nature of a substitute.
Without objection, the amendment is considered as read and will serve as base text for purposes of amendment. The gentleman from California, Mr. Sherman, is recognized for 5 minutes.
Thank you. This is a bill that is consistent with some of the Basel III, or one of the Basel III proposals. Members of this committee know that I haven't hesitated to criticize certain elements in the Basel III proposals, but this is one that makes complete sense. It simply says that if a bank with over $100 billion in capital has securities available for sale, that they need to mark to market the real value of those securities. It takes away the view of somebody saying, well, we paid $100 million for them, for these securities, and they're not worth that in the market, but somehow we'd like to think they were still worth what we paid for them. Marketable securities are worth what they're for sale for in the market. Now, we've worked with industry on this. They have asked for a gradual phase-in. This bill, consistent with the Basel III Endgame proposal, says that it becomes fully effective July 1, 2028. So we have a long phase-in for this change. As the only CPA on the committee, it's particularly important to me that what this bill does is it makes regulatory accounting mirror generally accepted accounting principles. Banks already use this system of accounting in their GAAP, or generally accepted accounting principle, financial statements, which are the ones they provide to their shareholders and which are the basis on which shareholders buy or sell their stock. And officers do or do not get bonuses, usually tied to stock price. It makes sense for the same accounting procedures to be used for the regulators, for the regulatory accounting principles. Now, the Bank Policy Institute not known as a wildly progressive organization, but in fact, really the think tank for the banks, paid for by the banks, included addressing this issue in their listed recommendations on capital requirements in June 2023. The Federal Reserve of New York has done a study on this proposal, since it already applies to the largest banks. They concluded that banks are more likely to hedge their securities. What does that mean? That means if they invest in 10-year bonds, 30-year bonds, and there's the possibility that they will decline in value, and they're holding them in their available for sale account, which means it's available to meet the cash needs of the bank, that they will buy insurance against the possibility that those securities will decline. And that is exactly what they need to do. And the case study for us is Silicon Valley Bank. When we first heard that Silicon Valley Bank was in trouble, we thought, oh, maybe they lent money to small and medium-sized businesses and they chose the wrong ones. That's not what happened. They were doing fine on their business lending, but they had a large portfolio of long-term U.S. Treasuries that had declined nearly $2 billion in value, and that is why Silicon Valley Bank is no more. But they had insurance. They sold the insurance earlier that year. So this says that if a bank is going to hold these long-term bonds, and I know they're treasuries, in theory you don't lose money. You do lose money if you sell them before maturity, and these are securities that are being held for the purpose of being available for sale before sale for maturity. So let us, now that we've seen the example of Silicon Valley Bank, not only the effect on the bank, but the effect on our economy, let us say that we want a system that encourages banks, if they're going to hold these long-term bonds, to get insurance that the bonds may go down in value. Or alternatively, they can invest in shorter-term treasuries. I yield back.
Gentleman yields back. Further discussion, further debate. Gentleman from Kentucky.
Move to strike the last word.
The gentleman's recognized.
Well, thank you. Just very briefly, I thank the gentleman from California for offering a proposal that is actually responsive to what we saw in March of 2023. Unlike the Basel III Endgame proposal, which is largely a regulatory non sequitur and attempts to put massive new capital requirements on an already well-capitalized banking system, the gentleman from California's legislation responds to interest rate risk, and as we saw with Silicon Valley Bank, interest rate mismanagement was really at the core of that crisis. And for the sake of time and efficiency, I would ask unanimous consent, Mr. Chairman, that a more fulsome written statement be submitted for the record.
Without objection. Will the gentleman yield?
I will.
The gentleman's done.
I am. I will yield.
I appreciate the gentleman's comments, and I concur. And I want to commend the author of this bill. It is responsive to what we learned as a result of the failures in March of last year. It is, I think, a consensus understanding among Republicans and Democrats on this committee who've taken time to study, that this was of direct concern to the institutions that took advantage of what was theirs to take advantage of, and they worked with their regulators on. And it was an obvious hole in their balance sheet that we should have been, in the public and the regulators should have been more savvy to, and we should correct this error. And we should do it in a measured way, in conformance with the economic reality. And from time to time, the author of this amendment gets his way on accounting principles in this committee, which is usually a good thing. And this is another one of those circumstances where his accounting expertise comes in quite handy. And so I want to thank the chair of the Financial Institutions Subcommittee for yielding.
If the gentleman would yield, I would inquire of the chairman whether he would advise me to seek a recorded vote. I want this bill to be able to be considered under a suspension, and would intend to ask for a recorded vote unless advised otherwise.
That is up to the gentleman for his request.
And I would also ask unanimous consent to put in the record this article from the Federal Reserve, what happens when regulatory capital is marked to market.
Without objection.
Yield back.
Does the gentleman from Kentucky yield back, or?
I yield.
2 minutes. Gentleman yields. Further discussion, further debate?
Take the win.
I appreciate you, Al. No further discussion, no further debate or amendment to the bill. The question now occurs on the adoption of the amendment in the nature of the substitute offered by the gentleman from California. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment in the nature of substitute is adopted. The question now occurs on ordering the bill, H.R. 4206, as amended, report of the House with a favorable recommendation. Those in favor shall signify by saying aye.
I ask for a recorded
Shall
vote.
signify by saying nay. Nay. In the opinion of the chair, the ayes have it. A recorded vote has been requested. Those in favor of a recorded vote shall raise their hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the Committee rules. The vote on this question is postponed. And then pursuant to the chair's previous order, we'll now take, we'll go pursuant to notice, we'll call up H.R. 4116, the Systemic Risk Authority Transparency Act, introduced by the gentleman to my right. I had to say it. The gentleman to my right, the gentleman from Texas, Mr. Green. Clerk will report the bill, which is distributed in advance.
H.R. 4116.
Without objection, the bill is considered read and open to amendment at any point. The gentleman from Texas has an amendment of the nature of substitute, copies of which were distributed in advance. Clerk will report the amendment.
Amendment in the nature of a substitute.
Without objection, the amendment is considered read and will serve as base text for purposes of amendment. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well, who's with us and seated to my right. I also thank the staff for the outstanding job that they've done to cause this piece of compromise legislation to come to fruition. And I did not mention it with reference to Mr. Sherman's bill, but I'd like to also thank you for the spirit of compromise that was shown as the bill was presented. Mr. Chairman, today I rise in strong support of H.R. 4116, the Systemic Risk Authority Transparency Act. This legislation was developed following failures of Silicon Valley Bank, SVB, and Signature Bank in 2023, when the Federal Deposit Insurance Corporation, the FDIC, invoked the systemic risk exception to guarantee uninsured deposits at those banks. Before 2023, the systemic risk exception was invoked on 5 occasions, all occurring between September 2008 and March 2009. To prevent further panic in the financial system following the collapse of SVB and Signature Bank, the FDIC chose not to follow its typical resolution process for failed banks, in which a failed bank is immediately sold to a competitor. On Friday, March 10th, 2023, the California Department of Financial Protection and Innovation closed SVB and, per the Federal Deposit Insurance Act, appointed the FDIC as receiver. The FDIC then established a bridge bank, Silicon Valley Bridge Bank, as it was noted, to which it transferred all SVB's insured and uninsured deposits. On Sunday, March 12th, the New York Department of Financial Services closed Signature Bank and appointed the FDIC as a receiver. The FDIC formed a second bridge bank, Signature Bridge Bank, and similarly transferred Signature's deposits and assets to it. On March 12th of 2023, the FDIC, that is the Federal Reserve, the Fed, and Treasury Department issued a joint statement announcing the innovation of a systemic risk exception enabling the FDIC to guarantee all uninsured deposits. The statement also noted that no losses would be borne by taxpayers, as any losses to the Deposit Insurance Fund would be recovered by a special assessment on banks. The Fed also announced a new bank term funding program on March 12, 2023, which would provide any bank with loans of up to 1 year on more favorable terms than the Fed offers banks through their facilities. These measures successfully prevented widespread panic in the financial system. H.R. 4116 would require that for any use of a systemic risk exception, the Government Accountability Office, the GAO, would have to produce the same post-failure report within 60 days of the invocation of a systemic risk exception and more comprehensive report in 180 days. Moreover, the appropriate bank regulator, including the FDIC, the OCC, or the Federal Reserve, will be required to issue a preliminary report within 90 days and a comprehensive report within 180 days. I applaud the GAO, the Fed, and FDIC for being transparent about what contributed to last year's bank failures in their reports to Congress. I wish to codify this transparency into law through this legislation. And Mr. Chairman, I thank you for what you have done to allow us to bring this to fruition. I'd like to thank the ranking member for what she has done, the staff, but I'd also like to mention that the ranking member did play a role in helping us to avoid the possibility of a financial crisis when these banks were failing. Mr. Chairman, I pray that this is a good piece of legislation that will be accepted and allowed to go to the floor. I yield back.
Gentleman yields back. Further discussion, further debate. Gentleman from Kentucky, Mr. Barr, seeks recognition. Gentleman from Kentucky speaks with his hands. I'm sorry, it's Mr. Race is encouraging. Further discussion, further debate. The ranking member, Mrs. Waters.
Thank you. I move to strike the last word.
Gentlelady is recognized.
I support Representative Green's bill, H.R. 4116, which will ensure if we have more bank failures in the future, Congress and the public will have the benefit of some kind of rapid and transparent reporting received, well, the same kind that we received from the GAO and federal banking regulators in the immediate aftermath of the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank 1 year ago. I was disappointed when Republicans immediately attacked our federal banking regulators shortly after last year's regional bank failures and claimed that they were not being transparent about what happened. To the contrary, the Federal Reserve and the FDIC issued robust and timely reports detailing the management, supervisory, and regulatory shortcomings that contributed to these bank failures. For example, the Fed's report revealed that SVB did not maintain nearly 2% more capital for its securities portfolio, which had a large amount of unrealized losses that they later had to sell and sparked a crippling bank run. In addition to those helpful reports, the agencies provided a large number of agency documents related to the bank failures. For example, the FDIC provided at least 4,000 pages of agency documents in 7 separate productions, and they provided our committee with access to an additional 46,000 pages of records. These bank reports supplemented the independent oversight work that the Government Accountability Office, or GAO, also provided at the request of Chairman McHenry and I. I'm glad the GAO is continuing its oversight work to investigate other aspects of those bank failures, like the role advances from the Federal Home Loan Bank may have played to inform additional reforms. This transparency and quick work by GAO and Biden's regulators should be celebrated, not denigrated. So I'm pleased that Republicans have worked with us to advance H.R. 4116 in this markup. I would encourage Republicans to build on this effort, working with committee Democrats to promptly advance other common sense reforms we have proposed, including on bank executive accountability, compensation, and deposit insurance reform. I urge all members to support H.R. 4116, and I yield back.
General yields back. Further discussion, further debate. Sorry. I was going to recognize myself to commend the gentleman. I move to strike the last word and recognize myself for 5 minutes. I want to thank the bill sponsor for offering this amendment. It gets at what we've learned as a direct result of what happened in March, and it shows that we need and shows that there's bipartisan agreement here on committee that we need more transparency from regulators. Regardless of administration, regardless of partisan control of the House, it's really important that we have better transparency to regulators' emergency responses and generally their decision-making. And so this is a very important and useful bill for the public good. And so I urge my colleagues to support it, and I thank the bill sponsor for offering it, and I yield back the balance of my time. Any further discussion, further debate, or amendment? The question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from Texas. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. The amendment is adopted. The question now occurs on ordering the bill as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it.
If I may, given that we have this expedited system of voting, I will ask for a vote.
A recorded vote is requested. All those in favor of a recorded vote, please raise their hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. Pursuant to notice, I call up H.J. Res. 127, a resolution providing for congressional disapproval under Chapter 8, Title 5, United States Code of the rules submitted by the Securities and Exchange Commission related to the enhancement and standardization of climate-related disclosures for investors, introduced by the gentleman from Michigan, Mr. Huizinga, the Subcommittee Oversight Chair. The clerk will report the resolution, which was distributed in advance.
H.J. Res. 127, providing for congressional disapproval under Chapter 8 of Title 5 United States Code of the rules submitted by the Securities and Exchange Commission relating to the enhancement and standardization of climate-related disclosures for investors. Joint resolution, providing for congressional disapproval under Chapter 8 of Title 5 United States Code of the rules submitted by the Securities and Exchange Commission relating to the enhancement and standardization of climate-related disclosures for investors. Resolved by the Senate and House of Representatives of the United States of America in Congress assembled, that Congress disapproves the rules submitted by the Securities and Exchange Commission relating to the enhancement and standardization of climate-related disclosure for investors, and such rules shall have no force or effect.
And without objection, the resolution is considered read. Myself, I'm going to recognize myself for 5 minutes for a statement on the H.J. Res. 127. So H.J. Res. 127 is accumulation of a 14-month investigation. I believe this is our 4th hearing on climate disclosure. Last year, the Subcommittee on Oversight and Investigations requested information from the Securities and Exchange Commission to help inform committee members about the SEC's authority to promulgate a rule on climate disclosure. Instead of cooperating with the committee's numerous requests, the commission played games, flooding committee staff with tens of thousands of pages of unresponsive documents and very few answers, and ultimately moved forward on an even larger 886-page final rule. Some might recall that I received my own congratulations letter to the chairman as one of those documents of, quote, openness. Only in Washington does a rule increase by nearly 400 pages, and it's celebrated as, quote unquote, narrowed. So in the 2 years since the climate disclosure rule was first proposed, we have witnessed an unprecedented assault on our capital markets. Let us make no mistake, the Commission finalized this rule despite no clear authorization from Congress. In a rush to appease the radical left, Chair Gensler finalized a rule that will increase the cost of being a publicly traded company by around 21%. And how did the chair respond to concerns surrounding his rule? He doubled down. Chair Gensler ignored the warning from the Supreme Court, which ruled in West Virginia versus EPA that the EPA exceeded its statutory authority, relying on ambiguity as constituting an implicit delegation from Congress. Chair Gensler then ignored the warning from the Fifth Circuit Federal Court of Appeals, which ruled against a separate SEC finalized rule about share repurchase disclosure. In that opinion, the court rightfully held that the, quote, the SEC acted arbitrarily and capriciously in violation of the Administrative Procedures Act when it failed to respond to petitioners' comments and failed to conduct proper cost-benefit analysis, close quote. And finally, Chair Gensler ignored his own Inspector General, who concluded that the SEC faced serious management and performance challenges, raising significant concerns that the agency was attempting to enact too many rules too quickly, in essence, flooding the zone. The fast-paced rulemaking over the last 2 years has raised serious questions about how important Gary Gensler views the internal economic analysis conducted by his agency. Additionally, the SEC's climate disclosure rule blatantly undermines the Commission's existing materiality standard. Under the principles-based materiality standard, a company must disclose information to prospective investors and shareholders so that they can make informed investment decisions. The SEC should not statutorily redefine the materiality standard to prescribe climate-related disclosures for all public companies, even when a reasonable investor would not find such information important to their investment and voting decisions. And I know some of my colleagues will say everything is material because it's the climate. Well, that is not what the law says. So, in just 9 days after the SEC finalized the climate disclosure rule, judges of the Fifth U.S. Circuit Court of Appeals granted a temporary stay. Then, before the ink had even dried on the final rule, the SEC voluntarily delayed implementation of its own rule to allow the numerous court challenges to move forward. And let me conclude with this. Although Chair Gensler has repeatedly reminded the public that he is not a, in his words, climate regulator under his leadership, the SEC has strayed very far from its clear statutory mission. Investors should know that the SEC's overreach will significantly hurt our economy while serving as a boon for special interest groups and far-left activists. Unless he radically alters this approach to our capital markets, Chair Gensler's legacy will be that of an overzealous bureaucrat who was repeatedly reined in by the courts. I urge members to immediately provide disapproval of the rule submitted by the Securities and Exchange Commission relating to the enhancement and standardization of climate-related disclosure for investors, and I yield back the balance of my time.
I'd like to strike the last word.
For what purpose? The gentlelady is recognized for 5
I
minutes.
move to strike the last word.
Gentlelady is recognized.
I strongly oppose H.J. Res. 127 because it would deny investors material information about the companies they're invested in and how these companies are faring, even as climate change and severe weather events worsen. Mr. Chair, climate change is real, and its impact on the financial health of public and private companies is real too. Investors have a right to know how the companies they own are impacted by this crisis and what they're doing in response to it. It was with these realities in mind that the SEC finalized its common sense climate risk disclosure rule last month. Instead of working in a bipartisan way, to empower investors with information about climate risk. My Republican colleagues now want to block America's investors from knowing key information about the stocks they own. And that's exactly what this resolution does. Ironically, Mr. Huizinga, who sponsored this resolution, also authored a bill last Congress that permitted the SEC to do exactly what the agency did, mandate that public companies disclose only climate-related disclosures that are, quote, material, unquote, to investors. During the markup debate in May 2021, Mr. Huizinga said, and I quote, "The SEC keeps investors safe by requiring that material information is not hidden from them," quote, unquote. He later said, quote, "The SEC's job is to determine whether a company adheres to transparency and gives material information," unquote. Well, Mr. Chairman, I have good news. The SEC's final rule conforms neatly to the standards previously laid by you, Mr. Huizinga. Based on the comments that the SEC received from investors, the rule concluded that climate-related information is important to investors. What's more, the final rule empowers companies to make disclosure decisions themselves. It says climate-related information should be dismissed only if, I repeat, only if the company finds information is material to the investors instead of claiming victory and congratulating the SEC for adhering to the standards set by the author's bill. Mr. Huizinga is now pushing for the rule's wholesale repeal and preventing the SEC from ever putting similar rules forth in the future. Now, none of us should be surprised. These actions are consistent with the aims of their chosen leader, the 4 times criminally indicted Donald Trump, whose Project 2025 plan includes dismantling federal and state climate policies, gutting the EPA, and making clean air and drinking water a luxury in our time. So I strongly urge my colleagues to vote no on this resolution. And I yield back the balance of my time.
Gentlelady yields back. For what purpose does the gentleman from California seek to be recognized?
I move to strike the last word.
The gentleman is recognized for 5 minutes.
Thank you very much, Mr. Chairman. I agree with the ranking member. I strongly oppose H.J. Res. 127. The SEC's climate rule is about standardizing the climate-related disclosures publicly traded companies must make so that regular people invested in the market can have access to the same information that businesses already are spending roughly $500,000 a year to access. Giving people more information is a good thing, not a bad thing. The reality is that climate change isn't just a threat to our planet, it's also a threat to our financial systems. Wildfires, floods, and hurricanes and the risk of future climate disasters have a significant impact on families' financial well-being. These are not far-left radicals. These are firefighters. These are police officers. These are teachers. These are regular investors. These are everybody in our country. We want to know this information. In fact, interestingly, this week I was able to talk to some insurers because they are having a difficult time insuring homes in California because of climate change, because of the wildfires. These are not far-left radicals. These are people that want this information because they invest. If you're a teacher, a firefighter, or anyone that's working to earn retirement for yourself and your family because of this rule, you will have more information to help you decide which companies to trust with your hard-earned savings. In issuing this rule, the SEC has remained true to the agency's mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Climate change also impacts anyone who has money invested in the market, including many, as I said, teachers, firefighters, with a pension, anyone who puts money away for a retirement account. So I appreciate very much what the SEC has done here, And talking about transparency and talking about giving people the opportunity to take a look at this rule and to comment, it was an enormous amount of time back and forth, and I think that they did a very good job. Obviously, there's some of us that wish that the rule would have gone further, scope 3 information, but you know what? I think this is a very good start. So I applaud the SEC. I applaud them for what they've done. It's clearly within their mandate. Clearly, opportunity is here to give information to investors that want this information, and I applaud them for what they do. Lastly, I would say this. There has been this notion of denying climate change for many, many decades, and finally, people are understanding that this is real. It has real impacts on our country and throughout the world. If you take a look at what's happening in Florida, how difficult it is now to get insurance, and the state of Florida could bankrupt itself if they do get a few hurricanes because insurance companies no longer want to invest in Florida because they know climate change has changed the situation. I was in the insurance business for a while, and I can tell you, we used to call catastrophes cats. And you used to have a 5-year cat, 10-year cat, 25-year cat, 50-year cat, 100-year cat. These 100-year catastrophes or cats are happening every 5 years now. The cost is dramatic. This information we have to have as investors. It is absolutely material. And again, I think the SEC did a very good job. I wish they would have gone further. But for the moment, I think that this is the right place to land. So again, I thank them for that, and I strongly urge opposition to H.J. Res. 127. With that, Mr. Chair, I thank you for the opportunity to give me to speak. Thank you.
Gentleman yields back. Gentleman yields back. Who else seeks recognition? For what purposes gentlemen from Illinois seek recognition?
Move to strike the last word.
The gentleman is recognized for 5 minutes.
This will surprise no one on the committee that I strongly oppose this CRA, and I wish we could stop having these conversations. Look, I get it. If you say the word climate change, we're immediately going to fire off all our partisanship. But this bill is not about climate change. It is not about materiality. This bill is about whether or not we think that the SEC should respond to investor requests and should protect investors. That's it. Now, if you think, as we just heard, that this bill moved too quickly, I would point out to you that investors first asked the SEC to take up this issue in 2003. We've been waiting 2 decades to act on this. I don't think that's too quick. If you think that investors don't care about this, that somehow this is the SEC steamrolling investor interests, I would point out to you that investors representing $50 trillion with a T dollars in assets are overwhelmingly in support of this rule. Ceres did a survey. 97% of those investors, $50 trillion in assets, supported the initial rule. 99% of them supported Scope 1 and Scope 2 as was in the final rule. That sounds like investors want this, and they like what the SEC did. 24,000 people commented. That's a rigorous process. If you think that disclosure costs money, and therefore we shouldn't do it, I agree with you. The average public company today is spending $500,000 a year trying to comply with the fact that there's all these different voluntary disclosures that those $50 trillion of investors would like them to come to, but they can't get a consistent set of rules. And so what the SEC would do in this is actually provide consistent reporting standards as investors would like to have, as accounting standards demand. What in God's name are we arguing about here? And oh, by the way, if you also, as I've heard some people say, are of the opinion that even though they didn't include Scope 3 is really a backdoor, and that is going to hurt small farmers who are going to be hurt, I would like to introduce you for the record the word of small farmers. World of Small Farmers says the final rule is considered a victory for farmers and ranchers. I'd like to introduce for the record Ag Escapes SEC Emission Reporting Rule from the American Farm Bureau. Why do investors want this? Because investors would like to identify and hedge risk. If you have your portfolio is exposed to a risk, you'd like to know which companies in your portfolio are exposed to that risk so that you can not be exposed to that risk. If you don't want to be exposed to that risk, you'd like to know which companies in your portfolio are contributing to that risk so that you can hedge out accordingly. To oppose climate disclosure makes as much sense as opposing, I don't know, rules to standardize GAAP accounting. This is so stupid. It is childish. It is back to 30 years ago when you could proudly stand up as a Republican and say, I deny that the climate is changing. Here's a snowball I found today. Thankfully, you can't do that anymore. But what is this? It's the same thing. Don't vote for this bill. Let the SEC do their job. Look out for investors. And if you do all that, I promise I'll never call it a climate rule. I'll just call it an investor protection rule, because that's what they want. I yield back.
Gentleman yields back. For what purpose does the gentleman from Arkansas seek recognition?
Strike the last word.
Gentleman from Arkansas is recognized for 5 minutes.
I thank the chairman and appreciate the debate and commend him for sending a message from the Article 1 power of the House and the Senate, the legislative branch, to a message to our regulatory agencies to stay very much in their lane. And when they, whereas certainly the commission followed the Administrative Procedures Act here, but this was such a colossal rewrite of a very complicated rule with major changes, in my judgment. It deserves, obviously, to be thought about very carefully in terms of reproposal and how that's put back out for comment. And I think the chairman makes some very good points in why he has his H.J. Res today. So I support Chairman Huizinga's effort here and his work to ensure that we do inform investors, absolutely, but only in a material instinct, and that we don't start having liability for very difficult to ascertain valuation analysis that could be not material but produce still a great deal of tort liability in the system. So let me yield to the gentleman from Michigan for his additional thoughts after hearing from our colleagues.
Yeah, I appreciate the gentleman from Arkansas yielding, and I think what maybe has been frustrating for a number of us who have been talking about this rule and the materiality of it is that this is somehow cast as a anti-environment position. And that's simply not the case. What this is an anti-expansionist of power without congressional authorization. And as the gentleman from Arkansas and frankly a gentleman from Illinois just had noted, there was over 24,000 comments on the proposed climate rule. This is one of the largest responses that the SEC has ever received. One of the largest responses. And yet they just then moved ahead. Well, what we're hearing from some of those 24,000 respondents is, wait a minute, this has changed now, so we have to go back and recalculate. We have to go back and figure out what the effects are going to be. And despite what the article that was submitted, and despite what some on the other side have said, there is very strong evidence that the essence of Scope 3 is still captured into much of that reporting. And that needs to be explored. And I will just note that under the Administrative Procedures Act, among other things, courts must set aside agency actions found to be 1, arbitrary and capricious, 2, in excess of an agency's statutory authority, which absolutely this is part of where that problem is. And number 3, promulgated without observance of the procedure required by law. I would argue that the APA demands that this be re-put to comment. And as far as what some of my friends are saying of, well, everything is material because everything is affected by the environment, and therefore we need to know every piece of information about every company. Well, history disagrees with that. Current law disagrees with that. And more recently, the courts have disagreed with that. So I embrace materiality. Materiality is the fundamental element of what it means to be an investor, disclosure, regime that we have here in the United States. So I appreciate the gentleman from Arkansas yielding, and I yield back to him.
I thank the chairman, and I think you make some good points. One other one I would recognize inside this domain of the Administrative Procedures Act and the role of Congress to have oversight and strict direction of the cabinet agencies and the independent regulatory agencies. And I've seen this during this Congress on a bipartisan basis. Reasonable comment period times, reasonable analysis. And we haven't seen that in this case, although they extended it. But this reproposal is so important, the chairman references. And the final thing is, where is Congress on a bipartisan basis willingness to hold a strict account how to have an effective cost-benefit analysis? And I think that's very much in doubt in this instance, and how to do that and measure it in a way that's comparable across all industries. I thank my friend for his comments, and I return my time to the chair.
The gentleman's time has expired. Is there any further comment? Seeing none, there being no further debate. Oh, sure. For what purpose does the gentleman from Kentucky seek recognition? A gentleman moves to strike the last word and is recognized for 5 minutes.
I missed some of the debate, but I just want to make one point here. Much has been made about the need for comparability and consistency in disclosures related to emissions and climate stewardship from public companies. And in fact, that's the primary argument that I think is the right argument for the SEC to try to make to justify this 800-page monstrosity that's going to create massive litigation risk and compliance costs for public companies and discourage private companies from going public and encourage public companies to go private. But I would just make the point that in the final rule, Chairman Gensler, the stated goal of comparability and consistency, and the commission fails in a breathtaking and spectacular manner to achieve that result because of the ambiguity. We had a great oversight hearing where securities lawyers were asked to comment on this, and the confusion and the difficulty that public companies are already voicing to their counsel, to their accountants, that this rule will create more problems, not less, and confuse investors and inundate them with a torrent of non-material information and confusing information because there's so many different and varied and disparate standards for emissions. And because there's a lack of definition in the rulemaking on certain issues that they're requiring to be disclosed, not only will there will not be comparability, but nobody is going to really understand who's greenwashing and who's not as a result of this rule. What it will do, what it will achieve, is a huge additional litigation risk for public companies, and a lot of over-reporting to prevent litigation. And that over-reporting and that additional litigation and that additional compliance costs, you know who that hurts? It hurts the shareholders of these public companies. The mission, for crying out loud, of the Securities and Exchange Commission is to protect investors. And all this is going to do is diminish returns for retail investors. So the commission, no matter how well-intentioned they are, no matter how well-intentioned my good friend Mr. Kasten and other devotees of Mr. Vargas are to protect the planet from these polluters, this is not going to protect the planet. It's going to result in a lot less trees because of all of the additional paper that's going to be required to send to shareholders that they're going to throw in the trash because they don't care about this. And for those investors who do care about one single issue, they're not the reasonable investor. The reasonable investor, the vast majority of retail investors in this country, what they care about is the retirement security. They don't want the companies that they're invested in to be diverted from their core business to lawyers and accountants and compliance costs that divert their attention to their core business, which is to deliver earnings and profits to maximize shareholder value. And so the commission has totally missed the mark here, and they're certainly disrupting markets. They're certainly creating more confusion with this rulemaking, and certainly not protecting investors. They're hurting investors, and that's why I support the gentleman from Michigan, and I compliment Chairman Huizinga on his excellent work to highlight the core flaws of this proposal. With that, I yield.
Gentleman yields back. Is there any further debate? Seeing none. Sorry, for what purpose? If you can just hold just a moment.
Mr. Chairman,
For what purpose does the gentlelady from Texas?
I move to strike the last word.
The gentlelady is recognized for 5 minutes.
I yield my time to the ranking member.
Why wasn't she talking?
Oh, she's yielding to you. So what? She's yielding to you.
The gentlelady from Texas is
Okay,
yielded to the ranking member.
I think she should, yeah. Thank you very much. Mr. Chairman, I welcome Mr. Barr to this debate. Like I said in my earlier comments, he too should be congratulating the SEC for adhering to an amendment he offered at a markup in May 2021. During that markup, when Mr. Caston's climate risk disclosure bill was being debated, Mr. Barr offered an amendment that said Mr. Caston's bill should only apply if companies find that climate-related information to be material. He said, quote, "We must ensure any disclosure meets the materiality standard," quote unquote. Well, again, the final rule would only apply to those companies that they themselves determine that the climate-related information is material to their investors. And with that, I yield back to her. I yield back to the gentlelady from Texas.
I yield back.
Gentlelady from Texas yields back. Is there any further debate? What purpose is the gentleman from Pennsylvania? Gentleman is recognized for 5 minutes.
I too urge my colleagues to support H.J. Res. 127, introduced by Mr. Huizinga, aimed at disapproving a rule by the SEC concerning the enhancement and standardization of climate-related disclosures for investors. It appears that being an opponent of this rule somehow classifies those members as not believing in climate change. Couldn't be anything further from the truth, regardless of how many times it's said. The SEC's rule strays significantly outside of its traditional purview and expertise. This rule positions the SEC as an environmental regulator, a role it is not equipped for, nor was it the intention of the SEC to be an environmental regulator. It is an overreach. It complicates the regulatory environment. It imposes risks and burdens on entities it claims to be trying to assist. Moreover, the potential implications for investors are concerning. By imposing stringent, onerous requirements on climate-related disclosures, the rule risks clamping down on innovation within the energy sector, innovation that is vital to environmental sustainability. And frankly, that's the only way carbon emissions are going to be significantly curbed, through innovation in the private sector. So last week in a hearing, a large portion of or many of the energy companies expressed, after I asked what was their R&D budget, they said it was for minimizing emissions. It's through the roof. It's some of the largest expenditures that we could have, or that they have, because it matters for the social impacts, as well as for their employees, and simply the right thing to do. So, it's essential that the broader economic context in which this rule is being proposed be considered, not to mention the fact that this rule largely focuses and increases and puts burdens on groceries and gasoline, the two items, the two commodities, if you will, that are escalating in price and causing inflation. So it's a bad idea. The SEC's in overreach position here, and this rule will do more harm than good. I yield back, Mr. Chairman.
The gentleman yields back. Is there any further debate? Seeing no further debate, the question now occurs on ordering H.J. Res. 127 reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. And all those opposed shall signify by saying nay.
No.
In the opinion of the chair, the ayes have it. For what purpose does the gentlelady seek recognition?
I would request a recorded vote.
A recorded vote has been requested. All those in favor of a recorded vote, please raise your hand. Seeing sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the Committee on Rules, the vote on this question is postponed. You want me to call it up and then have them read? All right.
Pursuant to notice, I call up H.J. Res. 122, a resolution providing for congressional disapproval under Chapter 8, Title 5, United States Code of the rules submitted by the Consumer Financial Protection Bureau relating to credit card penalty fees, introduced by the gentleman from Kentucky, Mr. Barr. The clerk will report the resolution, which was distributed in advance.
H.J. Res. 122, providing for congressional disapproval under Chapter 8 of Title 5, United States Code of the rules submitted by the Bureau of Consumer Financial Protection relating to credit card penalty fees.
Without objection, the resolution is considered read. I recognize myself for 5 minutes in support of my resolution. I urge all my colleagues to support H.J. Resolution 122, the Congressional Review Act resolution to nullify the CFPB's disastrous credit card late fee rule. Yesterday, we had a hearing about oversight of the CFPB, and the Democratic witness asked, why would anybody be against reducing late fees? Reducing late fees makes things easier for people who pay late. But the problem is, to help push the Biden administration's war on so-called junk fees using weapons of junk economics, the CFPB has actually penalized Americans who pay their credit cards on time and are trying to build credit for a better financial future. The late fee rule, which cuts the safe harbor for late fees from $30 to $8, will result in on-time borrowers subsidizing those who do not pay on time. Only in Joe Biden's world is that fair, to punish people who do the right thing in order to subsidize people who pay late. It will result in increased costs of and decreased access to credit products and a negative shift in consumer behavior where individuals are actually incentivized to take on additional debt. That is not helpful to consumers. This increased debt will lead to lower credit scores, which in turn hampers one's ability to achieve the goal of home ownership, finance a car, and access credit in other capacities. Unfortunately, the current administration does not believe in the concept of repaying debt that it is owed. But today we have an opportunity to advance legislation that ensures these negative outcomes are not borne by consumers. Strikingly, a study has found that nearly 50% of subprime cardholders pay their bills on time. I'll repeat, 50% of subprime credit card owners pay their bills on time. But because of the CFPB's coordinated attack on late fees, these very subprime borrowers who rely on these credit products for day-to-day expenses and the hope for financial elevation in the future will now be charged higher APRs that will inhibit their ability to pay on time. This is why we say this is junk economics. So today I ask my colleagues, do we want subprime borrowers to be disadvantaged? Do we want credit accessibility to be more expensive or unattainable for Americans? Do we want to increase debt burdens on everyday Americans? The answer to all of these questions should be no. To ensure that these bad outcomes don't occur, though, we must pass this resolution to nullify the CFPB's credit card late fee rule. I ask now for unanimous consent to insert letters of support from the following organizations: Americans for Tax Reform, the U.S. Chamber of Commerce, the Consumer Bankers Association, America's Credit Unions, the Bank Policy Institute, the American Bankers Association, the Independent Community Bankers of America, and the Defense Credit Union Council. Without objection, those letters of endorsement of this resolution are submitted for the record. And I will just conclude in support of this resolution of disapproval by saying this. We should not want our consumer protection agencies to encourage bad financial behavior. We should not want our consumer protection agencies to discourage Americans from paying on time, to build up their credit, to achieve financial independence. We should not want our consumer protection agencies to take actions that limit the financial options available to the American people or make access to credit cards more difficult or increase the cost to responsible credit card borrowers. But that is exactly what's happening here. And for the 50% of Americans who live paycheck to paycheck, who might carry a credit card balance, who are subprime borrowers, but pay on time, every month they get that bill. Responsible owners of credit cards. This rule punishes them. How in the world does that fulfill the mission of the Consumer Financial Protection Bureau? To take away credit cards, to take away options, and to increase cost for responsible, maybe subprime, maybe struggling people who need access to credit cards. How is that protecting consumers? Well, the answer is obvious. It doesn't protect consumers. And it actually encourages people to trash their own credit. It's disgraceful. That's why we need to pass this resolution of disapproval, and I yield back. The gentlewoman from California, Ranking Member Waters, is now recognized.
I move to strike the last word. I strongly oppose this anti-consumer resolution, H.J. Res. 122. It would rescind a final rule issued by the Consumer Financial Protection Bureau to limit junk fees. Specifically, the rule would generally limit credit card companies' late fees to $8. Today, credit card companies charge between $32 and $40. The rule only applies to the largest credit card issuers that have more than 1 million accounts, and it permits them to charge a higher fee only if they demonstrate it is reasonable and proportional to the delayed payment. This is part of the CFPB's work to combat junk fees alongside other agencies and the Biden administration. While mega banks and congressional Republicans may not like it, the American people support the CFPB and their junk fee initiative. Let's put this initiative into perspective. While House Democrats have held hearings after hearings to attack the Basel III endgame proposal that would strengthen the safety and soundness of our banking system, that rulemaking received only about 400 comments. On junk fees, the CFPB has received 200 times the amount of comments from the public, specifically receiving more than 80,000 comments. Let me give you one example. a consumer in Stroudsburg, Pennsylvania, wrote, quote, "Credit card fees must be limited now. I have personally been subject to outrageous late fees when I was even a couple of hours late to pay my fees simply because I remembered I needed to pay but forgot when the cutoff time for payments was. For some cards, it's 6 p.m., for some, it's 8, for some, it's midnight. How are we supposed to remember? I hate to think of someone with 2 jobs and children and many responsibilities being charged $30 just because the credit card payment time or date slipped their mind," end quote. And even 4 out of 5 Republicans support the CFPB and its work. Why is that? Because nearly all Republicans, except the ones sitting in this room, apparently are like the rest of us and don't like to be ripped off or charged junk fees. And I want a strong federal watchdog who has our back. Today, most large credit card companies typically charge anywhere from $32 if you're late on your credit and card payment. But the CFPB found in its research that this amount far exceeds what is reasonable and proportional to the violation. So, PFB's rule will generally lower those fees to $8, and a credit card company can charge more than $8 so long as they demonstrate it is reasonable and proportional. This rule will save consumers more than $10 billion annually, or $220 every year, for more than 45 million people typically charge these fees. Additionally, I would remind my colleagues that since this is a CRA resolution, it not only will take $10 billion of annual savings out of the pockets of consumers, but it will also prevent the CFPB from taking similar action to protect consumers without a further act of Congress. And honestly, that seems to be the main objective of committee Republicans. So I urge members to reject this resolution and respect the wishes of your constituents to not get ripped off or saddled with completely unreasonable and unfair junk fees charged by large credit card companies. Thank you, and I yield back.
Gentlelady yields back. For what purpose does the gentleman from Pennsylvania seek recognition? Gentleman yields, and I want to engage in a rhetorical question that I'll be directing to my friend, the ranking member, about the $10 billion. Because she's right that when you lower late fees for people who pay late, they're not going to pay as much late fees. And she cites a statistic of $10 billion. So where does that $10 billion come from? That's the question. That's the question for the ranking member. I'll tell you where it's going to come from. It's going to come from consumers who pay on time. That $10 billion is coming out of their pocket because they're going to lose access to credit cards and they're going to pay a higher interest rate. Banks aren't going to pay that. That $10 billion is, yes, it's coming off those folks who pay late, but the people who pay on time, and 50% of subprime credit card borrowers are going to pay more. So people living paycheck to paycheck who need a credit card, they're going to lose their credit cards, and those who don't lose their credit cards, they're going to be paying that $10 billion. What is the fairness in that? Not fair, not protecting consumers, certainly not protecting responsible consumers. So here's some facts to consider here. The Bureau itself, in issuing this rule, they actually recognize the economics that maybe some of our friends on the other side defending the Bureau don't understand. The Bureau, which had scant economic analysis here, still admit and acknowledge that cardholders who never pay late, which the CFPB's own data indicates that is 74% of all Americans with credit cards, will not benefit from the reduced fees and could experience, quote, higher maintenance fees, lower rewards, or higher interest on interest-paying accounts. So think about that. 74% of all Americans who will never benefit from this proposed rule because they pay on time. What will they experience as a result? The vast majority of credit card holders, both prime and subprime, What will they experience? They will experience higher fees, lower rewards, and higher interest rates. How does that protect the responsible owners of credit cards? It does not. It does not. So the CFPB itself concedes that this is bad for 74% of all consumer credit card accounts. Now, what about the people who do save the $10 billion? Is it really worth it for them to ultimately lose access to credit cards? Is it really worth it to them because they save a little bit on a late fee that they'll actually be encouraged to pay late and have their credit cards go down the toilet? Is that really protecting them because they save $20 on a late fee and then incur more and more late fees and go into a spiral of debt? Is that really protect them? To have their credit trashed? And the Bureau's rule actually encourages them to pay late? I don't think so. I think in the long run, that damages that consumer. That damages that consumer's opportunity for home ownership or to get a loan for a car. This is a terrible idea. And so instead of referring to these as junk fees, I think we need to recognize what these fees actually are. They are a necessary cost of providing financial products and services. And by the way, the vast majority of Americans agree that they're legitimate. They don't think they're junk. They see this as for what it is. It's junk economics. But here is a great quote from a consumer who was surveyed about credit card late fees. Quote, "Paying on time is a personal responsibility I accept when I get a credit card. I'm extended credit by the bank, and late fees are a penalty for missing a payment I agreed to pay. It's not fair to expect that I shouldn't be penalized or for cardholders who pay on time to cover the costs of those who do not pay on time." Now look, I get it. Sometimes you miss a credit card payment and it's late. But guess what? There are customer service phone numbers for that. Maybe the post office didn't deliver it on time and you didn't pay online. Maybe you put a stamp on and it was late in getting there. Credit card companies operate in a highly, highly competitive market. And credit card owners know how to operate in that system, and they switch and they get offers to move their debt for a small fee and pay interest, zero interest for 12, 14 months. Very, very competitive. And so guess what? Those credit card companies waive those late fees because they know they want to keep those customers. So bad idea, and I urge all of my colleagues to vote yes on this resolution of disapproval, and I yield. For what recognition does the gentleman from Illinois seek recognition?
Move to strike the last word.
Gentleman is recognized.
Yield my time to the ranking member.
Gentleman yields.
Oh my goodness. Well, I think it is important for me to say something. You've done a great job for those poor credit card companies. So let me do something for the people. My something for the people is this. I agree, first of all, with the Consumer Financial Protection Bureau that would like to reduce fees to about $8. That seems to me more than fair. But what I want to do is have a colloquy with you about how you assume that if, in fact, they cannot get this exorbitant amounts of fees from people who pay late, that somehow people who pay on time are going to have their interest rates or whatever increase. How do you make that argument?
Because the CFPB itself, Madam Ranking Member, said that.
No.
I'm not saying that. Rohit Chopra's staff says that. They acknowledge it. They admit it. And for an independent agency to say, oh, well, we're independent, but are following this junk fee agenda from the White House, it's obviously a political agenda that the CFPB doesn't even agree with.
Reclaiming my time. You don't believe anything else that Chopra has to say, and all of a sudden you quoting him without having any facts. What you are claiming, I don't care where you heard it, if you heard it from them, and I would be absolutely surprised that you or believing that's what you
Will
heard.
the gentlelady
Yeah,
yield to answer
yes,
that
I
question?
yield, certainly.
So thank you for yielding. I would direct the gentlelady's attention to the rulemaking itself. It's in the Federal Register. The Bureau, and I'm quoting the Federal Register, okay? I'm quoting the CFPB. These are not my words. The CFPB's own data indicates that, quote, that 74% of all Americans with credit cards could experience, quote, higher maintenance fees, lower rewards, or higher interest on interest-paying accounts. And what they're referring to are people who pay on time.
All right, reclaiming my time. What you're saying is that the banks can decide that they're going to make good customers pay more for something like maintenance, whatever that is, and some other kinds of things that they're now saying, because I don't get $33 or $32 from someone that's paying late, that all of a sudden everything else is going to increase and I'm going to charge those good paying. That just doesn't make good sense.
Well, the gentlelady yield.
I don't care where you heard it, who said it, it doesn't make good sense. The fact of the matter is that this side of the aisle have decided that they're going to be on the side of the rip-off credit card companies and those who are stealing and taking money from the most vulnerable people in our society.
Well, the gentlelady
No,
yield.
I do not at this point. I got to tell you something. I do not support. As a matter of fact, the last I heard, the banks and the credit card companies were doing extraordinarily well. So if they arbitrarily decide that they're going to raise the amount of money that good customers are paying, they have a choice. They don't have to do that. And so I don't support that. I support the idea that these rates that are being charged for late payments is much too high, much too costly for the average citizen. And I would dare you on any day of the week to prove that you are right, that the people say that's right. We should be charged more. We should charge to be $30-something for these late charges. I believe that the people, whether they're Republican or Democrat or whatever, they're on our side. They're tired of getting ripped off. They're tired of getting overcharged. They're tired of seeing the banks of America continue to grow and have huge profits, pay less taxes, and still charge us all of this money for late fees. And so with that, I yield back to you.
Thank you. Here's the point. You know, you and I disagree about banks being big, bad, evil creatures or whatever I hear you say. The thing is, they're not the ones who are going to pay the $10 billion. They're not the ones who are going to eat it. It's the credit card customers who actually pay on time.
That's because they charge
them.
them.
They're the ones, they're going to get the higher interest
Well,
costs.
who's charging them?
Unfortunately, my time is
No,
expired.
your time's not up.
Oh,
You're in the chair. Come on, keep talking.
Oh, it's your time. The gentleman from Illinois' time has expired, unfortunately. Does anyone, does the gentleman from Tennessee seek recognition?
Yes, Mr. Chairman, move to strike the last word.
The gentleman is recognized.
You know, Mr. Chairman, I think what, you know, we talk about fees. This is an issue that's important to both you and I. We've both worked on this, is that, you know, banks, credit card companies in the form of security, they're providing services that they can't charge for. And those costs have to be paid for by way of their business model. And so for Congress to weigh in and try to somehow manipulate a business model that's providing, you know, access to credit to those, quite frankly, who have challenged credit scores, let's trust the market. And so I support this resolution. It's good policy. Thank you for offering it, Mr. Chairman. And with that, I yield to the gentleman from Kentucky as much time as he needs.
Thank you. I think the gentlelady from Missouri would appreciate it if I yielded as well.
Yes, ma'am. Sir.
So I will yield in the interest of time, unless there's any other member. The gentleman from California, for what reason does he?
I want to strike the last.
Gentleman strikes the last word.
I want to thank all my friends on the other side of the aisle for illustrating the difference between the Democratic and Republican parties. The acting chair says that this is a highly competitive market, that people change from one bank to the other, and he may be true. So this rule only applies to institutions over, I believe, $100 billion. I believe there's a cutoff. I forget exactly where that cutoff is. So what this means is that those institutions will be free to keep their existing system, and they will attract all those pay-on-time wonderful customers, and they'll still get the great deal. And those who occasionally pay late can stay where they are and get the lower late fee. If it is correct that this is a competitive market, then some will be in one category, some will be in the other, and consumers can choose. Second, the gentleman from Kentucky says they should be able to charge their costs. I agree. That's why $8 late fee covers the cost. But it's not just $8. It's interest at a very high interest rate from the moment you pay late until you finally pay. Now, today's computerized systems, I wonder if there's even an $8 cost. This is not a situation where it's the 1970s and three bank officials need to get together and say, what do we do with Mr. Jones's credit card? He's over, should we cut his? No, this is all done by computer instantaneously at no cost. The report cited by the gentleman from Kentucky says, well, this could conceivably, I could grow hair. It could happen. But it's highly unlikely for the very reason that this is a competitive market. I cannot believe that this is going to come out of the hides of those highly prized credit card customers that pay on time and that are good credit risks. Those folks will still be able to find a bank that will give them a good rate. And to think that, but if indeed it is true that cutting these late fees is harmful to those good consumers, then why does the gentleman from Kentucky wax poetically in favor of those banks that waive late fees? Presumably, waiving a late fee is a stab in the heart of every pay-on-time customer the bank has. No, banks often waive late fees, and I've never seen that condemned by any member of this committee. When a bank waives a late fee, it is not stabbing its other customers. When you pay late, $8 charge, interest rate running at around 30%, that is plenty. And for us to say that banks should be free to charge 4 times their actual cost, $32 or more, on the theory that they're then going to provide a better deal for their other customers? I don't think so. Keep in mind, the banking system is already taking 3% or more from the merchant before they even make a penny off their customer. Do we really need to say that 3% on what is now increasingly every transaction? It's been a long time since I've used cash for anything other than our own cloakroom. So they're making the 3% on the front end. They're getting the late fees that more than cover their actual costs. And they're getting 25 to 30% interest every day that money's outstanding per annum interest. I can't imagine that the banks need more. But if they do, well, that illustrates the difference between our two parties. And I'll yield to the ranking member for any comment.
Thank you very much. And I think you have said it very well. You've made the point. But the question that you the statement that you made, now you see the difference between Democrats and Republicans. Now the people know who it is who will protect them from exorbitant late fees and who are willing to lower the late fees, and those who want to protect the credit card companies and the banks and want them to continue to charge these high fees. The difference has been demonstrated very well here today, and I yield back the balance of my time.
The gentlelady yields back. The gentleman yields back. The gentleman's time has expired. Is there further debate? Okay. There being no further debate, too bad nobody can yield to me. The question now occurs on ordering H.J. Resolution 122 reported to the House with favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay.
Nay, no.
In the opinion of the chair, the ayes certainly have it. Yeah. Okay. The gentlelady, for what purpose does the gentlewoman from California seek recognition?
I request to record.
A recorded vote is requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. For what purpose does the gentleman from California seek
The
recognition?
exact opposite of what the committee did just a second ago. I ask unanimous consent that I be allowed to rescind my request for a recorded vote on H.R. 4206, the Bank Safety Act.
Without objection, the request for a recorded vote is withdrawn, and the ayes have it. The bill H.R. 4206, as amended, is ordered favorably reported. A motion to reconsider is laid on the table. Pursuant to notice, I call up H.J. Resolution 120, a resolution providing for congressional disapproval under Chapter 8 of Title 5, United States Code of the rules submitted by the Financial Stability Oversight Council related to guidance on non-bank financial company determinations, introduced by the gentleman from Arkansas, Mr. Hill. The clerk will report the resolution, which was distributed in advance.
H.J. Res. 120, providing for congressional disapproval under Chapter 8 of Title 5, United States Code of the rules submitted by the Financial Stability Oversight Council relating to the guidance on non-bank financial company determinations. A joint resolution providing for congressional disapproval under Chapter 8 of Title 5, United States Code of the rules submitted by the Financial Stability Oversight Council related to the guidance on non-bank financial company determinations.
Without objection, the resolution is considered read, and I will be recognized for 5 minutes to discuss my resolution, H.J. Res. 120. The Financial Stability Oversight Council, as its name implies, was established to identify risks to the financial stability of the United States, promoting market discipline, and responding to emerging threats to the stability of the U.S. financial system. However, I, along with a number of my colleagues on this committee, were deeply disappointed when recently the FSOC finalized their new non-bank systemically important financial institution, SIFI designation guidance. Instead of showing regulatory discipline, the Biden administration decided to issue the third non-bank SIFI designation guidance in 3 administrations, thereby cementing, in my opinion, FSOC's legacy as a political tool rather than an emerging threat monitor. This guidance transforms FSOC into a roving regulator aiming to bring entities under the Fed's control for seemingly and potentially partisan purposes rather than addressing true systemic risks. It also raises serious questions about whether FSOC is taking the best approach to even addressing systemic risk. An activities-based approach like the one that had been proposed in the Trump administration and was established, in my judgment, was the appropriate regime moving forward. Nevertheless, instead of examining risky activities within the broad financial ecosystem, FSOC has chosen to use the designation as a tool to crack down on individual companies and subject them to Federal Reserve oversight. This new non-bank designation guidance is a veiled attempt to grant political appointees the ability to go after specific companies without the need to adequately justify the designations across the economy. Further, the Biden administration failed to learn anything from the Obama administration's mistakes. For example, in the MetLife designation, it was struck down by the district court
saying that FSOC lacked a cost-benefit analysis, number one, and secondarily, was arbitrary and capricious in making that designation of MetLife. A conclusion that will no doubt be reached by the courts when a new designation is challenged because of this new revised proposed guidance. It explicitly excludes a cost-benefit analysis. Financial stability is paramount, not just for the U.S. economy's well-being, but for maintaining our global competitiveness. And given how powerful FSOC tools are, it's especially important to balance those authorities with prudence. That's why thoughtful members like Congressman Bill Foster have introduced bills like the FSOC Improvement Act, which requires the Fed board to treat non-bank SIFI designations as a last resort rather than a first option. Furthermore, abandoning the Trump administration's responsible, activities-based approach is demonstratively negligent and diminishes the FSOC's potential to act as an effective coordinating body amongst the federal regulators. A coordinated approach that examines activity-based risk within the financial system and subsequently works with market participants is undoubtedly a better approach for mitigating risk. Rather, FSOC's chosen to act as a hammer, looking at everything in their risk category as a nail. There's even some in the Biden administration that commented that FSOC has failed under this administration because it hasn't made any new designations. Well, let that sink in a minute. If your barometer for success is simply looking at how a regulatory body has or has not expanded its jurisdiction, that's concerning. And in my view, it's fundamentally flawed as a mindset. Unfortunately, we witnessed heavy-handed and haphazard approach to financial regulation by all of our financial regulators in recent years. And that's why industry participants of all stripes have come together to oppose this new guidance from FSOC, including 8 trade associations from different industries who've all signed on to a joint letter of support for this Congressional Review Act resolution. And I would ask that that be submitted in the record at this time, and without objection, it will be. I urge all my colleagues to support this CRA, and let's go back to something that was working that I think is much more consistent with our supervisory concept in and around FSOC since it was initiated. Let's do it on an activities base. Let's submit those that are performing in a systemically risky way, more scrutiny under FSOC, and let's make sure we have a balanced, effective, well-measured cost-benefit analysis. And with that, I urge my colleagues to support this CRA, and I yield back the balance of my time. What does the gentlewoman from California seek recognition?
I move to strike the last word.
The gentleman is recognized for 5 minutes.
I strongly oppose this resolution, H.J. Res. 120, which would rescind updated guidance by Treasury Secretary Yellen as chair of the Financial Stability Oversight Council regarding FSOC's procedures for designing a non-bank financial company, like an insurance company or asset manager as a systemically important financial institution, or SIFI. These new procedures overturn very harmful guidance, but put forward by Trump's FSOC that rendered the SIFI or SIFI designation tool meaningless. A former FSOC official testified before our committee that it could take FSOC 6 years before they designated a company under these procedures. In fact, the Trump-era guidance was so harmful that former Treasury Secretaries Geithner and Liu, along with then former Fed chairs Yellen and Bernanke, took the unusual step to write a letter strongly warning Trump's FSOC not to adopt them. They wrote, quote, "Though framed as procedural changes, these amendments amount to a substantial weakening of the post-crisis reforms. These changes would make it impossible to prevent the buildup of risk in financial institutions whose failure would threaten the stability of the system as a whole." In December 2020, I wrote a letter to then President-elect Biden, and this was one of the key Trump-era actions I urged Biden's administration to overturn. Our financial system is safer because FSOC, under Secretary Yellen's leadership has done just that, restoring a key authority to promote financial stability. Congress, led by Democrats, many of whom are still on this committee, established this authority at the FSOC to ensure that companies like AIG, which were able to amass trillions of dollars in financial exposures, could no longer threaten our economy and hide in the shadows. For critics of FSOC, I would highlight that the new guidance makes clear that designation is only one tool at FSOC's disposal and that it is not one that the Council is prioritizing over other tools, such as making recommendations for regulatory actions to improve safeguards. Furthermore, I appreciate that the new guidance ensures that any company has adequate due process and that there's robust engagement between FSOC, the company, and the company's primary regulator. Last, since this is a Congressional Review Act resolution, it would not only rescind FSOC's guidance, but it would effectively codify the harmful Trump-era guidance, since FSOC would be unable to issue new guidance without a further act of Congress. And so, despite the fact that my friend Mr. Hill has decided that he's going to redesignate, redefine, restructure all of FSOC, regardless of the problems that they have the responsibility for oversight and dealing with, I urge members to heed the warning of our former Treasury secretaries and Fed chairs about that Trump-era guidance and vote no on this harmful resolution. I yield back.
The ranking member yields back. Is there further debate? The gentlewoman from Missouri, the chairwoman of the Capital Markets Subcommittee, Mrs. Wagner, is recognized for 5 minutes.
I thank you, Mr. Chairman, and I move to strike the last word.
The gentlewoman's recognized.
The 2008 financial crisis was a result of the inability of financial regulators to properly identify systemic risk and promulgate appropriate regulations. And as a response to the crisis, the Dodd-Frank Act was passed in 2010. This Democrat law doubled down on the failed approach of over-reliance on our regulators and created a new, the chairman called it roving regulator. I'm going to call it roving mega regulator with enormous power. The Financial Stability Oversight Council, FSOC, which was tasked with identifying systemic risk. Additionally, Dodd-Frank drastically reduced competition in the banking sector. It imposed barriers to entry for new banks and burdened financial institutions with a deluge of new requirements that resulted in thousands of banks either closing shop or merging with larger institutions. Under Dodd-Frank, FSOC has the power to designate companies as a systemically important financial institution, SIFI, and therefore subject to Federal Reserve supervision and enhanced prudential standards, in other words, too big to fail. Last year, FSOC finalized guidance that would allow it to apply these same too big to fail burdens to non-bank financial institutions, such as asset managers, broker-dealers, insurance companies, and private funds. The annual consumer cost of designating a non-bank financial institution as a SIFI could range from $5 to $8 billion. Yet, FSOC's new guidance fails to require any cost-benefit analysis when making such a designation. If the financial crisis taught us anything, Mr. Chairman, it was that relying on government regulators in Washington to identify the root and root out systemic risk will always fail. The collapse of Silicon Valley Bank is the most recent example of this failure by regulators to identify and address risk. This guidance put forth by the Biden administration rescinds the 2019 Trump-era changes that rightfully moved FSOC's authority from an entities-based approach to an activities-based approach in determining whether a non-bank entity should be deemed a SIFI. To grant such unfettered discretionary power to a government agency should concern every American, particularly when the body exercising that power, FSOC, is composed almost entirely of members of a single political party. Congress should not be in the business of empowering government bureaucrats to act subjectively with very little transparency or accountability. That approach only hurts U.S. businesses, their customers, and our economy. I urge all of my colleagues to support the gentleman from Arkansas's resolution that reins in our regulators and saves Main Street investors billions of dollars. And I yield back the balance of my time.
The gentlewoman yields back. Is there further debate? Strike the last word. The gentleman from Illinois, Mr. Kasten, is recognized to strike the last word.
Thank you, Mr. Hill. So I oppose the CRA and support the FSOC's recent ruling. Although I think there's a rich conversation we could have here about the SIFI designation process, and maybe that's for a longer conversation. I want to go back to 2019 when a former constituent of mine made some comments with former Fed Chair Ben Bernanke and Treasury Secretary Tim Geithner. My constituent was a guy named Hank Paulson. And they collectively made the observation that financial risk tends to migrate around regulatory obstacles like a river flowing around rocks. They obviously had some experience in 2008 with risks being concentrated in AIG and outside of the view of regulators. We sat here just a little over a year ago talking about how risk was concentrated in uninsured depositors at SVB, and I remember all the stress of us wondering about what that was going to do to society. And as recently as just a few hours ago, when we were debating H.R. 5535, we had this whole conversation around what happens if Citizens Property Insurance, that has now doubled their market share of Florida insurance coverage, and that Governor DeSantis has said is on the verge of going insolvent because they can't cover those losses. What happens if they can't cover that risk? Now, are they a SIFI? Probably not. On the other hand, if you can't get property insurance in Florida, and therefore you can't get a mortgage in Florida, and therefore you can't pay the property taxes to keep the state of Florida going, the failure of Florida would be systemically important. Now, I am not suggesting that we declare Florida a SIFI, to be clear, but I think we are in a world, particularly with climate risk, where we know that there is risk flowing through the system, as these distinguished former Fed chairs and Treasury secretaries say. Now, by the way, when I say he's a former constituent of mine, I wish he still was a constituent, but the Illinois State Senate changed the district lines. But I still think he's a pretty smart guy. But we know those risks are there, and the conversation that I would love us to be having is saying, what do we do when there is systemic risk in the financial system that is diffuse and not concentrated in one entity? That's a good conversation. As we sit here right now, the SIFI designation is the big tool that FSOC has to monitor these risks. And look, we've seen it's not just the US, the European Central Bank said that handling of climate risk by 23,000 different asset managers looked at the way it's being handled, and they said, quote, it is poorly assessed and that no significant segment of the investment fund sector achieves a clear reduction of its exposure to physical risk. This is a big deal. We should be strengthening FSOC's authority. We should be having a conversation about how to look at systemic risk in our society wherever it lies, even if it's not in a SIFI. But we should also take the wisdom of who is out there. I just want to, before I wrap up, the acting chair said that there's been 3 changes in FSOC designation and 3 presidents. That's true. What we're talking about here is the rescission done in 2019, and I would again go to the wisdom of those who were there in 2008. Janet Yellen, Ben Bernanke, and Tim Geithner, and Jacob Lew all said at that time that that 2019 guidance would substantially weaken post-crisis reforms and, quote, make it impossible to prevent the buildup of risk. They said that those 29 changes would effectively neuter the SIFI designation authority. We do not want on this committee to be accountable for accelerating a future financial crisis. What FSOC is doing is good. I can argue they should do more. This CRA is a bad idea, and we should vote against it. Thank you for your time. I yield back.
The gentleman yields back. Is there further debate? Hearing none, the question now occurs on ordering H.J. Res. 120 reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay.
Nay.
In the opinion of the chair, the ayes have it. For what purpose does the gentleman from California seek recognition?
I seek recognition to ask for a recorded vote.
The gentlewoman has requested a recorded vote. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. Pursuant to notice, I now call up H.J. Res. 125, 126, and 124, and ask that they be considered en bloc. The clerk will report the resolutions which were distributed in advance.
H.J. Res. 125. Providing for congressional disapproval under Chapter 8, Title 5, United States Code of the...
Without objection, we'll have all three resolutions in the record as read. The gentleman from Wisconsin recognized to strike the last word.
Thank you, Mr. Chair. On December 2nd, 2022, the Federal Reserve Board requested comment on draft principles that would provide a high-level framework for the safe and sound management of exposure to climate-related financial risks for board-supervised financial institutions with over $100 billion in assets. The Fed's principles for climate risk management follow the release of similar principles from the OCC and the FDIC, and likely will result in an interagency rulemaking on climate dictating bank practices. Neither the Fed nor any of the numerous extra-legal international and NGOs that the Fed meets with on potential climate risks can clearly articulate the risks and do not, by admission, have accurate data on models to account for such risks. While Chairman Powell has argued in public that the Fed ought not to be setting climate policy, and Vice Chair for Supervision Barr testified that the Fed ought not to be channeling credit towards politically favored or away from disfavored sectors of the economy, ongoing work by the Fed points in exactly the direction of the increased Fed action on climate policy and credit channeling with no authorization from Congress. On January 17, 2023, the Federal Reserve Board provided additional details on how its pilot climate scenario analysis exercise will be conducted and the information on risk management practices that will be gathered over the course of the exercise. This clearly signals that future scenario analysis, which could be full-blown climate stress tests with links to capital requirements and asset risk weightings, will be used to steer credit away from production in sectors of the economy like fossil fuels for political reasons. I urge my colleagues to vote in favor of this resolution, and I yield back.
Is there further debate?
I move to strike the last word.
The ranking member is recognized for 5 minutes.
House Republicans appear to be in complete denial about climate change. When we have a housing affordability crisis and consumers being charged billions of junk fees, Republicans are wasting our time rescinding every rule, regulation, or guidance issued by any of our agencies if it has anything to do with climate change. Right now, the climate crisis is getting worse, evident by record-breaking heat, floods, storms, droughts, and wildfires in communities all across the United States. Climate change is real, and climate-related financial risk must not be ignored. We're considering 3 resolutions that would rescind interagency guidance from the Federal Reserve, FDIC, and OCC to the largest banks on steps they can take to ensure they have risk management systems that account for climate-related risk. Specifically, this guidance describes how large banks can address specific prudential risk areas, including credit, liquidity, other financial risk, operational, legal, and compliance, and other risks regarding climate-related risk. And yet, despite the fact we saw a record-breaking 28 climate event-related events that cost more than $1 billion last year, Republicans want large banks to pretend that did not happen and to not account for those risks in their risk management. Indeed, this guidance we are debating is such a small step, and the United States is far behind what other countries are doing to deal with this very real threat. For example, regulators in the United Kingdom included climate change in their stress testing 4 years ago, and the Bank of England designed their 2021 stress test to aid their economy's transition to net zero and to analyze climate-related risk on capital requirements. For all the talk I hear from Republicans and the industry urging our financial regulators to provide more clarity, more guidance, and more information about how the industry should comply with the law and operate in a safe and sound manner, the policy solution Republicans are advancing is to get rid of that guidance. This hypocrisy is rich, and this denial about climate change from the other side of the aisle will only serve to harm our children and grandchildren's generation. And so, I strongly urge my colleagues to reject these 3 resolutions, and I yield back.
Is there any further debate? I now recognize myself for 5 minutes to strike the last word. Well, I'm glad today that we are considering my CRA on the FDIC's rule on climate-related financial risk management for large financial institutions as part of this en bloc. This rule should never have been finalized in the first place. As an independent agency created by Congress, the FDIC is tasked with ensuring deposits, supervising financial institutions for safety and soundness while protecting consumers, making large and complex financial institutions resolvable, and managing receiverships when necessary. Despite the incredibly important tasks that fall under this congressionally mandated mission, the FDIC, under Chair Gruenberg, is now also venturing into climate policy. The FDIC is not a climate regulator. When the FDIC finalized this rule in October of last year, Chair Gruenberg said, "The FDIC is not responsible for climate policy and does not tell banks which customers to serve." In truth, however, this rule would do just that. Under the Biden administration's direction, this rule requires banks to account for customers' climate risks and other ESG factors when determining who to bank, offer loans to, and ultimately do business with. Even after a year after the collapse of Silicon Valley Bank and Signature Bank, other prudential regulators still have their eyes off the ball and are more focused on picking climate winners and losers than they are on promoting sound risk management. This CRA would nullify the FDIC's rule and steer the agency back toward its core mission of ensuring the safety and soundness of financial institutions and the ones it supervises. In this current environment, the last thing we need from this administration is more red tape and more attacks on our American energy producers. I urge my colleagues to support this CRA, and I yield back. Is there further debate? The gentleman from Florida, Mr. Donalds, is recognized for 5 minutes to strike the last word.
Thank you, Madam Chairman. I want to thank my colleagues for your support on this resolution. H.J. Res. 124 provides congressional disapproval of the OCC's principles for climate-related financial risk management for large financial institutions. This resolution will end another instance of extreme bureaucratic overreach and stop the latest attempt by the Biden administration from circumventing Congress to implement policy. The OCC's principles demand that large private financial institutions address climate-related risks in their governance policies, procedures and limits, strategic planning, risk management, data risk measurement, and reporting and scenario analysis. While this rule will increase the cost of business for financial institutions, the average consumer will once again be the ones bearing the brunt of poor federal policy. The OCC's mission is to ensure banks and savings institutions operate in a safe manner and provide fair access to financial services, not to impose overly burdensome and immaterial environmental mandates on private industry. The federal government should be focused on creating a strong market for American businesses and institutions to thrive, not intentionally implementing barriers. We should also be having these policy debates here in Congress where the members are directly accountable to the voters and not leaving these decisions to unelected and unaccountable administrative state employees here in Washington, D.C. I urge my colleagues to help protect American markets and return these wide-reaching policy debates to Congress by supporting H.J. Res. 124. Thank you, Madam Chair. I yield back.
Is there further debate? There being no further debate, the question now occurs on ordering H.J. Res. 125, 126, and 124 reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay.
No.
In the opinion of the chair, the ayes have it.
Request to record it.
A recorded vote has been requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. We will take up the postponed votes immediately after floor votes. The committee stands in recess.
This is not a human shield in my lap, just to be clear. We're waiting on Mr. Lynch and Mr. Scott. So if anybody has access to, all right. So what says the crowd? Should we, all right. All right. Oh, shoot. I know, we're going to get going. The committee will come to order. As previously discussed with the ranking member, we'll vote today by using electronic devices. Before proceeding to our pending votes, we'll call the roll. Members should be aware that it may take several seconds for their vote to be recorded on the electronic device. Be patient, push the button, wait, and then it will be, you'll see it visually. So please be patient with, and staff will work with you to fix any issues. And I assure you, will not close any vote until every member is recorded that wishes to be recorded, and we'll now call the roll. Clerk will open the vote. Oh, green means you're here. I'm just passing on what the staff has said. This is silly, isn't it? Look at it. All right. It does. I mean, it takes a little time to record. I'm sorry. Sorry. I hit green here. Mr. Barr.
He's present. He's green.
Has every has every member been recorded? The clerk will close the vote. The clerk will report the roll.
Mr. Chairman, there are 49 members here. A quorum is present.
The committee will, that is the first vote of the House Financial Services Committee using electronic devices. We succeeded. We should all be proud of ourselves. Let me introduce my youngest of 3 children, my son, Perry McHenry. You gonna say hello, Perry? Hi. We've got bipartisan pizza, Perry. All right. Got pizza. That's good. Pizza. Yes, we're going to eat pizza. The committee will now take, and this is my way of asking forgiveness of all members. The committee will now take postponed votes on pending amendments, pending amendment to H.R. 5535, the Insurance Data Protection Act offered by the gentleman from Wisconsin. Members will record their vote electronically. The question is on the amendment offered by the gentlewoman from Ohio, Mrs. Beatty. The clerk will open the vote. There it is. Now we have to leave this. We have to leave this here for a second. Okay? There you go. Have all members voted? Have all members voted? Any member wish to change their vote? If not, the clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 21 and the nays are 28.
A majority having voted against the amendment is not agreed to. There being no further discussion or amendments to the bill, the question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from Wisconsin. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. The amendment is adopted. The question now occurs on ordering the bill, H.R. 5535, as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it.
Yes, your recorded vote.
Recorded vote has been requested. All those in favor of recorded vote, raise their hand. A sufficient number having raised their hand. Members will now vote electronically. The clerk will open the vote. Have all members recorded their vote? There it is. Mr. Horsford? No, he's in.
So we'll call it. So now just.
Let them go manual.
Time out. Just give us a second.
Oh, it worked. Okay.
You got to hold it up then. Now? Shh. Now, is there a member who's not voted? Is there a member who has to change their vote? If not, the clerk will close the vote, and the clerk will report.
Mr. Chairman, on this vote, the ayes are 28 and the noes are 22.
A majority having voted in favor of H.R. 5535 as amended, the bill is ordered favorably reported to the House without objection. Motion to reconsider is laid on the table. The committee will now take postponed votes on the pending amendments to H.R. 802, the Respect State Housing Laws Act, offered by the gentleman from Georgia. Members will vote electronically. The question is on the amendment offered by the gentlewoman from California, the ranking member. The clerk will open the vote. Is there a member who hasn't voted or wants to change their vote? Have all members voted? The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 21 and the nays are 29.
A majority having voted against the amendment is not agreed to. There being no further discussion or amendment to the bill, the question now occurs on the adoption of the amendment of the nature of a substitute offered by the gentleman from Georgia. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. The amendment is adopted. The question now occurs on ordering the bill. H.R. 802, as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. All those opposed shall signify by saying nay.
Recorded vote requested.
The opinion of the chair, the ayes have it. Recorded vote having been requested. All those in favor of recorded vote, please raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. Members will vote electronically. The clerk will open the vote. Bring your pizza. Any member wish to change his or her vote? Any member not voted? The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 29 and the nays are 21.
A majority having voted in favor of H.R. 802 as amended, the bill is ordered favorably, reported to the House. Without objection, the motion to reconsider is laid on the table. The committee will now take the postponed votes on the pending amendment to H.R. 7437, the Fostering the Use of Technology to Uphold Regulatory Effectiveness, Future in Supervision Act, offered by the gentlewoman from Indiana. Members will vote electronically. The question is on the amendment offered by the gentlewoman from California, the ranking member. The clerk will open the vote. There it is. It is. Any member who's not voted or wish to change his or her vote? Oh, I'm sorry. I think he's got a bum seat. No. Well, all right now. Could it be your location? There we go. Any member who hasn't voted or wish to change their vote? Clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 28.
Majority vote having voted against the amendment, the amendment is not agreed to. There being no further discussion or amendment to the bill, the question now occurs on the adoption of the amendment in the nature of a substitute offered by the gentlewoman from Indiana. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. And the amendment is adopted. The question now occurs on ordering the bill H.R. 7437 as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. Is there a recorded vote requested? A majority having voted in favor of H.R. 7437 as amended, the bill is ordered favorably reported to the House. Without objection, motion to reconsider is laid on the table. For members' understanding of the pace here, even with some laggy buttons here or devices, we're under 1 minute, and a normal vote via voice is over 3 minutes. The committee will now take, it's not encouraging members for more amendments or more votes. The committee will now take postponed votes on the pending amendments to H.R. 7440, the Financial Services Innovation Act of 2024, as offered by the chair. Members will vote electronically. The question is on Amendment 1, offered by the gentleman from Massachusetts, Mr. Lynch. The clerk will open the vote. That's, the Himes technique is a good one. Any member wish to change his or her vote? The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 28.
A majority having voted against the amendment is not agreed to. The question is on the amendment, number 2, offered by the gentleman from Massachusetts, Mr. Lynch. The clerk will open the vote. Any member wish to change his or her vote? Any member wish to change his or her vote? Shh. The clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 28.
A majority having voted against the amendment is not agreed to. The question is now on Amendment 3 offered by the gentlewoman from Ohio, Mrs. Beatty. The clerk will open the vote. Any member wish to change his or her vote or has not recorded their vote? The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 28.
A majority having voted against the amendment is not agreed to. There being no further discussion or amendment to the bill, the question now occurs on adoption of the McHenry Amendment in the nature of a substitute. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. And the amendment is adopted. The question now occurs on ordering the bill, H.R. 7440, as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. All those against shall say nay. In the opinion of the chair, the ayes have it. A recorded vote has been requested. A recorded vote is requested. All those in favor of a recorded vote, please raise their hand. A sufficient number having raised their hand, a recorded vote is ordered. Members will vote electronically. The clerk will open the vote.
Mr. Chairman.
Any member wish to change his or her vote is not recorded. Clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 28 and the nays are 22.
A majority having voted in favor of H.R. 7440 as amended, the bill is ordered favorably reported to the House without objection. Motion to reconsider is laid on the table. The committee will now take postponed votes on the pending amendments to the pending amendment to H.R. 7428, the Earned Wage Access Consumer Protection Act, offered by the gentleman from Wisconsin. Members will vote electronically. The question is on the amendment offered by the gentleman from Texas, Mr. Green. The clerk will open the vote. Here, let me try something. I'll show you pictures. Hold on one second. We gotta wait till this is. Is there a member who is, I had a proxy vote there. My apologies. Any member wish to change his or her vote or not voted? Clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 28.
A majority having voted against the amendment is not agreed to. There being no further discussion or amendments to the bill, the question now occurs on adoption of the amendment in the nature of a substitute offered by the gentleman from Wisconsin. All those in favor shall signify by saying aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment is adopted. The question now occurs on ordering the bill 7428 as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. All those opposed shall signify by saying nay. A recorded vote, the ayes have it. A recorded vote having been requested by the ranking member, a recorded vote is requested. All those in favor of a recorded vote, please raise their hand. A sufficient number having raised their hand, a recorded vote is ordered. The members will vote electronically. The clerk will open the vote. Okay. Okay. We're going to hit the green. The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 28 and the nays are 22.
A majority having voted in favor of H.R. 7428 as amended, the bills are ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. Pursuant to the chair's previous order, we'll now take the vote pending ordering H.R. The vote pending on ordering H.R. 4116 as amended favorably reported. Members will vote electronically. The clerk will open the vote.
Dad.
Any member wish to change his or her vote? The clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 50 and the nays are 0.
A majority having voted in favor of H.R. 4116 as amended, the bill is ordered favorably reported to the House. Without objection, motion to reconsider is laid on the table. There being no, pursuant to the chair's previous order, we'll now take the vote pending on ordering H.J. Res. 127 favorably reported. Members will vote electronically. The clerk will open the vote. Okay. Do you want to go get pizza? You want to go get pizza? Any member who's not voted wishes to vote, or any member wishes to change his or her vote. The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 28 and the nays are 22.
A majority having voted in favor of H.J. Res. 127, the resolution is ordered favorably reported to the House. Without objection, motion to reconsider is laid on the table. Pursuant to the chair's previous order, we'll now take vote pending on H.J. Res. 122, favorably reported. Members will vote electronically. The clerk will open the vote. Any member wish to change his or her vote or has not voted, clerk will report. Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 28 and the nays are 22.
A majority having voted in favor of H.J. Res. 122, the resolution is ordered favorably reported to the House. Without objection, motion to reconsider is laid on the table. Pursuant to the chair's previous order, we'll now take the vote pending on ordering H.J. Res. 120 favorably reported. Members will vote electronically. Clerk will open the vote. Any member not recorded? I know, but. Any member wish to change his or her vote is not voted? The clerk will close the vote. Clerk will report.
Mr. Chairman, on this vote, the ayes are 28 and the nays are 22.
A majority having voted in favor of H.J. Res. 120, the resolution is ordered favorably reported to the House. Without objection, motion to reconsider is laid on the table. Pursuant to the chair's previous order, we'll now take vote pending on ordering H.J. Res. 125, 126, 124 favorably reported. Members will vote electronically. The clerk will open the vote. Good. Any member wish to change his or her vote? Any member wish to change his or her vote? Any member not voted? We've got one more. Hold on. One 120 is right there. The clerk will close the vote. The clerk will report.
Mr. Chairman, on this vote, the ayes are 28 and the nays are 22.
A majority having voted in favor of H.J. Res. 125, 126, and 124, the resolutions are ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. Staff are authorized to make technical or conforming changes on all measures in order to be reported today. Members will have 2 days to file views on each reported measure considered today. There being no further business pending, this first foray into electronic voting financial services has been quickly concluded. I want to thank members, and I want to thank the staff for making this a reasonable and good process. And with that, the committee stands adjourned.